dipping in? Or do you believe there's too much of uncertainty and there's not going to be much growth? So why should they even get the current multiples? Your take?
Yeah, I mean, I've always believed that I've had a hard time with the multiples unless you're going to have growth. X growth, what are they worth? What is the valuation? So, there are two questions. There's a short-term growth question, and there's a long-term terminal value question. And on both those, there's enough question marks that we're not getting excited. I think they may be good for a trade at some point because, as Nandan Nilekani said at the AI Summit, there's going to be an implementation story for the IT service companies. But the question is the implementation story going to carry the hundreds of thousands of people that work in these IT service companies, or is it going to be a smaller subset of them that are going to be doing that work? And what does that mean? And this is a question for all SaaS companies and now for Indian IT service companies. Is the per seat model getting disrupted over time into a more outcome-based model? And yes, there'll be some companies that will transition very well. But as a group, I think it's going to be challenging.
Yeah. Growth is going to be challenging in that sense. Arvind, do you have a strong view on markets overall? I mean, directionally? Are here in India, of course, I mean, I think we're down about 3.5% for the year. And last year was poor in that sense. On an absolute basis, it's poor. Relative basis, it's poorer still. But overall, directionally, not just India, but I mean, is the global market looking a little heavyish or all okay?
Well, leadership has clearly changed. I think the tech names in general are struggling. Obviously, the software is being the prime example, but even the Mag 7 have had mixed results at best. And you're seeing energy stocks and other parts of the economy, which are a very small part of the index. And I'm talking about the broader global markets, are now starting to be the outperformers. And they're not just outperforming because there's short-term Iran tensions. This outperformance has started, several weeks ago. And so I think that it could be an interesting year where the leadership is kind of getting a little more muddled versus a very clean AI trade with the tech stack leading the way. And this is more of a transition year. And where that leaves the Indian market, I think, to the extent that oil prices go up on supply concerns, Indian market is not going to be, is not going to see a lot of outperformance. But if the growth story, which is starting to show signs of revival, then once the oil news settles down and hopefully we get past this Iran tension sooner or later, then the market could start to perform. But, India headwinds remain things like IT, which are not benefiting, and now oil in the short term. So in the short term, I'm not sure that there's, much of a momentum that we see in the Indian markets.
Arvind, one quick question. Do you expect a secondary impact of the software pain? So, for example, Blue Owl, which is that alternate asset managers, they were big lenders to software companies. And we know the news flow over the last 48 hours. They have halted redemptions at one of their retail-focused private credit funds. They have rushed towards a $1.4 billion asset sale. And that's because of the exposure Blue Owl has to the software companies, where there you can see the pain and the bludgeoning. Is this an isolated case, or do you think there will be a ripple impact of the weakness in software spilling over to other parts of the financial market?
Well, so let's distinguish what is going on with Blue Owl and what's going on with the software companies in terms of equity markets versus the short-term business. From a business standpoint, most of the software companies have not seen any collapse. In many cases, not even a slowdown in growth. The concern is about the long term. And so I think there's a little bit of an over panicking about the short term. I think the structural problems are more long term, and I'm not sure that they're going to get disrupted that quickly, and everybody's not going to be disrupted. So there's a little bit of a rush for the exits that's causing the Blue Owl type problems, but I don't think it suggests a systemic risk in software or a systemic risk in lending in the short term. So I think maybe some of this is a little bit of a panic without a real business collapse that was underlying that panic in the short term.
Yeah, no, absolutely. Take your point there, Arvind. Good conversation. Thank you very much for joining us, and appreciate your time here as always on CNBC TV 18. Thank you.
Thank you, Krishna.
All right, let me just quickly run you through what's lined up here on the program over the next 2.5 hours as we look ahead. So 8:35, we have the management of Gulf Oil to discuss data center opportunity and what they're seeing out there. We'll also have Rohit Srivastav joining us at 8:30 to talk about markets, because I think that's the big focal point. 9 o'clock, Probal Sen, oil spikes and what should you do in that space. 9:20, Pankaj Murarka of Renaissance Investment Managers talks about markets. 9:30, we'll have a special discussion around Jio's big AI push announced yesterday. Management of Hindalco will be speaking with us at 9:40 on their F527 outlook. 9:50, we'll be speaking with Inox GFL Group and their, the Win World asset acquisition. Towards the end of the program, Lata in conversation with Manish Gunwani of Bandhan AMC on the underperformance of Indian markets and what really could turn the tide here, if at all. Stay tuned. All of that coming up.
Welcome back. Hope you're having a good morning. Well, time to focus on stocks, and our research team is standing by with all the top stocks. You need to look today at Ekta joins in to tell us about Novartis. Ekta, morning.
Well, morning. This is a deal which has really been on the cards, and that's what's taken place when Novartis has entered into an agreement with Chris Capital, where they will be selling 70.68% stake in the company. So they will be selling that majority stake to Chris Capital. Remember that if that Novartis AG, which is basically the parent company of the company of Novartis, was basically considering this, and now the deal is done. We're still working out the details, but the valuation is expected to be around 2,100 crores as a whole. And Chris Cap will possibly be purchasing this stake for around 1,500 crores in terms of the majority stake. Remember, the likes of Dr. Reddy's were also in the fray for it. There will be an open offer which will take place, which will be at around 860 rupees per share. We'll come back with more details, but as of now, the deal is done and Novartis is now off the block, with Chris Capital being the majority owners.
Thank you very much for that. And we need to track ABB's numbers and the outlook. Vinny, how does it look?
Hi, so ABB Q4 calendar year 25 numbers, I beg your pardon, is what they've reported. Now, overall, inline set of numbers that's coming from the company. Revenue growth, as expected, has just been a muted growth of around 5%. Our expectation was around 2%, so slightly better there. Margins come in at 15%, but this includes the labor code impact that is there this time of around 66 crores. If you exclude that, then the adjusted EBITDA would come in at around 17%. So good improvement in terms of margins as well. Apart from that, revenue growth has been across all their segments, whether the motion segments, automation segment, robotics segment, all of them have seen a very good growth. Order inflow. We did have a clue coming in from ABB Global's numbers that order inflow would be good. This time it's coming at around 4,096 crores. The run rate in the last few quarters was in that 3,000 range. Now that has seen an improvement. Plus the order book overall has seen an order inflow has overall seen a jump of around 50% on a year-on-year basis. Do not forget the company has highlighted that they're mainly seeing a benefit coming in from data centers, automotive, building and infra and railway side segments and metal segment, which is leading to better inflows in terms of the orders for the company. The stock has already seen a run up. In the last 1 month, it's up almost 20%, especially after the global numbers that came in where they indicated that India segment would see a very strong order book. But still, given the strong order book continues, we could see a slight bit of an uptick in the stock today as well.
Okay, all right. Thanks a lot for that, Vinny. Looks like you're in Friday mode.
She wants to turn back time. She thinks it's calendar year, Q4 calendar year 2024.
No, let's not go back there, because then we'll have to go through the whole tariff saga again. I'm happy with 2025.
Okay, all right, Vinny. Thanks for that. Hopping across to Sid, he's tracking CIE Auto. Morning, Sid.
Good morning, Najal. So for CIE Auto, also it was Q4 CY25 earnings. As far as earnings are concerned, it was a mixed set of earnings, reported double-digit revenue growth for both India and the European business. While as far as margin is concerned, there was a drop for both these businesses, India and the Europe. And going forward, company is expecting to hold the margin and the growth at these levels. Now, why the margin was down? For India business, there was an energy tariff increase by Maharashtra government that impacted the margin. And second, labor code also had an impact on the margin. For European business, there was one-off cost related to one of the subsidiaries that had an impact on the margin. Coming to the numbers, revenue has increased by 15%, has come in at 2,326 crore. EBITDA has increased by 8%, while margin has seen a drop of almost 100 basis points. It has come in at 15.4% versus 16.4%.
Thank you very much for that. It's now over to Ria for more stocks which are in the news.
Well, yes, let's start off with SBI Life first. The US FDA has closed an inspection of the injectable medical devices unit with 0 observations. Swiggy will also be in focus today. They have decided to shut down their food delivery app called Snack after it failed to scale after initial operations in cities like Bangalore and Gurgaon. Keep an eye on Apollo Pipes as well. The promoter has bought 5.25 lakh equity shares, which is 1.19% of the stake of the company on the 13th of February. And lastly, 2 stocks will be in focus on the back of order wins. The first one is Space Digitech. They have received an order worth roughly 89 crores from RailTel for the supply of video surveillance systems, and the execution period for this will be 8 months. And RailTel has also received an LOA worth roughly rupees 36 crores for a railway signaling project with a 24-month execution period.
Okay, all right. Thank you very much, Ria, for that. Well, let's talk about commodities, and I think oil's got to be top of mind once again. I think it's almost a 7% pop in 2 sessions. Manisha, good morning.
It is, yes. And if you look at the week-on-week basis, it's up by 6%. It's trading at a 6-month highs as well. 15% up for this year till time. But the markets are right now working with a $10 to $12 of a war premium. the U.S. president has set a 10 to 15-day deadline for nuclear deal talks with Iran. With Iran also reiterating with whatever U.S. is saying, and with U.S. deploying largest military force in Middle East since 2003 Iraq invasion, is something that really seems to be making a lot of markets jittery here. And it's not just about U.S. and Iran as well, remember, because it is the stalled diplomatic efforts between Russia and Ukraine that seems to be working into crisis. It is also about the U.S. crude inventories declining by a big 9 million barrels in the previous week itself. So that all of that seems to be adding up. The geopolitical tensions have led to buying in safe haven. So you have gold back above $5,000 an ounce. Silver prices yet again gained 2% overnight, trading at around $78, $79 an ounce there. Same is the case with metals as well. Actually, tangible commodities seem to be doing well for a third straight day today. So you have metal prices trading in the positive also. The street, though, is going to watch for the U.S. PCE data that would give you further direction in many of these commodities.
All right. Thank you very much, Manisha, for that. So that is the dollar, which, of course, is moving up for the last 2 or 3 trading sessions. And, of course, I mean, you know, what's happening with the oil complex as well. Sud is here with the brokerage calls of the day. And Sud, over to you. What's top of mind and where is the street focused on?
So Investec has today initiated coverage on JSW Cement with a buy call and targets given of rupees 146 per share. It says company stands out as a rare combination of superior execution, cost leadership and disciplined growth, and it's well positioned to scale into India's top 5 cement players by FY30, and it also leads the sector on blended cement and also on ESG ratings. Next one is Lenskart. Now there is another brokerage which has initiated coverage with a buy call on the stock, and today it's Motilal Oswal, and targets given of rupees 600 per share. It says company has built strong moats in a difficult to scale category, and it expects CAGR of 25% for revenue and 53% for EBITDA over FY25-28, and expects free cash flow to improve in the range of 65 to 70% of EBITDA beyond FY28, and valuations are at a premium of other leading retailers, but Motilal Oswal believes it's justifiable. Last one is on auto company CLSA has come out with a note. It says premium brands continue to flourish and entry SUVs and 125cc plus segments shine the most after GST rate cut. In two-wheelers, TVS Motor and Royal Enfield continue to outperform the industry. In PV, Mahindra and Mahindra continues to outperform the industry, and top picks in PV, it's M&M. Amongst two-wheelers, it's Bajaj Auto for CLSA.
Got it. All right. Thanks a lot for that, Sud. Well, time to slip into a short break. On the other side, Rohit Srivastava, founder of India Charts and Strike Money, will be joining to talk about the market trends. Stay tuned.
All right, welcome back. You know, markets are very much the focal point, the focus area. And we've got yesterday's sharp sell-off to reckon with, right? I mean, this morning, of course, is absolutely flat. Rohit Srivastava is with us. He's founder of India Charts. And Rohit has been calling for lower levels for some time. His view has been that we are in a bit of a bearish phase here. Rohit, good morning. Good that you could join us today. So just lay out the view here. I mean, if you could just address what perhaps potentially could have happened yesterday, because it was a sharp sell-off and it doesn't show up in any numbers in terms of FI, DI, etc. And then, I mean, your view from here in the near term.
So I think it's a mix of things. Good morning, Prashant, and happy to be here. A lot of news flow around what might happen in Iran. I think that may have played to some extent on the minds of people. It's also that it was the weekly expiration. So if there were a lot of long bets, there could have been some unwinding. But people that I have met, a lot of our clients, especially HNIs, I think have been slightly concerned about the market, and it's possible that a lot of individual investors are trying to book gains or create cash, and that could be also a source of selling. So pinpointing it may be difficult, but I think the negative news flow has really not gone away, whether it's been around the AI trade, the tech trade, whether it's around Iran, and also generally that we don't see a lot of strength in US equities. Although we continue to see strength in Asia and emerging markets, they haven't shown any weakness yet. But US equities continue to show some kind of lackluster movement. And so I think all of that is playing into people not being able to hold on to the long side of this trade. So that's where the unwinding is starting from. And it's also been pretty fractured, because when we move from sector to sector, but before I come to that, let me address the market level. So what we are really looking for right now, yesterday the Nifty's closed below the 20-day average. So that's a first sign of near-term weakness. And we'd look at, if we stay below that, we go to test maybe 25,100, which is sort of filling the gap that we had made on the trade deal day. So that is the first thing that's going to happen. But after that, it's going to be looking at the monthly levels. When you consider this entire bull market from 2020, since COVID, even when we had corrections in 2021, 22 around either the Russia war or various other reasons, we did not fall below the 20-month moving average. And even last year, when we've seen corrections in the market, we've sort of not gone below that except for maybe a month and then rebounded from there. So that level comes in at 24718. Okay, so that's an important level to stay above on a monthly basis when we are considering Feb. So we have to maintain this bullish course on a broader basis and say that this is only a correction in a bull market. We would have to hold 24718. If that breaks, then the monthly bands come into focus, and those are way lower. That's almost around 22,750. So are we going to make that plunge, of 1,000, 2,000 points? Will depend a lot on how we close for the month. So that's going to be an important read into how February really does, given that we have around a week, I think, left for the month end. So that's going to be the key level. Bank Nifty, of course, has been the outperformer within all of this, and has managed to push up to a new high. Yesterday we did see it sell off, and my momentum indicator did give a bearish cross, but it's still way above the 20-day average, which is at 60,086. So of course it's not showing the same setup as banking yet, but if it does close below 60,086, then we would open up to downside on Bank Nifty as well, down to maybe around 58,500. So that's the immediate setup as far as Nifty and Bank Nifty are concerned. And it does show that we have near-term weakness, and then the question becomes, how do we trade this on a sector basis?
So just to kind of a lot of numbers here on the Nifty, you're saying immediately is 25,100, right?
That's right.
And what's the what is the level on the upside which negates this view?
So, well, if we go above the recent high that we really made, 26,009, so I'd say around 26,020 is a resistance that we were watching. That would be a level to negate it.
Got it. So 25,100 on a monthly basis, 24,718 is the 20 monthly moving average, which did not break in prior corrections, but that comes into play, and then below that we'll see. I mean, if it comes to that. And Nifty Bank, you're saying, is still above the 20-day, but if the 20-day goes, then you're looking at about 58,500, perhaps, right? It's been the stronger of the two indices, clearly, very, very clearly.
That's
Okay.
right.
So then from viewers who are watching, right, and trading, I mean, you want to be with the trend, right, and not try and do things when the kind of sort of, the bigger trend is, the bigger overlay is against you, then you get whipsawed and capital gets locked and stuck, etc. So what's the advice for viewers watching, Rohit?
Yeah, so there are a couple of things that I've advised people over the last couple of days, and I can go from traders to investors. So let me start with investors first. And one of the strategies that I've been publicly outlaying is that a lot of investors who buy for the long term, they're not comfortable that if you sell a lot of stock now and then how do I buy it back if the market goes up? And secondly, I may have to pay tax. And at the same time, there's a lot of news. What if there's a war? What if the India-US trade deal falls apart because of some Russian imbroglio? For all of that, the ideal way is that you buy a 1-year hedge, and it's still cheap because the India VIX has not gone up substantially. It costs approximately 2% to hedge yourself for the rest of 2026. So we are talking about December 2026 puts for the strike of 25,000. Till yesterday they were below 500. They may have crossed 500, yesterday. But even at that price, it still is around 2% of your portfolio if you buy that. So say, for example, if you have a 1 crore portfolio, 6 lots sort of covers 1 crore. One lot covers around 16 lakhs. So that is the coverage that you get for the entire year. So that's an easy way of really not exiting your portfolio, at the same time having a hedge against any unexpected, unprecedented news flow or knee-jerk reaction that the market might show you. So that's, I think, the simplest solution for investors that I could think of, where they don't really need to panic and get out of the markets, but you have a hedge for the rest of the year because too much news flow that we have to deal with every day. And then when you take this kind of a hedge, you should really not think about exiting it also every day, because immediately people ask me, "Oh, market fell yesterday. Shall we get out of our puts?" Or when the trade deal news happens, should we book it out? And my answer is, you've bought it for the whole year. And when you're paying 2% for the whole year, you shouldn't worry about it, because say the market does rally 2,000 points from here and goes up 10%, maybe your portfolio gains 20%. Your option price might just drop by 1%. I mean, out of 2%, you lose half of it. And that's not a lot to lose against the gain that you would make having a hedge in place for unprecedented news flow. So I think that is the simple answer. So do this for the rest of the year and you would actually become, easy on yourself. You don't have to worry about everyday movement. So that's for long-term investors. Now, for traders, what we do is we have seen that this market is pretty
Just come in.
fractured.
Sorry, Rohit.
Yeah.
Rohit, sorry. You're saying the 25,000 December 2026 put, 25,000 strike. That's what you said?
Yes.
Okay, got that. Go on. For traders, yes.
Yeah. So now for traders, the action would be to stay with the trend, as you mentioned, and which is still on the short side. And the market has been pretty fractured, which means that not all sectors are falling at the same time. You still had banking going up, and you still have stocks like Larsen making a new high. And at the same time, there is weakness in certain segments. So the simple thing I did a couple of weeks ago is I just looked at what is the 1-year performance of stocks and the 1-month performance of stocks and which are the weakest sectors. So the top 3 weakest sectors in the market over the last year have been technology, that's the obvious one, real estate, which may or may not have been obvious to all, and thirdly, FMCG. Now, FMCG is mostly MNC stocks, low floating stocks, so we don't really give trading calls on FMCG stocks, but they've been weak, so we would probably avoid buying them. But the trades, therefore, on the short side, the easiest shorts are essentially in the real estate and technology space. Because those are the weakest segments, and anytime the market falls, you see a lot of selling happening there. So even yesterday, though tech didn't fall much, we saw real estate stocks, fall 2 to 3% during the day. And probably today we are seeing some overnight moves that could affect tech. So that's the easy target till we can start seeing weakness spread to other parts of the market as well. So that's the approach we are taking. Look for even individual stocks when we scan, we look for those which have been weak over 6 months or 12 months and are making lower lows. and look for opportunities to short over there rather than try to catch a top and try to say that PSU banks, for example, are topping out, or PSU stocks are topping out, and try to short them. So that sometimes can be a little more difficult because it may not immediately happen, and there's a stronger segment. So target weakness in a weak market rather than target strength. We are still not seeing a broad-based sell-off in the market, which is why there is still hope that this is just going to be a temporary correction, and maybe it is a sector correction. So that's the hope the market has till it becomes more broad-based selling. And so accordingly, the trader application is that target the weak areas.
Yeah. Useful advice, directional advice, and a top-down view there, Rohit. So we'll leave it there, and we'll sort of continue to come back to you as we navigate these trades in this view as well. Thank you very much, Rohit, for joining us. Really appreciate it. And I think useful advice. I mean, just a frame of mind to think about when you are approaching things and doing things both on the long and short side. Well, I think we want to just get back to the IT space, right? Rima, take it away.
Well, indeed, because EPAM shares declined 17% yesterday. Endava shares were down 4.5%. And these are seen as proxies for mid-cap IT companies, particularly, say, a company like Persistent. Now, what spooked the market? Both came out with numbers. In the case of EPAM, it's their CY26 guidance. They're guiding for a 3 to 6% growth, which is pretty much at the midpoint of similar to what they grew last year, which is 4.9%, which basically means that although there is a big AI opportunity, there is a massive AI boom, it's not yet translating into numbers. So even for CY26, there is no pickup in growth rate. That's what disappointed the street when it came to EPAM. For Endava, the numbers were actually positive. Their guidance improved in this quarter versus 3 months back. But here, what disappointed the street is the fact that the company said that the AI investments impacted their PBT margins to the extent of 300 basis points. 300 basis points on account of the AI investments and the pivot. And that's the reason why the company's PBT margins halved in Q3 versus the prior quarter. CLSA has written a note. They're saying the EPAM correction could potentially imply a negative spillover to Persistent stock price, but they're still very bullish on Persistent, and they recommend investors to add Persistent. But keep your eye out. One, because at least what EPAM says that there is no pickup in growth in this year versus the prior year, despite the AI services opportunity. And two, in the case of Endava, there is an impact that you can see on the profitability on account of the AI investment. So we'll watch for mid-cap IT once again. We will slip into a break on that note. On the other side, we'll connect with the management of Gulf Oil to discuss the data center opportunity. Both TCS and Jio are very bullish in the data center opportunity. They're going gung-ho. Jio's first 120 megawatts will come up in second half of this calendar year. So we'll discuss the impact with Manish Gangwal on Gulf Oil Lubricants. Welcome back. Manish Gangwal, whole-time director, CFO of Gulf Oil Lubricants, is now joining in to talk about the data center opportunity. Thank you very much, Mr. Gangwal, for joining in. While your core business is automotive, you are developing specialty cooling fluids for server thermal management, basically for the data center opportunity. Can you give us a sense purely from data centers? What is the revenue contribution, the volumes today? I guess it's small, but any numbers would help. The margins that you're enjoying and the kind of partnerships you have with servers.
Good morning, Rima, and thanks for having me. First of all, data center and the current AI summit which is going on, I think it's a very nascent sort of industry currently in India. Of course, most of the POCs in this world of liquid cooling has happened in US and Europe. What we have developed as Gulf Oil is that we have now two products in the liquid cooling space for data centers. And one is, of course, a PAO-based synthetic product. Another is a mineral-based product. And we have, of course, tested this for critical material compatibility for the data center components. So we have reached so far up to a stage where we are ready to do a POC with some of the liquid cooling service providers or some data center operators in Indian environment. Because there are not many still data center opportunities with liquid cooling in India. Most of the data centers yet in India are air-cooled. And we are looking for a POC. We have the product ready, two products. And one is a high-end synthetic, another is a mineral-based product. But looking for opportunities to do a POC in Indian environment while the products are ready.
Okay.
But having said that, we believe that it's a growing segment. It is a good to have product for future. But as of now, the opportunity and the size is very, very small and not even meaningful to mention.
Got it. Have you reached out to any of the server makers, Dell, HP, NVIDIA, to test your products? And what is the timeline internally?
So we are approaching them. We actually, lot of things are happening in this space. It's a very nascent space. To find a right partner and do a POC, it's an evolving subject. As of now, we are looking for partners, and we have not yet concluded with anyone in terms of our POC as of now, but ready for it.
But you're in conversations?
Yes, yes.
And do you think you will be able to get the final certification for usage by this calendar year?
Definitely, yes. Because by the time the race to data center starts in India, we should be ready with our POC done and ready with the market fit product. So we are definitely looking for something decisive by the calendar year end.
Okay. For these two particular products that you have developed, what is the opportunity? What is the total addressable market that you see right now, or maybe in the next 2 or 3, 5 years down the line?
See, we have been highlighting this at your channel and in the media that even when all the data centers turn to a liquid cooling, which is unlikely because India, most of it is still air-cooled, and many of the data centers may operate in an air-cooled environment also because that's more cost-effective. But if all the data centers and with a high potential, the way data centers are being talked about to grow in India with all the major IT companies going for it, the total addressable market will still be less than 1% or maybe around 1 to 2% of the total lubricant market size. So it's meaningful from the comms perspective, from the futuristic perspective, but from an actual number perspective, the numbers may not be very, very significant, is what we maintain.
Okay. So you're competing with air-cooled, right? Yours is liquid, and you're comparing your competition for data centers is air-cooled. You said those are cheaper. So what is the case for, using, the specialized liquid cooling systems that you all have?
Because the density will go up, in terms of data processing, the speed and the size so that will require definitely a high-end cooling facility. So many of those high-end data centers, big data centers with the speed of computing going up, they will need liquid cooling. So while there will be certain segment of air-cooled, but all the large formats of data centers and all will convert to liquid cooling at some point.
Just one final question with TCS and Jio, because they're right now front and center of developing data centers now, and they have gigawatt scale ambitions. Will you all in any way partner with them?
we'll definitely discuss with all the potential, opportunities and the people who are, in advanced stage of setting up those. As of now, we have not crystallized anyone, Rima.
Thank you, Mr. Gangwal, for joining in. Helpful conversation just to get the state of affairs right now. We'll slip into a break. On the other side, we'll get to the pre-opening rates. We'll also be joined by Probal Sen of ICICI Securities to put the spotlight on the oil and gas sector after the big rise seen in crude prices. We'll also get in our technical experts, Shrikant Chauhan and Mitesh Thakkar. Welcome back. Pre-opening is suggesting a sharp slide. The Nifty is down 300 points. We'll let the rates settle. But yesterday as well, there was a waterfall decline in the markets. The sentiment turned cautious on the back of geopolitical tensions, and we saw a big sell-off. Where do we go from here? Shrikant Chauhan of Kotak Securities and Mitesh Thakkar Bonanza Portfolio are now with us, gentlemen. We'll let the rates settle, but the mood yesterday was completely risk-off. Mitesh, if there is a bit of a decline to begin trade with, maybe not as sharp as 100 point, it now seems to be settling with a cut of about 0.5%. What's the advice?
In case there's a decline like this, I think we will go down to the levels from where the the trading gap started. On Monday, 2nd of Feb, we had a high of around 25,108. And then we opened with that big massive gap up of about more than 1,000 points. So I think if that level comes, then I think I would be tempted to even attempt longs and cover any kind of short position that I'm carrying. That's a big support for me, 25,100. But before that, I think, there is this minor pivot at about 25,300 level, which could be in play today. But if there's a gap down 25,100, I think the first attempt would be, to take a 60, 70 point kind of a stop loss and maybe attempt a long.
Okay, it's settling in. The cut is now 25 points. Shrikant?
Good morning, everyone. So for Nifty, I am of the view that it has broken important level at 25,500. And below that, the next level to watch out for would be 25,370, 350, where the market has taken support recently. But below that, the chances of hitting 25,000 or maybe 25,100 would turn bright. So broadly, I am of the view that the market is heading for retesting the levels of 25,000, 25,100 in the near term. Ideal strategy should be to look for reducing position or to create some short position if there is any rebound in the near term, because this sell-off was intense. And if we go through with the breadth of the market, then it is like very, very poor. So while looking at the entire structure formation of the market, I am of the view that markets are heading lower.
Okay, markets are heading lower. Cut that. Let's get your stock picks then. Mitesh, you go first.
Imagine I have a mix of buys and sells today. On the buying side is Eicher Motors, if you get it around 40, 50 points lower. So 78.60, 78.50 is my preferred buying zone. Keep a stop below 77.85. Look for targets of 8,025. Dabur is a sell with a stop at 509 for targets of 485. Similarly, a sell on HPCL with a stop at 443 for targets of 415. And HDFC Life is a positive stock. Would recommend longs here with a stop at 723 and a target of 750.
Okay, cut that. Shrikant, what about you?
Good morning, Nigel. I think we can go for buying some metal stocks, because whenever there is a recovery in the market, we see or pullback in the market, we see buying interest in metals. So Tata still looks good at current levels around 205, 204. There we are again expecting stock to move towards 210, 212. Here we can give a stop loss around 203. But trend, there we have a bearish view and we are expecting stock to fall further. It is forming lower top, lower bottom series. So currently around 4,070, it's a short candidate with a target of 3,900 on the downside. And we can keep a stop loss above 4110.
Got it. Thanks a lot, gentlemen, for that. It's going to be a bit of a rocky start to trade. Let's see by the end of today if you're happier than at the start. The rupee as well, the initial rate has come up. It started off closer to around 91. Yesterday, remember, the money market was shut. We had a public holiday. So let's keep an eye out on that front as well. Money market will be in focus. But Rima's hopped across to the ball to tell us about Morgan Stanley. They have written a note on Reliance. Rima, take it away.
Well, Morgan Stanley says that Reliance Industries has pivoted every decade in its 48 years of listed history. And now its vision to invest $110 billion in AI-related energy supply and the digital ecosystems over the next 7 years is the company's next major shift in capital allocation. So Reliance's proposed investments of $110 billion, 10 lakh crore is what they mentioned yesterday, is as large as the telecom and consumer investments that the company made in a period of 2014 to 2021. And Morgan Stanley says that we see the company taking a partnership approach. Now, in terms of scale, right, the investment is massive. As we said, it's on par with what the company spent to build the entire mobile network and retail stores over the last decade. And it's money not just for software. It includes building massive data centers, making their own AI chips, creating renewable energy like solar and wind to run these power-hungry systems in an efficient way, and AI chips as well. As Mr. Mukesh Ambani said yesterday, Reliance will start with 120 megawatt of data center capacity in the second half of this year. Work is already ongoing at the Jamnagar facility. The other big question is, where will such money come from? Now, Reliance Industries generates about $14 to $15 billion in cash every year from its existing businesses. But given the existing investment requirements, Morgan Stanley says that the company might sell off pieces of their other business like telecom fiber network to raise an additional $4 to $5 billion a year. Now, why is Morgan Stanley very excited when it comes to Reliance Industries? They say that this intelligence business will be much more profitable than their older investments, potentially earning double the return. 12% ROCE is what they expect compared to what they made in telecom and retail. And because of this shift, Morgan Stanley has labeled Reliance as a top pick with an overweight rating of 1,803 rupees per share.
Thanks a lot for that, Rima. Well, let's also listen into Mr. Mukesh Ambani, who detailed, their path ahead with regard to AI intelligence and how they're looking at investing in that space. Let's hear him out.
Jio, together with Reliance, will invest 10 lakh crores over the next 7 years, starting this year. This is not speculative investment. It is not for chasing valuation. This is patient, disciplined, nation-building capital designed to create durable economic value and strategic resilience for decades to come. Distinguished participants, the biggest constraint in AI today is not talent or imagination. It is scarcity and high cost of compute. Geointelligence will build India's sovereign compute infrastructure through 3 bold initiatives. 1, gigawatt scale data centers. We already started construction on multi-gigawatt AI-ready data centers at Jamnagar. Over 120 megawatts will come online in the second half of 2026 this year, and a clear path to gigawatt scale compute for training and large-scale inference.
In fact, we spoke to Reliance Industries Chairman and MD, Mr. Mukesh Ambani, earlier this month when he spoke how we can leverage AI to our advantage and the scope of technology to disrupt the industry. Let's hear him out.
A lot of people are asking, is the ambition and the aspiration to disrupt this business just as you did with telecom, Mr. Ambani?
I'm a believer, have been a believer that we have to embrace technology. We cannot run away from it. And AI is real, right? From an India point of view, it is hugely advantageous. If we think about 200 million children in our schools, and if we now think about connectivity to all our schools, and we give ourselves a goal that in 1 decade, right, with a fraction of the total GDP that others spend on education, we can deliver to each of these 200 million kids, including in the remotest village, quality education. Can we in India take care of all our 1.4 billion people with a digital physical health system at a fraction of global costs? Answer is cannot do it without AI. Security, right? Again, critical for our safety for all our 1.4 billion people. If you use AI, right, and complement it with your law enforcement policies, possible to do. Simple taxation, right? We can now have the ability to have for each citizen, each company, the transactional transparency. So your tax paying becomes as simple as when you stay in a hotel and you have an electronic system, you can see all your transactions both ways and there are no disputes. And it becomes a much predictable, enforceable society.
Okay, all right. Well, let's go across to Prabal Sin, energy analyst at ICICI Securities, who joins us. Hi, Prabal. Good morning. Always good to see you in. What do you make of this big mega investment that Reliance Industries is talking about? More than 1 lakh crore is what you're talking about. I think the total is around 10 lakh crore or thereabouts. Their cash flows are very, very solid. They have some capex plans. And now this is the next level of growth, I think so. What do you make of it? The investment, the cash flows, and how does it place them in the way ahead?
So I think it's fairly early days as yet to sort of put numbers around the potential from this segment. Having said that, obviously, in terms of, am I audible? There seems to be some.
You are audible. You are audible. You're going to give us an idea about the current cash flows and how this investment pans out. Please go ahead.
So I think, as per our estimates, operating cash flows can actually, on an annual basis, can aggregate about 1.7 to 1.8 trillion, all inclusive. So obviously, there's a lot of, ammunition that Reliance has to, bring in the kind of.
I'll tell you what, Prabal, we'll come back to you. I think the number that I got was the operating cash flows right now is more than 1.7 lakh crore per annum. So we'll try to reconnect with Prabal and get a better sense on that front. For the time being, let's hop across, I think, to Mitesh. He's here to give us his 9-10 call.
Yeah, I'll go with a buy on Eicher Motors if it opens lower and then see how it goes from there.
I missed the pick. What was it, Mitesh? Eicher Motors.
Eicher Motors, yeah.
And the level you're looking at?
Buy around 78, 60, 50 for targets of around 8,025.
Okay. Buy into the weakness is what Mitesh is talking about. Got that. Mitesh, want to give us your view on Reliance Industries? Someone needs to bat for the Bulls. Could it be Reliance Industries?
See, Reliance, as of now, the only thing going for it is that, that trade deal support is coming up. The stock is also oversold, but no signs of reversal as yet. So I think once the market opens, we'll take a call there.
Okay. All right. Got that. Going back to Prabal. Prabal, Oh, not yet back. All right. Let's take a quick check then on what's moving around. The Nifty is likely to start off with a downtick of close to around 50 points or thereabouts. The PCR, remember, that's at around 0.7 or thereabouts. Intraday, if that number moves down as well, you'll be fancying your chances that you could see a bit of a bounce. However, the geopolitical issue takes center stage. What is Mr. Trump going to do with regard to Iran? He's talking about 10 days of a breathing period. So hopefully that's good news, both for humanity as well as good from an equity market perspective. I think the rupee should come up for you. That weakened a little bit. The start it was indicating was closer to around 91. Yesterday, those markets were shut. But that's not only the rupee. There's been weakness being seen across currencies. And the dollar index overnight as well moved from ballpark 97.2 to around that 98 odd mark. Some of the economic data didn't look as bad or looked a little bit better than what we're estimating. And also the Fed in terms of their action from here on. Probably we won't see as many rate cuts as we expected, say, a month or 45 days ago. Rate cuts could be relatively lower. So I think that's why the dollar index as well has strengthened a little bit. Do we have Prabal back? All right. I think we just brace ourselves for market opening. Yes, Prashant.
Nigel, yeah. No, absolutely. I mean, I think less than 60 seconds to go for market open. So let's now stick with prices and where things land. So it's going to be oil. I mean, I think it's in a way a repeat of yesterday, right? But in different ways. Oil spiked day before yesterday. So yesterday morning, some of the oil-related names starting lower. ONGC was on the gaining side. I mean, if you remember, right to the word go at 9:15. And the other area was IT, which, as we came in yesterday morning, was looking a little better. But of course, we know what happened here. But you've got oil up and software down last night, and we got the start coming up in just a bit. So what do we have? Nifty down about 50. Is it down 50? I think rates will start to appear, 25,410. That's about a 0.25% lower at this point. Nifty Bank is also down to begin this session. And what do we have there? So 0.12, 0.13% down on the Nifty Bank. Mid-cap index is 0.2% lower, and I think the small-cap index is lower as well, about a 0.25% coming through. So, it's a down start. Nifty Bank is blinking red and green. As Rohit pointed out earlier, Rohit Srivastav, that even after yesterday's sell-off, Nifty Bank remains comfortably above the 20-day. So is that the index to do the heavy lifting? I think the Nifty is also coming back into the green. And yeah, I mean, I think it's not bad. You know, the rest of the market, the rest of the screen will come up. The Nifty heat map, how the 50 stocks are opening up. This is, of course, initial rates, but it's not a bad-looking screen. Infi, HCLTech, Wipro, TCS, are all, I mean, those are literally the top 5 losers on the Nifty. On the other side, you've got Power Grid. I was talking about oil stocks, ONGC, NTPC, Titan, Eicher, Nestle, etc., which are starting on the upside. It's more up than down, 32 odd up and the rest lower, and about 22 points to show for it with about a minute gone into market open. Rima.
Looks like we preempted some of the fall yesterday with a sharp decline. So it's opened up flat, but IT is on the back foot. The Nifty IT index is opened with a cut of 1%. And even yesterday, Prashant, by the time we closed up, the Nifty IT index was in the red. So the start was good, but by the close of it, all the gains had evaporated. In terms of the big IT losers, large cap names, Infosys, Wipro, TCS, weak in trade, but mid-cap names like Persistent and Coforge are also taking a knock today. Both those mid-caps are down 1.5%. EPAM's guidance not encouraging, and the street doesn't like the fact that the AI investments are hurting the profitability, like we saw in the case of Endava. So IT continues to be the big drag. Some other names like FirstSource are now down nearly 2.5%. Other than IT, you have weakness coming through in Ultratech Cement, Bajaj Finance, Apollo Hospital. But here the losses are restricted to less than 0.5%, so not very meaningful. On the way up, it's the oil and gas beneficiaries of the ride in crude prices. So ONGC should come up for you on your screen. Oil India, not a part of the Nifty, but let's pull up Oil India. Some of these refining names like MRPL had a good session. Titan sees buying, that's up nearly 1%. Eicher Motors advanced. That is one of the picks that our technical experts was giving us. So Eicher Motors inching up. Power Grid, NTPC, also seeing some buying. Hindalco, SBI on the gainers list with about a 0.5% up move.
Well, that's right, Rima. The index that's struggling today is the tech index. That's down 1.2%. That's post EPAM's numbers overnight, and plenty of the stocks, they did see some kind of a sell-off. However, from the lows of the day of around 31,840, it's seen a bit of a bounce. The recent low of around 31,400 is extremely important. Let's tell you about a few stocks that's moving around. Apollo Pipes, I think that stock had started off well in the green. So that's one of the winners today. A promoter entity coming in there, say they want a bigger chunk of it. I think they bought close to 100% from the overmarket. The street liked it. The stock is up close to around 2%. You have CIE Automotive reacting to its numbers, reacting positively. So that stock as well opens up well in the green. What else? Centum Electronics, stock is up close to 7.5%, but volumes are not very, very large. So you can ignore that move for now unless it comes on larger volumes. On the flip side, Thyroke actually seeing some selling. It's down 5%. Volumes decent. 1.5 lakh shares traded in the first couple of minutes itself. So that stock has seen some selling pressure. Black Box is down close to around 4% as well. NetWeb, a stock that's seen a big run this month as well as this week. That as well has come in for some profit taking, down close to around 4%. And Godfrey Phillips has been smoking hot. It's up more than 15% in this week. However, this morning it's down close to around 4% or thereabouts. Par for the course. Yesterday, it appears the street was factoring in some kind of overnight action, which didn't take place. We'll have to wait by for the next few days, but at least the geopolitical issue continues to be top of mind for the time being. A flattish start. Prashant.
Nigel, thank you very much for that. That's the opening sort of screen and where things are as they open up. So 25,443, it's absolutely flat. Pankaj Murarka is with us, CEO and CIO, Renaissance Investment Managers. Pankaj, good to have you with us here. Thanks very much for joining us. So just your sense of things now, Pankaj. The software thing is one. I don't know if you have a strong view there. That clearly is a negative, right? And there's it's a $250 billion industry, export industry. And of course, I mean, a lot of them are listed here. But that aside, how are markets looking, Pankaj? I mean, people have been saying, well, it's looking better and things will pick up. Credit growth has picked up, that is for sure. Earnings growth will pick up consequently. But, I mean, the price action is not telling you. I mean, the market's not ready to believe. So one's got to pay attention to that as well, right? And look for and search for answers outside of the consensus. I mean, just your thoughts to kick this off, Pankaj.
Prashant, morning. What you're saying is right, Prashant. What we're essentially seeing on a bottom-up basis, we're seeing clear signs of improvement. There's revival in demand in the economy. Credit flow is improving. We're coming out of a period of slow earnings growth. The good thing is the last quarter gone by, earnings have been pretty much in line with expectations. So there are no incremental downgrades in earnings on consensus estimate, which was happening for the last 3 quarters. And we're coming out of a period while this year has been a year of slow or moderate earnings growth, but we're looking to, low double digits, getting back to 12-13% kind of earnings growth for the top 200 companies going into the next year. So clearly there's an improvement in earnings, trajectory of earnings growth. So I think on a bottom-up basis, company-specific basis, things are clearly improving. But what is clearly overplaying on the market is tough macros. I think globally, things are challenging given the fact of whatever is happening. The good thing about India is that from even a macro perspective, India probably is, we had some, I would guess, we've had some macro stress over the last 6 months. Now with the trade deal done, currency stabilizing, hopefully foreign flows should stabilize, and FDI flows, which had just moderated, were flattish for the last 18 months, should start accelerating again. So I think I see clear signs of India's improving macros, and that translating into micros is visible over the next 12 or 18 months. So I think India remains relatively well placed. From a broader market perspective, I think index are fairly priced at about 19 times 1 year forward earnings. So one should still look at, I would say, 12-13% kind of a return from a 1 year perspective, from an index perspective. The good thing about Indian market is if you look at it, last 10 years on a calendar year basis, each calendar year, the markets have given positive returns. So I think that's a reflection of India's macroeconomic stability. So I think in a world which is somewhat challenged on multiple fronts, geopolitical and economic, India is that probably, anchor of economic stability in the world. And index can still give 12-13% returns. Obviously, alpha will be made through stock selection and on bottom-up stock picking. And I think there are ideas out there which is where one has to focus on. So I still think the overall, I were to sum it up, I think the view on the market remains positive, but it's a mood of cautious optimism.
Hi, Pankaj. Good morning. Good to see you in. You're sounding a little bit more optimistic this morning. Good to hear. Pankaj, what about the tech space? Which side of the defense are you on, in terms of it? Do you believe that they're providing an entry opportunity? As this growth wasn't expected to be great out there. As of now, what is the exposure you'll have to tech, and will you look to build onto that?
Morning, Nigel. So clearly we've seen that the sector has been at the receiving end, and the kind of selling we've seen in the sector across, I think, and that's a global phenomena. Globally, software companies, if you look at global software companies, including likes of Oracle and SAP or a Workday or a Salesforce, and as a consequent, what the selling we've seen in Indian IT services companies has been relentless, meaning this is one of the most ferocious selling one would have seen. And now valuations for sector, including global software companies, are at lows that we had seen during 2008 financial crisis. I think the markets are clearly divided. I believe there's a very high degree of optimism amongst equity markets participants globally on AI companies across the semiconductors, hyperscalers, and on the AI side. And there's a very high degree of pessimism where people have started questioning the terminal value or longevity of software companies and IT services companies. I think if you really ask me, I think the reality is somewhere in the middle. So there's a lot of excess optimism I see in AI-driven companies, because I don't think so. I think everyone is overestimating what AI can do in the next 2 years and grossly underestimating what AI can achieve in the next 10 or 15 years. We're at the start of this technology curve. Usually technology curves these are 20-year cycles. And I think software companies are adopting AI in their workflows, and IT services companies have a very pivotal and central role in implementing an adoption of AI in enterprise ecosystem. So I certainly am a firm believer these IT companies are here, and I don't think so they're going away kind of a thing. From our point of view, obviously we have a fair degree of ownership in these companies, and I firmly believe that for a longer term investor, these are very compelling valuations to buy into these companies.
Nikesh Arora yesterday in a conversation said that look at self-driving cars. I saw the first prototype in 2009 and it took 15 years to build truly autonomous cars and build agency there. So, as you said, he called it marketing hype. There is potential, but it takes time and it's not going to replace us just tomorrow. You said you have ownership in IT names. Can you tell us with the appropriate disclosure which stocks you own? And given the fall, would you look to add on?
You're absolutely right, Rima. And even when we talk about self-driving cars, just to add to that context, self-driving cars are on the ground, on the roads, only in 2 cities in America. Because that software which drives FSD, software which drives self-driving car, has to be customized and trained for every city. Every city is a new application for the software. Because every city has its own nuances in terms of traffic rules and curves and so on and so forth. So by the time it reaches Bombay, Delhi, and Bangalore, it will be 2047. So all of this technology, markets have this. That is how stock markets are supposed to behave. Meaning, while markets tend to overestimate things on a short-term basis and probably underestimate over a longer period of time. Amongst our ownership, we own the tier 1 companies, including TCS, Infosys, Tech Mahindra. Because we also believe that AI is a very fundamental and foundational technology which will change the world in a meaningful way. Companies will have to make massive investments in their own business in terms of reskilling, training their workforce, and repurposing them and preparing themselves for the AI-driven world which lies ahead of them. Larger companies with larger balance sheets and larger cash flows have the ability to do that, and they're actually doing it far more, meaning very aggressively. So I think larger companies at this point, whenever these kind of technology shifts happens, it calls for a massive investments in businesses. And in the larger companies have an edge over mid caps or small caps at this point of time because the sheer large cash flows that they have, they can invest into the business far more aggressively, and they are better placed to lead that technology change or drive that change. So that's where our ownerships are.
Yeah. I'll just say this one thing though, right? And I think what Rima referred to, Nikesh Arora, Vishal Sikka made that same point. He said, well, he, I think, referred to Waymo, which is the autonomous driving car, which, of course, is now owned by Alphabet. He said that, well, I think Nikesh was referring to the same company, I'm assuming, that, 20 years later, less than 1% of these cars are now, just less than 1% of cars on the road. So it takes that point is taken, but I'll just say this one thing, and we've heard this. If there is one thing we've heard from, for example, Sam Altman yesterday, Dario of Anthropic and others as well, that the only difference, all this technology, when every technology thing cycle is in a way, in some way similar, but the way this is very different is what both of them emphasized and we'll play those sound bites out, is that the pace of acceleration, because it is now for the first time. AI is building AI, right? So every 2 weeks, the models which are coming out are generations ahead. Now, how fast will that be applied to enterprises and companies? That is the gap. And that perhaps may take time. Absolutely, I take that point. But that, I think, was an important fundamental point. We're talking about 2 weeks, 3 weeks, the next generation coming out, and not like 2 months or 1 year, right? So that pace, I think, is just absolutely tremendous and mind-blowing. Now, in terms of ideas here and how to position yourself, Pankaj, how would you do it from here, given where prices are and the broad spectrum of sectors and how much they've corrected and etc. Go on.
No, just on the previous point, Prashant, you're right. So obviously technology is significantly ahead in terms of what the leapfrog the technology has made, but there's a significant adoption gap where enterprises are not ready for it. So it will take a while. It's a journey. And which is where these IT services companies, I think, have a very central role to take enterprises to where, adopt AI and all of that. On broader markets, so obviously, meaning, financials looks one of those better placed sectors because we're seeing acceleration in credit growth. And probably the worst of margin hit that this sector had to take is now already in the base. From here on, over the next 4 quarters, we'll see margin improvements in financials. And as I said, we are seeing improvement in credit growth. And valuations are very reasonable. One of those sectors where valuations are fairly reasonable. So financials remains a prominent sector in that sense. Apart from that, I think the recovery in consumption is sustaining. We now that the whole GST-driven flush is out, we're still seeing very meaningful recovery in sustaining in consumption. So I think consumers looks to be and given the backdrop of significant stimulus that has been infused into the economy by the government last year, and also this year now we have 4 state elections, and it's become a norm in India for state governments to stimulate the economy or do handouts before the election. So probably that will have its own impact on the economy. So I think consumer is one sector where valuations are more reasonable, and we find growth improving. And also, I would say now we're seeing there was for a period of 3 or 4 quarters, there was a slowdown in industrial economy in India. Now, government making adequate allocations and actually spending that money, we're seeing industrial growth coming back. So the industrial capex or the industrials are also looking, pretty good. So I think those are some of the pockets of the markets which are looking interesting. And I would also say, as a second round impact of whatever investments we are likely to see in setting up of data centers in India, probably we'll see an improvement in growth for power. So utility as a sector, the sector has underperformed in the last 12 months, is also looking interesting because we'll see higher demand for power going ahead.
Okay, thank you very much for joining in, Pankaj. Great chatting with you. Lenskart is a stock which is moving up, 2.5% up on Lenskart. Motilal Oswal today has initiated coverage in the stock. They have a target price of 600 rupees. They say the company has built strong moats in a difficult to scale category, and they expect a revenue CAGR of 25% and EBITDA CAGR of 53% from FY25 to FY28. So Lenskart is seeing some buying. But let's get back to the other big story. Reliance Industries chairman Mukesh Ambani yesterday addressed the AI summit, and he made multiple notable announcements. One, it was an investment of 10 lakh crore rupees that the company will make into AI and AI-related infrastructure over the next 7 years. This will be between Reliance and Reliance Jio. And he also stated that India could not afford to rent intelligence, and the Jio itself will help cut costs dramatically for AI in India. Listen in to his comments.
Jio connected India to the internet era. Jio will now connect India to the intelligence era. We will deliver intelligence to every citizen, every sector of the economy, and every facet of social development and every service of government. Jio will do so with the same reliability, quality, scale, and extreme affordability that transformed connectivity. India cannot afford to rent intelligence. Therefore, we will reduce the cost of intelligence as dramatically as we did the cost of data. Jio, together with Reliance, will invest 10 lakh crores over the next 7 years, starting this year. This is not speculative investment. It is not for chasing valuation. This is patient, disciplined, nation-building capital designed to create durable economic value and strategic resilience for decades to come. Distinguished participants, the biggest constraint in AI today is not talent or imagination. It is scarcity and high cost of compute.
Let's analyze these statements in greater detail. Sanjay Kapoor, entrepreneur, Nitin Soni, Senior Director at Fitch Ratings, is now joining in. Sanjay, the big statement is that we will now reduce the cost of intelligence as dramatically as we reduce the cost of data. And you and I, we've all lived through Jio's disruption in the telecom space, where tariffs came down by more than 95%. How do you read this? Will this, in a way, trigger a price war for AI? Who gets impacted? Your thoughts, Sanjay?
So good morning to you and the viewers. First of all, it's very heartening to see the big boys in India wanting a stake in this play. And if you really see what's going on right now, there's a lot of traction in the data center space from either the reality guys or the energy guys or the connectivity guys. They all want to dive into this space and make the best of it. There is opportunity, and eventually, also we need to keep that about 97% of what happens on data centers today is about CPUs and not GPUs, just about 3%. Will it become 50% in time to come? And will we be globally competitive? What is the role that we play? So just to give you a little bit of feed here, so there's data processing, which is around inferences, and there's data processing, which is around training. Training can be done remotely, right? Inferences generally will require presence in that country or locally. And at least the training, can we become the hub for this part of the world and feed, because US can't take it all. US has an energy crisis right now. And we'll have to solve this equation as well. It is about real estate, it is about energy, it is about power and water, and it is about connectivity. Ultimately, we can solve these equations and build globally competitive data centers and also move towards GPU model in times to come, and not just be a power land sort of a model, and finally become the hub for this part of the world. I think there'll be big traction, and India will be able to play a serious role in the data center infrastructure technology business.
Sanjay, hi, morning. Prashant here. So when we talk about lowering the cost of intelligence, cost of accessing AI, etc., what's the route to do it? Are we talking about lowering inference cost per token? I mean, how does it happen? Because we have, at the end of the day, as you said, it requires GPUs, etc., right? And the point is on chips, we are dependent on NVIDIA and AMD and the likes. We have a model now, Sarvam, but that, of course, also requires GPUs, and the cost is all back-ended in that sense. So how does this happen, the actual operationalization of bringing costs down?
So, like I said, there are 3-4 big components that we have. Can on energy we become cheapest in the world? Maybe we can be competitive, but not the cheapest in the world. Can we become the cheapest in the world on real estate? The problem is that right now the traction amongst the people who've been investors has been around 5-6 major cities, and they have not gone to tier 2, tier 3 cities where probably the price of real estate could come down. But will that be the big difference? Because most parts of the world are going to remote when they're developing, their data centers. Then comes the cost of construction. Now, cost of construction can have a advantage in India, the MEP part, where we could be 20-30% lower than the rest of the world. And also all the big cities now have a crisis on water. Will we go to more water-friendly areas which are remote? And finally, the connectivity, because ultimately these large data centers and processing units will require connectivity. And, while we have a lot of intercity fiber available, I'm not too sure our strength on intracity fibers as much, and we'll have to build it. Also, we are a developing nation. Don't forget, when we were putting in fiber 10 years back, 15 years back, we were putting fiber at the edge of the road. But now the road has become 2 times the size, and therefore the fiber is sitting in the middle of the road, right? And you cannot allow those disruptions when you build such serious data centers. But I think one thing is very clear, that India is not running away from the size required to be competitive. So I think most players, whether it is Adani's or Jio or Airtel, they're all committing to a gig plus, and that's serious commitment. And the good thing about this industry is demand is not an issue, and demand will not be an issue for many more years. And that's a great situation to be in. So I think we have to, on the supply side, become competitive. And you are absolutely right. GPUs are still going to come from overseas. The technology is not getting transferred to us in a hurry.
So Sanjay, for us to be competitive, the issues would be 3-4. 1 is cost of land, unless we move to tier 3 cities where it's cheaper. 2, water, and 3, fiber connectivity. Are these the 3 headwinds for us?
And the power. You need uninterrupted power, which is required. So now in US, for example, they're putting in grids behind these data centers, which are completely private and dedicated to the data centers. Will we finally move there? Of course, we'll move there. I don't see a problem. But to make sure that we have absolutely uninterrupted power supply and good quality power supply is something that we have to catch up with.
Yeah, the tier 3.
One last thing I want to say, ultimately, just keep in mind that everybody finally wants to move to green energy. And the path to green energy for powering these large data centers and GPU data centers is something that we'll also have to put in our roadmap.
Yeah. Now, there's just one quick question, Sanjay. When you said move to tier 3 because land and other factors of production are cheaper, but is the issue also of, like, for example, there are these undersea cables, right? And I think that's coming up to, say, to Visakhapatnam, to Mumbai, and I think that is the reason why you got so much investment on data centers coming in these two locations, right? So that is, I guess, but the cost of land is expensive here. So is that a hindrance to the argument, your point that move to tier 3, etc., or not really?
So we don't have a dearth of landing stations here, and we are a part of all consortiums that bring in undersea cable to the country. So I don't think that will ever be a hindrance, because right from CMEV 1 to CMEV 8, we are there everywhere, and there are multiple routes through which under the sea cables landing here. Landing stations are increasing in the country. I think we can do that. We need to now create redundancies on the connectivity which are far beyond what we've done in the past. Right. And don't forget that ultimately we have to cater to hyperscalers. Hyperscalers will be the anchor tenants to bring in the sort of data that you're wanting. Just going to enterprise customers is not going to fill up those huge data centers that we want to build. So it's a play that you live with the hyperscalers, and hyperscalers will need immense redundancies on how they serve their customers, because it's their complete business model and credibility at stake. So I guess, we have the wherewithal. We have to get there.
Okay. Nitin, what does this all mean for the Jio IPO that's expected in this calendar year? Now the Jio is not just going to be a telecom operator, but an AI infrastructure play, a digital platform. Does it command higher valuations? Do you see the valuations going up? What do you stand at? And we've seen it in the past when Jio brought down the cost of price, they built a capex-driven moat around their business, and many weaker players got weeded out. Do you see something similar happening this time?
Having me on the show. So we do rate reliance on foreign currency at BBB flat and local currency at BBB plus. I can't really comment on the valuation, but what I can tell you is that I think Jio platform as an entity is now moving towards hardware as a service as well. So far they have been investing in creating a backbone of network and infrastructure around wireless and fixed broadband. But as we have seen this announcement of investment of over $100 billion coming to the AI, and we do believe that a large part of that will go to the data center, creation of the data centers, cost of land, construction, power, as Sanjay was explaining. So a large part of that capex outlay will go in building that, and most of the money will be invested in building new data centers, right? And Reliance is already building data centers. I think about 120 megawatts is coming next year, and they do have a joint venture with Brookfield and other partners to build data centers in South India. Then what it means for Jio platform is that Jio will also diversify its sources of revenue and sources of cash flows, not only coming from the wireless or the fixed broadband business, but also more and more the revenue will be coming from the enterprise revenue, from the data center revenue, which in fact is more sticky and recurring in nature, and does have a higher EBITDA margin as well. So yes, I think in the broader sense, the Jio platform as a company will improve its revenue diversification and will improve its stickiness and have a higher cash flow visibility once all these investments start generating cash flows.
Gentlemen, it's a deep topic, but we've unfortunately run out of time. But thank you very much for joining in with your early perspective. This is a topic we'll keep discussing more and more as the days come. We will slip into a very short break. On the other side, the management of Hindalco will be joining in at 9:40 a.m. on their FY27 outlook.
Well, Hindalco is the next management on our radar. The stock is down close to around 15% in 2026 so far. The management had recently declared their numbers as well. For today's session, the stock is holding in the green. But to discuss the past quarter, the way ahead, we're joined by their CMD, Mr. Sanjay Kulshrestha. Hi, Mr. Kulshrestha. Good morning. Always good to see you in some. Before we come to you, just want to highlight the 3 big points that we're going to be looking at. The cost of funds. Will it increase further from here on? The 3% NIM guidance. Is it achievable in FY26? And what about the ROA expansion plans on the back of strong growth? Well, Mr. Kulshrestha, let's get to the first point then. The NIM expectation for quarter 3 was that we'll see a 10 basis points improvement when we spoke last. However, the calculated NIMs actually appear to have declined by around 15 to around 20 basis points. Yields are down also a little bit. Could you tell us what's the guidance for NIMs from here on?
So, thank you and good morning to you and your viewers. If you see regarding the NIMs, our guidance is always the 3% plus, and we will be achieving on the yearly results. We are working towards the improvement, and we are working towards cutting down of the cost of funds. Primarily, the reduction in the NIMs for the 9 month, it's a slight reduction of around 10 basis point. It is primarily due to the disbursement made during the last fortnight of the quarter. At the same time, I would like to add, the company is growing by around 25%. So the loan outstanding is continually growing. We had grown from 1.24 lakh crores to 1.55 lakh crores during the 9 months, which is a growth of around 25%. Once you start growing, in the initial years, you have to keep check on your NIMs or spreads, because this is a very competitive and very challenging ecosystem wherein the Hindalco is working, which is a sector agnostic company. So you have to see that the way we are working, we are taking care of the NIMs, we are reducing our pricing, and I can assure you that at the end of this financial year, we will be as per our guidance of around 3%, on which we had already worked.
Got it. All right. So that's on NIMs. What about on ROAs? I think it's currently at around 1.9. You were talking about moving to around 2.15%. What's the tragedy? What do you end this year with? And where is that number headed?
Again, as per the arithmetic, when you grow by this number of 25%, again, the ROA will come under the pressure. We will be plus 2%. The reason is same. The last fortnight disbursement in the quarter 3. But as you see that we are planning our disbursement on quarter to quarter basis. So we are improving on our bottom line on quarter to quarter basis. So this is the primary reason, but I will not hide about the growth, but I will keep this number plus 2% in the times to come. And I think within a year or two, they will be settling at 2.1, 2.15%, as you have mentioned.
Got it, sir. And what about urban infra, sir? As a percentage of your book, what is it? Where is it headed? That's the better yields, right? You enjoy on urban infra.
So I think this is a very relevant question as a country also. If you see during last month, a lot of drivers had came into the urban development, which is a growth story, and which we are planning that how the global cities has to be planned for Viksit Bharat. Government of India has taken a lot of measures, starting from the budgetary allocations of the financial capital expenditures to the policy making, then creating a partial guarantee fund. In the Finance Commission, 16th Finance Commission, you may have observed the way to 55% of the urban local body grant has been increased, how the incentive for becoming the urban from rural has been started, how the reform parameters are started. Then you have seen the economic survey also. So everything is pointing toward how we will grow in the urban segment. So this is a big market for Hindalco. This is a big responsibility in the challenging times for the Hindalco to sustain its business, to keep the momentum going, and to contribute in the development of our country. So there is a huge responsibility and there is a huge potential in this market to grow. Growth for the Hindalco. So we are well positioned, and with this perspective, we had announced Urban Invest Window, which will become a one-stop solution for the urban local bodies to create a bankable, sustainable, and viable projects. And in this respect, I will like to inform that recently our cabinet has also approved the Urban Challenge Fund, which is a 1 lakh crore subsidy, which will be extended by the Government of India, and 3 lakh crores has to be arranged by 1 lakh will be from the state government side, and For PPP project, it is around 2 lakh crore. It's a big opportunity which is coming. There is a lot of intervention from the legislation, policy, capital. So everybody is working how our Viksit Bharat will come a growth hub kind of cities, and the momentum will come in the development of the ecosystem in the urban segment.
Always good to have you on the show, Mr. Kulshrestha. Wishing you all the best.
Thank you so much.
We catch up soon. Wishing you and the team all the very best. Have a good day ahead.
So much. Thank you so much.
All right, let's turn our attention to the Inox Group. It's in focus as Inox Clean Energy will be acquiring the Wind World's India's IPP as well as the O&M assets. Now, this will be via two different entities. We have a couple of entities that are listed, Inox Green as well, and Inox Wind is the other listed entity as well. To help us out with this, we have Devansh Jain, the Executive Director of the Inox Group, who joins in. Hi, Devansh. Good morning. Always good to see you, Win, and congratulations on this, inorganic growth that you've taken about. Let's ask you a couple of questions first and understand this in better detail. What's the total amount you're paying for Wind World India? And is there some debt that you're taking on? And the obvious question will be, how are you funding it? Please go ahead.
Hi, Nigel. Good morning. Pleasure to be back. Been a while. So basically what we've done is Inox GFL Group through two entities has been the successful bidder for Windworld's IPP assets and O&M businesses through an NCLT approved resolution process. Inox Clean Energy, which is our privately held power generation and solar manufacturing arm, is acquiring 600 megawatts of operational wind IPP assets across 7 states. That is an acquisition which is broadly going to cost us under 2,000 crores. That's going to be a mix of debt and equity. The equity is already in place. The debt has already been tied in. With respect to Inox Green Energy Services, which is the listed arm for O&M services, we are taking over 4.5 gigawatts of wind O&M annuity revenues, which is a very large O&M portfolio consisting of marquee clients across Tata, Greenco, Hindustan Zinc, etc. Now, this is being funded fully through equity. Inox Green had large cash balances, and that's been used to conclude this transaction.
Got it. Okay, all right. So let's focus on the listed entity then, which is the Inox Green Energy Services that you mentioned, which is going to be taking on the 4.5 gigawatt of O&M. Could you tell us, under its fold now, how much would be coming in after this 4.5 gigawatt addition? And what is the target for this entity, Inox Green Energy Services?
So Inox Green, through investments until now, controlled about 13.5 gigawatts of O&M assets. Now that this transaction has been fully culminated, 4.5 gigawatts will move from an investment basis to an actual operational asset on the balance sheet with full revenues and profitably, fully visible, which will accrue and be visible in the full financial year FY27. In fact, in our recently concluded results, we set out a guidance for Inox Green Energy Services to do about 600 crores of EBITDA for the full financial year, where we've also stated that 600 crores of EBITDA will be equal to 600 crores of cash profit.
So just break it down first for the entity that we're talking about, Inox Green Energy. What is the targeted EBITDA that you're going to be looking at for that particular entity? And also if you could help us out with by when do you see this entire deal getting closed out? And if that's the case, FY27 for Inox Green Energy, what could the revenue, what could the EBITDA look like?
Look, broadly, for this whole transaction to culminate, we've now been issued the letter of intent by the Committee of Creditors. As I understand, it should be a broadly 60-day process to get the final approvals from the Honorable NCLT, and then the company simply folds into Inox Green Energy Services. From a FY27 perspective, we believe Inox Green's overall revenue will be close to about 1,300 odd crores, and we expect the EBITDA to be about 600 crores, which is what we've guided for in our recently concluded analyst call post our results. And as I mentioned, 600 crores of EBITDA would be equal to 600 crores of cash profit because Inox Green as an entity has zero interest. Depreciation goes out because we're demerging our substation business from this entity. And there are no taxes because there are brought forward losses from the previous years when the wind sector was undergoing pain. Hence, I mentioned 600 crores of EBITDA for FY27 should be equivalent to almost 600 crores of cash profit for Inox Green Energy Services.
Got it. Okay. All right. So that's about Inox Green. What about for Inox Wind? What kind of guidance are you looking at out there? I think you're given some very adventurous numbers, but you're very optimistic and you're confident about getting there. I was looking through your con call as well. And, if you just want to revise, what do you end this year with in terms of revenue? On that sort of a base, what kind of growth can you look at? And how's the balance sheet looking of Inox Wind?
Look, from an Inox Wind perspective, we've kind of guided for almost 5,000 crores of revenue for FY26. I think, and we've also upped EBITDA guidances to almost 20 to 22%. Broadly, if you look at that really translate to almost 1,100 crores of EBITDA. And from our perspective, I would assume the cash profits would broadly be about 1,000 crores. Cash profit. Cash profit is nothing but net profit plus depreciation plus deferred tax assets. For FY27, we've guided for 75% growth on top of these numbers. And I think that's a very large number when you look at it. But if you look at where we are in this financial year, we would have grown almost 55% compared to the previous financial year. There had been certain delays over this quarter and so over the course of this financial year from certain equipment supply orders which we had, where some of the people, their sites were not ready, some of the evacuation was delayed. But I think we've now got a very, very strongly diversified customer base. We've got almost 15 different customers across 25 different contracts, including a lot of new additions such as Aditya Birla this year, Jackson this year, Amplus, Gentari, Leap, First Energy, Leap Green. So I think we've really made a very, very diversified, strong portfolio and well hedged between 50% being turnkey and almost 50% being plain equipment supply. So I think, 5,000 crores this year itself with almost 1,100 crores of EBITDA is a very large order which we are bang on for. I mean, for the 9 months which have gone by, we've almost done about, if I recall correctly, about 800 crores of EBITDA. So I think they're very strongly positioned for this financial year. And I think for the next financial year, very, very strong growth numbers. And that's backed up by a very, very large order book, new manufacturing plants which have gone live this year.
Okay. Got it. Devansh,
I mean, people could expect more, but I think we're doing a very large, I think we're showing substantial growth.
All right, and you're quite pleased with your performance as well. Just a quick question, since you said the EBITDA number for the first 9 months of Inox Wind is around 800 crores, I think the revenue number is around 3,200 crores. To get to that guidance of 5,000 crores, you have to do around 1,800 crores for Q4. Doable, right?
We've guided for full year numbers, Nigel. I think I'll leave it at that. And I think we're confident of achieving what we've said we will achieve.
Got it. All right, Devansh, always good to have you on the show. Congratulations on this inorganic growth. You're appearing very, very confident. And mathematically, Q4 should be a rather large one, going by your guidance of 5,000 crores on that sort of a basis. Well, you're optimistic about strong growth with good margins. Look forward to chatting up with you soon, and we'll keep tracking these numbers that you've given us.
Well, back in the green now. We were in the green, but now well above 25,500. Defense is the big mover. The defense index is up 1%. Look at data patterns. 9% gain on that. Yesterday also data patterns was higher. Paris Defense 4%, Idea Forge 4%, Garden Reach Shipbuilders 3.5%, Bharat Dynamics advancing 3.5%, and BEL in the frontline pack is surging about 2%. So that's the pocket of strength today. Vinay Rajani of HDFC Securities is now joining in. Vinay, after yesterday's big fall, we're attempting a bit of a rebound. Where do we go from here? What's the trade?
Yeah, good morning and thanks for having me on the show. So yes, definitely a good recovery from the lower level. If you were to look at the average traded price of yesterday's session, it was around 25,550 odd level. So that can act as a strong resistance in the intraday. So this level needs to be tracked closely, 25,550. This is the precise level for the resistance for the Nifty. But yes, I can see some broad-based buying happening in the FNO stocks, and many stocks which were previously doing good are still performing well. So yes, and Nifty has also not breached the previous swing low of 25,372, which is also a positive thing. But we need to keep that level as a support in mind, and 25,370 is the level below that we can see a drag towards the 200 days EMA, which is placed down 25,235. So these are the levels, but yes, recovery is there. There could be a stock specific action in today's trade. So yet, though we saw a weak movement in yesterday's trade, we could see some positive movement in some of the overall primary strong stocks.
Stocks, Vinay?
Yeah. So basically, I can see some strength building in defense space since morning. So Bharat Electronic is looking relatively stronger on the primary chart. So around 444, one can go long. I would suggest a stop loss at 437. On the upside, I'm expecting a short-term target at 460. Second stock can be taken long in the pharma space, which is Biocon. So pharma space has been into a overall uptrend and has been defensive space in last 2-3 sessions. So Biocon around 387 one can go long. 382 should be the stop loss, and on the upside we can expect a target of 397.
Thank you very much for that. Get into a break. On the other side, Manisha Gupta will focus on commodities. Stay tuned.
Fly Emirates, fly better.
Welcome back. Let's talk commodities. The big story is the surge in crude prices, 6-month highs. Manisha is now joining in. Manisha.
Well, thank you so much for that. Our second straight day, and we've seen the gains in crude oil prices just about continue. Well, yes, it has it is trading at a 6-month highs. We've seen 5% of gains for the crude oil prices in this week itself, and it is 15% higher for the year 2026 by now. Well, the markets seem to be believing that there is a geopolitical premium of around $10 to $12 a barrel right now in the crude oil prices. The U.S. president has quite clearly said that 10 to 15 days is a deadline set for the nuclear deal talks with Iran, and post that, there would be some action. There are various reports also suggesting that the action could be as early as this weekend itself. Well, U.S., remember, has deployed the largest military force in West Asia. This is since 2003. That is when the Iraq invasion has happened. So with that kind of activity happening in that area, markets believe that something very soon is going to come there. Also, U.S.-Iran conflict could prompt Iran to restrict the traffic through Strait of Hormuz. Now, this is what the street is really worried about, because this is an area where nearly 13 million barrels per day of crude oil passes, which is almost 31% of all seaborne crude that is traded on Earth. So that is where the concerns really seem to be coming in from. Let me remind you that over the last couple of days, we have seen Iran actually shut partially Strait of Hormuz to do some drills there, and that has the markets very jittery there. And apart from that, it also is Russia and Iran, where they have seen naval drills in the Gulf of Oman. So there are more countries joining in, and that also is leading to concerns there. Apart from what is happening in US and Iran, it also is about US and Israel, which are expected to discuss Iran on 28th of Feb therein. The stalled diplomatic efforts between Ukraine and Russia, something that US was leading, also has not yielded any results. That in turn also is supporting markets. And then you also have very strong data from the US markets coming in, better than street expectations, whether it has been about house sales, industrial production, GDP numbers, all of that has been on the better side. The support also comes in from the fact that the U.S. crude inventories have declined much more than what the street was anticipating, by around 9 million barrels in the previous week there. Sanctioned crude inventories are to the tune of nearly 375 million barrels in the offshore, that is on the waters, is what Goldman Sachs says. So as you see, these inventories offshore continue to gain. That in turn also is supportive for the prices, almost hitting $72 a barrel in the Asian markets right now for the Brent prices there. It is about, these are the three scenarios that the street really seems to be working at this point in time. If the US-Iran talks do not work, if they do work, and if the talks resume meaningfully, then the markets believe that $65 a barrel is what we could be looking at. So an immediate $5 to $8 of a decline is what you could be looking at. But if there is collapse and there is a military action there, then $80 a barrel. And in a time when there is military action and there is an impact on Strait of Hormuz, then markets believe $100 is not going to be a resistance, it is going to be a support. So these are the three scenarios that the street seems to be working with right now in sense of crude oil prices.
10-15 days of peace, or just more uncertainty to know which way this is going to go. Thank you very much, Manisha, for that. Get into a break. On the other side, Lata speaks to our market master, Munish Gunbani, to understand India's underperformance and what may turn the tide.
You want to talk business? Meet me in the Onboard Lounge.
Welcome back. Indian stock indexes have been having a tough time. It was not just a bad 2025. In 2026, February 2nd, 3rd, we seem to find our feet with the announcement of the US-India trade deal. But to look at the performance month to date itself, Indian Sensex and Nifty down about 2%, whereas most other indexes, Kospi up 32%, the Brazilian index, Bovespa, is up almost 14%. In fact, MSCI emerging markets, let's take that index, that's up 7%. So clearly the IT negative wave is having a very bad impact on the Indian stock indexes. Where do we go from here? Is the mood changing? Are we close to bargain buy levels? Joining me now is our market master, Manish Gudwani, head of equities at Bandhan AMC. Manish, good morning. Thank you very much. Difficult morning, difficult times. What is your understanding at your end of the IT stocks? Bargain buys or falling knives?
Well, Lala, I wouldn't be too contrarian here and say they are bargain buys. Obviously, valuations have corrected a lot, but we have to acknowledge that the impact of AI on coding effort is enormous, right? So I do think that when you see global stocks like Accenture, Capgemini, EPAM, they seem to be a bit more cheaper than Indian IT services companies. Second is that when you see the currency, at least till now, I think they've been getting the benefit of rupee depreciation. My personal view is that there's not much left for rupee to suffer. So that benefit also for this sector is kind of dissipating. So overall, you need to be very brave to own this sector at this point of time. I don't think I think it's a bit too early to jump in.
Okay. There were some very convincing arguments made by Nandan Nilekani at the Infosys AI Day and by Chandra in the AI Summit itself. He spoke to CNBC TV 18 as well. They are clearly seeing a business case as integrators of legacy systems so that they make companies, enterprises AI ready. You don't see that as a decent business case?
No, I do. So what has typically happened with this industry is whether it was Y2K or cloud, that logic has worked. But you have to remember 2 or 3 things here. One is that AI impacts coding in a massive way, quite directly. So when you see the negative impact versus what can come positive, it's a bit more trickier than cloud or Y2K or whatever, right? The second is the base of revenues is very, very high, right? We're talking of a lot of the large caps having employee workforces of 2 lakh, 3 lakh, 5 lakh, whatever.
Yeah.
Now, to retrain those kind of workforces is going to be a much, much bigger challenge than, let's say, 10, 15 years back, right?
Yeah.
Third is, as I said, a lot of foreign investors have cheaper choices available globally. So in that context, I do feel that, as I said, a bit too early to jump in.
Okay, fair enough. I'll come to the AI theme again. It's not going away. But at the moment, do you think Indian markets are at bargain buys? I mean, we are piercing through even technical supports. Are you fishing for buys in other areas? Which?
I think India's underperformance to EM or global markets is mostly done. But we've not seen the classical indicators of a global risk off, right? When you see credit spreads globally, when you see volatility globally, from a contrarian indicator perspective, these are very, very benign levels at this point of time. So I do think, as I said, that maybe our underperformance to global markets or to emerging markets is coming to an end. But if there is a global risk off, which may happen either because private credit blows up or oil goes to 90 or whatever, I think that pain, if it happens, is still left.
No, I think on the global markets, we are ignoring the fairly solid growth numbers that are coming from the US. So I'm not one of those who's crying wolf about a chaos around the corner. It doesn't look like that right now. I'm only asking you, what are the bargains? What look like bargains to you? Is it consumption? After all, discretionary consumption. Food did well in the latest earnings round. So what are you picking? And more generally, is it buy time? Is the earnings cycle itself turning?
See, earnings cycle on an aggregate level makes sense only for large caps. And at that, I think will definitely turn because our nominal GDP, I think, has bottomed out. Obviously, corporate earnings have a big correlation to nominal GDP. Inflation is obviously going to go up. Rupee depreciation helps earnings, right, on the net basis. So rupee is depreciated. That will obviously help pharma, IT, refining, metals, whatever. So to that extent, I think FY27 earnings will definitely, to my mind, be better versus FY26. But I think the jack in the box, I think, is Indian manufacturing more than consumption. I would probably think that the potential upside, because if you, as you correctly mentioned, the global economy is actually doing very fine. So when you see the global bellwethers of industrials, which is ArcelorMittal, Caterpillar, BHP, if you see their earnings momentum is fabulous, right? So we are living in a fairly decent capex cycle globally. And let's face it, our biggest export is under threat, which means that I think rupee will underperform yuan by a big margin over the next 3-5 years. And that may actually give the fillip to Indian manufacturing. So I think the space I would probably think has the biggest risk reward at this point of time is Indian manufacturing.
No, actually, that is a very under-discussed issue. You know, we keep saying that we are 6% depreciated versus the dollar. If you compare us to yuan year on year, I think it's like, you know, over a 10% depreciation. For the longest time, I remember we were, 10 rupees, 11 rupees to yuan. Today, it is 13.5 to buy a yuan.
Exactly. And see, obviously, China is the biggest trade surplus in the world. Obviously, this is a world where the geopolitics is about reducing trade imbalances. I think there's going to be enormous pressure on China to rebalance its economy, which means that the yuan will probably appreciate a lot if China has to get its trade deficit down, trade surplus down, sorry. And on the other hand, if at all AI really impacts IT services, which again is a high probability scenario, then India will have to pivot from a policy perspective, from a currency perspective to manufacturing.
No, actually, you know, something subterranean is happening. I don't know if you looked at the January trade numbers very closely. We were all unhappy that goods exports is flat, but machinery exports were up over 20% and electronics exports were flat. So, you know, there is a lot of differentiation happening. Maybe your manufacturing thesis is right. So are you into, I mean, when you say manufacturing, what are your favorite sectors? Is it auto ancillary, cap goods, L&T? What are you looking at?
Yeah, I mean, first of all, I'm more bullish on exporters than domestic, right? I mean, because obviously a TAM will be, the addressable market will be very limited if you are a domestic manufacturer. Now, in terms of exports, I think it starts right from slightly upstream thing like steel to metal forming, to auto ancillaries, to chemicals. It's obviously a vast space. You just need to, but I think capital goods exports is something that looks interesting.
Okay, no, that's very important. Two important themes you're giving us: look for manufacturing and look for exports. They're likely to do better than those servicing domestic sectors. What's the sense about banking itself? I mean, this is not a fear anyone is talking about just yet. But if we are going to see layoffs in IT space and certainly not increasing employment, is this whole retail consumer loans on which the entire banking system sits under threat? If the stock market is a forward-looking creature, then is this a worry at all, or am I just crying wolf?
I think too early to worry, although we should keep our minds open. Obviously, no one really knows how big the impact will be. But if you see real-time data on GCCs, because RBI has monthly trade services data, right? That is quite strong right now. Last few years, we've seen GCCs have done well, irrespective whether IT services is doing well or not. So I'm a bit more optimistic that this theory that IT services slowing down will kill Indian economic growth. I'm not necessarily of the view because, as I said, we live in a world where global growth is good. We live in a world where yuan versus rupee is given a competitive edge to manufacturing. We live in a world where demographics is actually bad. So maybe the productivity of AI combined with the bad demographics will lead to a Goldilocks scenario where global growth is decent, but interest rates can still come down, right? Because if you see US, 1 year back, everyone thought tariffs will lead to a lot of inflation, right? But it's not come through because there seems to be some productivity growth that is flowing through, mainly because of AI. So I don't think we should be very pessimistic looking at the negative effects of AI. We should remember that AI may actually get interest rates down a lot, which will help markets as well.
Yeah, no, I agree with you. I mean, what kind of gains can you reasonably expect, say, from the Nifty in 2026 itself? As you say, the nominal GDP has bottomed out as well. At least the foreign selling appears to have stopped. It is, into a trickle, except for the odd day when there was a 7,000 crore. The selling has stopped.
So, Lada, we've maintained, and I know this may sound like a bit of a diplomatic answer. We think markets, when they're at fair value, we will get 6 to 7% real return, which is above inflation. So if you believe next year inflation is going to be 4-5%, maybe 6 to 7% real return is quite probable to expect.
Okay, that's still better than fixed income, especially when you look at a post-tax scenario. Thank you very much, Manish Gurmani, for joining us and pointing to some much less discussed themes like exports and manufacturing and perhaps a benign global growth scenario. Thank you for pumping up our optimism on that point. We wrap up on Bazaar on that note. Chartbusters coming up.
Well, it's a strong rebound from yesterday's sell-off. A weak start to trade. The market trades at day's high with the Nifty above the 25,500 mark. Banking stocks lead the recovery. IT stocks continue to remain under pressure, but they've recovered a fair bit from the lows.
ABB India reports strong numbers in Q4 calendar year 25, 50% growth in order inflows versus last year, taking its order book to over 10,000 crore rupees. The stock surges over 5%.
Novartis AG will sell 70% stake in Novartis India to Chris Capital for nearly 1,500 crore rupees, valuing the company at around 2,045 crores odd. Chris Capital will also launch an open offer to acquire the remainder of the 26%. The stock is locked up 20% circuit, trading with a market cap of just over 2,000 crores.
PB Fintech perks up in early trade. Kotak Institutional Equity upgrades stock to an adverse is reduced earlier on account of favorable risk reward. Kotak expects growth in premium to sustain at over 40%, well above company's guidance of 33% over the next fiscal year.
Motilal Oswal initiates a buy rating on Lenskart, target price of around 600 rupees a share. They expect the company to deliver 25% compounded EBITDA growth till FY28. The stock is up with a gain of around 3%. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Vinny. Vinny's in green, markets in green. Well, it appears Friday morning has started off on a positive note, Vinny. And I'm sure you're going to have a rocking Friday evening as well. But let's talk about markets for now. Green on the screen. Green, Vinny. Good times.
Good times. Good times in the evening as well, but today good time surely for the market.
Talk about the markets now.
Yeah, days has point for the markets as well. And some of these individual stock names, whether you look at an ABB India, good numbers, a good order book is keeping the stock abuzz. Data patterns, that's buzzing away in trade. Look at Bharat Dynamics. Some of the defense side is doing well. Netweb Technologies, again today, continues to do well in the trading session, holding on to gains of almost 3 to 4%. No complaining on that front as well. Overall, as a sector, PSU Bank is something that's managing to hold on to the gains at the trading session. Good gains for them. Top sectoral gainer. IT a bit muted again, down 0.2%. Realty is the top sectoral loser. So that is what we are watching out for. But a lot of individual names today in focus. Apart from that, in terms of losers, we have Nugent Software. After gaining in the last couple of trading sessions, you know, that AI play and that all the stocks which were AI related were buzzing. Nugent Software was one of them. Today it's down 6% for them as well. So keep an eye out on that. Okay, now we have, India signing the Pax Silica declaration. Remember, the Pax Silica is a US-led coalition launched in December 2025 to secure supply chains for chips, AI, critical minerals. UK, Australia, Israel, Japan, South Korea, Singapore, Netherlands, Qatar, UAE are core members. India now joins this list as well. The alliance is likely to ease India's access to advanced chips for building out data center capacity. Let's go cross. is the signing of the Pax Silica declaration that's come in, and India now is a part of it. You did see the US ambassador also there, as well as Ashwini Vaishnaw, who was also there at the declaration. But yes, that's interesting over there. But we do have the crude space, oil and gas space that's buzzing around in the trade. We've seen crude prices jump up. Prabal Sen, energy analyst at ICICI Securities, is joining us right now. Prabal, good morning. Thank you so much for joining in again. Prabal, your thoughts coming in terms of the increase that we've seen in the crude prices today, that US-Iran tensions, they are continuing. What is it that as a level now we should keep for crude, and what will it mean for our oil and gas OMC companies?
I wish I knew what level to work with at this point of time. I think the fact is that, it's the trifecta, Russia, Venezuela, and now Iran, that is basically, impacting the crude markets. Iran's position in the markets is actually more significant than Venezuela. Venezuela might have had much more reserves on paper. They probably still do. But Iran still produces, after all the sanctions and restrictions that have been there, 3.3 million barrels of oil per day, of which they export about 1.3 to 1.4. They were exporting probably 1.7 million barrels earlier, before a lot more of these sanctions got hit. But they are still apparently, putting out 1.3 to 1.4 million barrels of oil per day. So disruption of these supplies, on the one hand, in the physical markets, obviously creates an issue with respect to supplies. But the more crucial part is that their proximity to the Strait of Hormuz, which is responsible for a quarter of the world's seaborne crude movements, and probably a similar about 20% of global LNG shipments that pass through that critical area. Any action that escalates to disruptions on that strait can actually create very, very material threats to global energy security as such. So the impact of Iran is actually beyond just the numbers that they bring to the table. It's more about the country's importance from a geopolitical and location perspective. Plus, militarily, from what little I understand, they are definitely a much stronger country as far as military strength is concerned, compared to, let's say, Venezuela. So what action could be prompted by US military action is something that we'll have to see, and how it, if it escalates to the neighborhood, and other countries in the Middle East get impacted as well, that can have a much more escalatory impact. So crude will, I think, continue to remain bullish. I think crude prices will continue to remain in a stronger territory. Putting a level on it is impossible at this point, to be honest with you.
Got it. All right. Hi, Prabal. Good to have you on the show. Your estimates currently are factoring in what in terms of Brent crude prices? Your estimates as of now?
So we were actually working with $65 to $70 from a longer term perspective. If you really look at it, supply continues to get even more comfortable. I mean, just the other day, we saw reports that even Argentina's crude production from the Vaca, thanks to the Vaca Muerte shale development, that has also doubled in the last 1 year alone, from about 0.4 to about 0.8 million barrels a day. So there's sources of supply strength actually coming from all across. Geopolitical risk, to price it in at this point of time, crude can actually be 80, 85, or even 90 in the near term. I'm not that I'm saying it will, but as I said, it's very, very difficult to price in that risk into base case estimates. If you look at physical markets, if you look at demand supply, crude should not be, more than the range of $65 to $75. That is our base case estimate as of now. What happens on the geopolitical front, we'll have to keep updating, frankly.
Got it. Hopefully they smoke, smoke at least peace pipe, smoke whatever else they want as well. But hopefully we get some peace on that front. Prabal, the other big talking point is Reliance Industries, focusing on the AI vertical, talking about 10 lakh crore of investments over the next few years. Earlier today, you were helping us out with, the kind of cash flows that they generate. I think it is 1.6, 1.5 to 1.8 lakh crore or thereabouts. But they have ongoing capex. How do you view this investment, and will it put any kind of pressure on the balance sheet? Because they're sitting on fairly decent levels right now.
So I think what I was trying to mention, and apologies, by the way, for the network disruptions in my end in the morning. What I was trying to say was that the annualized capex, if you see over the last 4 to 5 years, has been in the range of around 1.2 to 1.3 trillion rupees. And with the kind of numbers that have been announced at the summit, that number can probably go to maybe 2 trillion plus. So I'm saying that about 1.2 additional coming through from AI, but also some reductions can be expected on the geo front and also on the downstream front as a little bit of that capex cycle actually winds down. Against that, as you rightly mentioned, operating cash flows are in the range of 1.6 to 1.7 trillion. So a little bit of leverage might actually go up. Their net debt has been holding steady at about 1.2 trillion or so, excluding spectrum liabilities and capex creditors for the last several quarters now. So if you were to look at leverage, I think there is probably scope for it to sort of go up. What it obviously does is till these investments are actually monetized. And I think at this point of time, monetization frameworks and revenue models for a lot of these businesses is something. Data centers is it's a clear business where there's a clear revenue stream that is visible. But in terms of AI related applications, building platforms, and a lot of the other stuff, we don't really know what revenue models are there. So till the time that happens, obviously FCF yields and ROEs and ROCs can see a little bit of pressure. But that is something that Reliance does. They make an investment from a 20-year perspective. We as analysts have to be sort of forced to look at a 3 to 5 year perspective. So that mismatch is always going to be there as far as the stock is concerned.
Absolutely, Probal. Probal, just in terms of what are you looking at now in your oil and gas space? OMCs, upstream, downstream, what would be the pecking order? Given the geopolitical tensions, we don't know the uncertainties there. Then what would you watch out for?
So given the geopolitical concerns, very clearly, if crude continues to strengthen, obviously upstream is the one that will benefit. In terms of downstream, it gets a little bit tricky because we don't know what is whether product spreads and product prices will also proportionately show the increase in the way that crude has been behaving. If that happens, then GRMs could also sort of ramp up and offset whatever declines happen on the retail margins fronts. So from a tactical perspective, I believe ONGC and oil will probably continue to do well until the situation stabilizes. I think downstream and even gas names, because remember that most of the gas now is priced at a linkage to Brent or to US Henry Hub, even in the country. Even domestic APM is now at a 10% slope to Brent. So to that extent, I think gas costs for gas consumers will also show an upward trend. So in a rising crude price environment, very difficult to sort of recommend something strongly from a near-term perspective. Structurally speaking, as I said, given where we see crude, given the kind of gas supplies, we continue to remain constructive on OMCs as well as CGD names. So HPCL, BPCL, MGL, IGL, all of these names we continue to prefer. In the near term, it's, ONGC and oil will probably be the only ones that sort of sentimentally go up.
Okay, Probal, thank you so much for joining in and giving us your time, talking to us about Reliance as well as crude and oil and gas space as well. Thank you so much for joining in. But on that note, we're going to slip into a very short break. We will be joined by Manish Hattiramani of Deendayal Investments with Market Technicals on the other side. Stay tuned in.
Welcome back. You're tuned into Chartbusters. The markets have seen a good recovery from the day's low. Not just 25,500, we're above the 25,600 odd mark. I'll tell you what, there were shorts that were added in the system yesterday from the FIs, as well as calls were written. So, you wanted shorts, you have shorts in the system. Let's see whether or not. I think the next point we're looking at is 25,900 because that level was rejected yesterday. Manish Hatiramani joins us from Deen Dayal Investments. Hi, Manish. Morning. Good to see you in. What's the level that you're looking at on the index? And if you can help us out with a couple of stock calls.
Good morning, Nigel. Thank you so much for having me on the show. Well, I think we're quite clearly sideways. The index has resisted around the 25,850 levels yesterday, and that's where we turned from. I'm of the opinion that 25,350 to be precise is an important level to watch out for. This also more or less coincides with the lows that were recorded on 16th of February. If we were to crack this level, we will see another 300 to 400 point drop. Until such time, we are sideways with 25,350 on the downside and 25,850 on the upside. My two stock calls are on the short side. The first one is on Bharti Airtel, which is for a target of 1932, stop loss of 2025. This stock has actually broken two short-term supports on the back of good volumes. Those were 2010 and 1995. A full throttle sell will get activated once we break 1950. The second sell is on Grasim for a target of 2862, stop loss of 2800. 2860 to 2960 was a sideways zone for this stock. We have ticked the lower end also, and now we have broken on the back of good volumes, which is also the lows of 16th of Feb, which has been broken.
Manish, just a quick word. Have you managed to see Brainbee Solutions a first cry on the charts and technicals? We've seen a sharp fall coming in, posted seeing nothing exciting. But today the stock is buzzing in trade. So any change in terms of the technical trends?
No, Vinny, I'm not tracking that stock.
Okay, Manish. Thank you so much, for joining us this morning and giving us your time as well. But now we're going to shift focus to our special segment where we will get you a few ideas for profit from Money Control Pro. We have Kanchi Shah of moneycontrol.com joining us right now to talk to us about the stock that she has been tracking closely. Kanchi, over to you.
So today's stock idea is Bharat Forge, which is a global engineering company that manufactures forged and machine components for automotive, defense, aerospace and industrial sectors. So the core auto business has been going through a rough patch, especially on the export commercial vehicle side. In the third quarter, North America was weak due to destocking and tariff issues. But now the US commercial vehicle seems to be bottoming out, and with tariffs coming down from 25% to around 18% after the India-US trade agreement, the worst seems to be behind. So domestically, commercial vehicle and passenger vehicle demand remains healthy, and the truck replacement cycle and steady passenger vehicle demand should support the growth over the next few quarters in domestic market. So what really changes here, the story, is the structural shift towards defense and aerospace. So these are no longer just optional growth areas, but they are becoming the core earning drivers. So defense order book right now stands at around 11,000 crores, and the company has secured a large CQB carbine order, and the execution of the 88GS program is expected to start in the second half of FY27. Management is guiding for a 30 to 40% defense growth in the next year, and over time, this segment could contribute around 18 to 20% of revenues. So this business offers better margins and more stability compared to the auto. Valuations are rich at over 40 times FY28 earnings. So I would recommend to accumulate this stock in a staggered manner from a long-term perspective.
Thanks a lot for that, Kanchi. Well, time to slip into a short break. Come back. We'll continue to focus on markets. The market's currently at the day's high. Don't go anywhere.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Just take a look at the markets. We're at the day's high, but there are a few stocks that have seen a considerable recovery from the lows. NetWeb, that's the stock we're talking about, was down 4% early morning. That's now up close to around 5%. So that's a 9% swing from the lows of the day. The street is trying to identify potential winners with regard to the AI story, and this could be one of the stocks, I think. So that's the way the street is reading it. This week, the stock is up close to around 18%. So big move is what we're seeing on that name. Another stock is Persistent Systems. The stock was under pressure. EPAM came out with a set of numbers overnight, but I think there were a couple of brokerages that said that they are looking into this weakness to buy into it. And that's why I think the stock has recovered, I think, close to around 2% from the day's low. Vinny, this morning I made this point with regard to the tech index, that last week it made a low of around 31,400. Yesterday it ended lower. And today as well, it started off with a cut of close to around 500 points. It went down to, I think, 31,800. So you pull up the tech index, you'll see what a great recovery actually it's seen from the lows of the day. There are shorts in the system. Till that 31,400 mark holds out, you'll be hoping that, in fact, you do see some more short covering because the shorts are heavily stacked in the system.
Absolutely. That's interesting there, Nigel. But we are moving on to a very big exclusive that we have on CNBC TV 18, straight from the all-important India AI Impact Summit. Shri Vana was in conversation with none other than Sam Altman, top boss of OpenAI. Here are some of the excerpts from the chat. They spoke about India's AI push, the deal with NVIDIA, and a potential listing of OpenAI. Listen in.
This is the fastest growing market for codecs. And it's amazing to see the energy here. Every time I come, it feels like it's gone up another level.
Sam, you've also shared the stage with Pratyush Kumar of Sarvam. The last time you were here, there were questions being asked on whether India can do an LLM. Have you had a look at what Sarvam has been able to put out?
India's, yes, but more generally, India is just building incredible AI, the entire AI stack, from like data centers to models to applications. And I think there's no country in the world quite matches India for total AI energy.
What's the latest as far as the deal with NVIDIA is concerned?
We are building compute as fast as we can. Yes, we'll have more compute over time, for sure.
OpenClaw and the pivot towards more agentic future for you specifically. Are we likely to, A, how do you use that? B, are we likely to see more acqui-hires from you?
So the models are getting good enough. We still have a lot of issues around safety and sort of security to solve with an OpenClaw-like approach, but I think OpenClaw is the most exciting thing to happen in the AI space in quite some time. And this vision of the models getting good enough that you can have a local agent running for you on your computer or a different computer and do all of these amazing things is really quite remarkable.
IPO in 2026? The visibility for that?
Presumably, OpenAI will be a public company someday. In terms of timing, there's like a lot of factors at play, and obviously this is a super dynamic world.
GPT-6?
Presumably that will happen at some point too. I don't have a date to share with you yet.
In the first half of the year?
I don't know when we're going to call something GPT-6, but the model improvement trajectory remains extremely steep. If you look at the progress from 5 to 5.1 to 5.2 to 5.3 in codecs, what I would say is, names aside, you can expect a trajectory like that to continue.
Okay, interesting word coming in there from Sam Altman. But with that, we're going to wind down this edition of Chartbusters, leaving the Nifty just very close to that 25,600 levels. Thank you so much for tuning in. Up next, you have Trading Hour to take you through important market updates.
Hello and welcome to Trading Hour. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I am Reema Tendulkar. With me is Ritu Singh. And Ritu, finally you can see some Friday cheer on the markets after a quiet flat start. It's picked up for the markets, up 0.5%, the Nifty inching towards 25,600. And what's helping is, one, banks. Banks continue to outperform. So this week, while the Nifty has gained about 0.5%, the Nifty Bank has outperformed with a gain of 1.5%. And the IT index, which opened with a loss of 1%, has erased all the losses and now trying to get back into the green. So that is helping. And the advanced decline ratio, though, is now in favor of the gaining side. So that's positive.
Hi, Reema. It is positive above 1.16:1. That's where we stand. So the market breadth very much positive, and the Bank Nifty doing its job. Although the IT index is seeing some pressure today, but interestingly, there are some names like GMDC pulled that up on the back of the Pax Silica signing that just happened. You're seeing names like that perk up in trade. Data Patterns, Tata Invest. You also have Siemens. That's making some smart recovery that we can see. For now, but almost every other index is in the green, barring IT and the Realty and Pharma pack, which still remain a bit of a drag on the markets. ICICI Bank, Reliance, these are some of the heavyweights that are lending their support to the markets in today's trading session, while Infosys, Eternal are some of the stocks on the downside. But Reema, we're focusing on some earnings that continue to come, and ABP India is one of them.
Indeed, and we've got Vinny joining in the studio to talk about the Q4 numbers and the way forward. Vinny.
Hi, yes, so ABP India, the stock is buzzing away in trade. Inline set of numbers that's coming from the company. Order book, that's been good. 4,000 crores approximately is the order inflow in the quarter that has gone by, Q4 calendar year 25 for them. So 4,096 crores to be precise. Order backlog now stands at around 10,471 crores. And the company has highlighted that they have benefited maybe from orders from data centers, automotives, building, infra, rail, as well as the metal segment. So overall, the order inflows has jumped up by 50% on a year-on-year basis. Apart from that, this time in terms of revenues, that has seen a growth of around 5%, in line with what we were expecting. Margins have come in at 15% versus 19% in the same period last year. But if you exclude the labor code impact of around 66 crores that's come in this time, then the EBITDA margins would see a better jump, that is 17%. Overall, even in terms of flows, order inflows, they've been much better than what we've seen in the last few quarters. Overall, in the first half maybe of this calendar year, the company had seen a bit of a tepid performance. Now we're seeing a bit of an improvement that has come in for the company. Do not forget, in terms of the numbers that came in from ABB Global, we had an indication in terms of the order book or where it would stand at or the jump that we would see. And that time also in January, the stock had seen a jump up. And in the last 1 month, the stock has gone up more than 20%. Today, after the numbers, also a good run-up is coming in for the stock. The trajectory of the company going forward is the key. But as of now, good numbers across all segments, they managed to do well. And that is keeping the stock abuzz.
All right, Winnie, thanks very much for taking us through that. The other, sort of stock that is in focus is PB Fintech. Now, that surged by almost 3% as we speak because of an upgrade that's come in from Kotak Institutional Equities. Sudarshan has been, looking at the details of that note coming in from Kotak and joins in now. Sudarshan.
So in the recent past, the stock of PB Fintech or say Policy Bazaar has been underperforming across the sectors. And the reason is the concerns that company faces is the regulatory concern, and IRDAI may come out with a consultation paper related to commissions, and that's one of the reasons why the stock has been underperforming. Now today, Kotak Institutional Equities has come out with a note upgrading the stock to add from reduce. It's a double upgrade and maintaining the target price of around rupees 1,725 per share. Now, what it's saying the risk reward after the recent underperformance has turned favorable. And second, the concerns that company faces from commission draft paper that IRDAI may come out, that may be offset by the tailwinds that company has from the term and health insurance premium that has been seeing the healthy growth. In Q, the calculated commissions rate was healthy at 21 to 22% in the last 4 quarters. Premium growth in Q3 was up 45% versus 35 to 39% in the last 3 quarters, and 70% growth was seen in term and health premium, which comprises almost half of the PB Fintech or say Policy Bazaar's business. Now, Kotak Institutional Equities does not expect Q3 momentum to continue, but it may remain over. Premium growth may remain over 40% until FY27 and 33% in FY28 versus company's medium-term growth of 30%. So, Kotak Institutional Equities believes that the growth that they are expecting in the premium, especially on term and health, and the tailwinds that the company is going to get from this may offset the concerns from the commission charges.
Thank you very much for that. Innocent Bank also is reacting to a brokerage note coming through from MK. What does it say, Ritu?
Well, you know, MK has upgraded Innocent Bank to buy from a reduced call and also raised the target price by almost 38% to 1,100 rupees. And this is on the back of what they call reinforced confidence in the new management's push on fixing some of the structural gaps in the bank, whether that is reorienting the asset liability mix, strengthening the governance controls, and also rebuilding leadership. Now, MK believes that this is going to set the stage for a sustained turnaround for the bank. Remember, they've just turned profitable after reporting a loss in the second quarter, and the management has guided for in-line credit growth for this time around and an exit ROA of about 1% for FY27. Now, MK believes that the ROA will further improve to about 1.3 to 1.5% by FY28-29 from the low of 0.1% that we're going to see in this current fiscal because of the growth, asset quality, recovery gains, all of that add further traction and drive a stock re-rating. Beyond this, MK says that there could be a reorientation of the asset liability mix towards consumer retail, and that is also going to help the bank deliver a healthy, sustained risk-adjusted return on capital. MK also says that the improving sectoral tailwinds and the favorable sentiment towards large private banks should further aid in Innocent Bank's re-rating, similar to what we saw with Federal Bank. And it also adds that for any further re-rating, it'll be dependent on sustained execution of the management strategy and no surprises on the asset quality or regulatory front.
All right, we'll slip into a break on that note. On the other side, we'll discuss bond markets with Manisha Gupta. Stay tuned.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome to Bond Street. Joining us on the show today is Vijay Chandok. He's MD and CEO at NSDL. Mr. Chandok, hi, thank you so much for joining in.
Thank you.
And the way the markets seem to be performing right now, what would you say is the driving factor for increasing retail participation into the debt market? In the last couple of years, the numbers have been quite strong. And there is this certain push now, starting right from Niti Aayog report to budget mentioning debt market. And then, of course, SEBI's also done an outreach program. Would you say the time is right or ripe?
Thank you. Thank you very much for having me on this show. Indeed, I think I've been in this industry for a long, long time. And we've been talking about the importance and the depth that is required in the bond market. I think finally, thanks to all the efforts that you just mentioned coming together, all together, I think over the period of last few years, that bond markets are indeed increasing. But to my mind, I think that the real compelling regulation that our regulator SEBI brought out, I think, which has really propelled the bond market forward, is the OBPP regulations.
Sure.
Coming out with, having come out with those OBPP regulations, we are seeing a proliferation of OBPP platform providers. So we have more than 40 of them in the country now, and we have partnered with many of them at NSDL. We've provided them digital experiences so that the entire process of onboarding is made available in a much more simplified and a convenient way. In addition to that, one of the other challenges that we've addressed, which is important for the retail investor, is information. So through our portal, NSDL Bond India Bond Info, we provide a plethora of information about bonds, which really helps a retail investor to understand the risks and then take an informed decision. We also power the trade repository. The depositories power that. And through that trade repository, there is a plethora of, again, information pertaining to the yield, pricing, the quantum sold, so that this kind of information is also available, which is important for decision making. In addition to that, we have also introduced things like demat account validation, an online real-time service, which enables that the platform which is providing the sale or purchase of the bond is able to immediately access on a real-time basis the investor's demat account, confirm it, and so that the transactions could be put through. So I think a lot of facilitation, paperlessness, digitalization, information flow, I think all that has happened in the recent time. That's really propelling the retail participation to bigger heights. So a lot of effort has gone.
Oh, yeah, I can see that. You've been counting that. OBPs, 40 of them right now. With the kind of market that there is right now and the way it's opening and the kind of push that it has, do you see this number going higher?
Indeed. In fact, a few months back, it was 40. It's actually crossed 42 now. So, yeah, I mean, we've seen growth. We have seen not just growth of OBPPs, but I think their numbers are also now starting to increase. The amount of demat accounts, etc., that they open on a monthly run rate basis, I think that is also showing a healthier trend.
What is NSDL doing really in this regard when it comes to enhancing liquidity, or the fact that the way we have distribution models for mutual funds and insurances, which is quite easier, do you see that being replicated when it comes to bonds?
Yeah, I think what really has helped the mutual fund industry increase their distribution network are fundamentally 3 or 4 aspects. I think one is the digital experience, which has made things easy, paperless, and simple to operate. The second is the advisory network, which has come and brought the understanding of this to the retail investor. So these factors have really and the smaller ticket size. I think combination of these factors has really helped the mutual fund industry. We are beginning to see some components of this coming into the bond market as well. Recently, SEBI has brought down the minimum investment from 1 lakh rupees to 10,000 rupees. I think that's a very positive step. There has also been growth of or involvement, I would say, of the advisors into this particular category of investment. So in addition to different other instruments, they're also talking about bonds as an important source of diversification. And the entire regulatory environment, interest rate environment is also conducive. So these factors, the information availability is also growing. So these factors which has helped mutual fund industry, we are seeing similar factors taking seed here. So I suppose that's already starting to show some benefits. And as this network and ecosystem matures a little more, I think more growth should be expected going forward.
Mr. Chandok, when you look at the kind of money that India raises from its debt market vis-a-vis bank is still very small in percentage. It is also very small in percentage when you compare it to other various developed countries or developing countries. What is it that you think India would need to do to push those 2 to 3 points to ensure that these markets start coming to the debt market in some more bigger way?
Yeah. So, you need the whole ecosystem to respond to an issuer. That's what helps the market grow. I just mentioned some of the components which have been laid out. So let me try and explain this with some numbers. 2 years back, we saw the total issuances of about 9 lakh crore. This has now gone up to next year it went to 10. This year it's likely to be 11. So we are gradually seeing that as the ecosystem which supports bond markets is coming together, 9, 10, 11, that lakh crore. So that's the kind of growth we are seeing. I think more information will certainly help, because the terminologies associated with bonds is not so straightforward, for a retail investor. So that has to be demystified, explained to him. He needs to understand risks. He needs to understand the kind of impact interest rate movements can have on it, and so on and so forth. So these are not so straightforward concepts for him to grasp. So explanation is important. So as that maturity comes, understanding comes, information flow happens, I'm quite hopeful that that's going to also lead to some growth in the markets.
CNBC TV 18 and India Bonds presents Bond Street.
Welcome back. There was a recovery about 1 hour back in the markets, but now we're stalling around the 25,600 mark on the way up, facing a bit of resistance, and markets have gone sideways, holding up in the green with a gain of about 0.4%. But you can see in the last half an hour or so, we've not managed to accrue any gains. Defense is a pack which is doing pretty well. The Nifty Defense Index is the top sectoral gainer, and in that, data patterns leading right from the front, 6.5%. You've got Paris Defense, Hindustan Aeronautics, BEL, BEML. That screen is buzzing and alive. But let's invite Ajit Mishra on the show now from Religare Broking. Ajit, thank you very much for joining in. Good rebound after yesterday's sharp sell-off. Do you see upward momentum? What's the trade?
Yeah, hi, good morning. So yes, it's been almost like 2 weeks that we are seeing this roller coaster ride continuing in the index. Means 25,400 on the downside and 26,000 on the higher side. So that's the range basically broadly that we are trading in. Yesterday we have seen after almost 3 days of advance, market retraced all the gains and we have retested the lower band, and again we are seeing a rebound attempt. So are we going to sustain those gains? It seems difficult considering that only banking is holding strong while the other sectors are not moving in tandem. So it's going to be more of a consolidation trend continuing in the index. So rather focusing on the index, the prudent approach is to focus more on banking index when it comes to the positioning on the index side, or stock specific approach. So basis that, the PSU banks looks comparatively stronger, and Canara Bank after this marginal consolidation is offering a fresh buying opportunity. So here you can go for long positions with 148 as a stop loss and 160 as a target. At the same time, since the tone is still consolidation, we are still getting opportunities on the short side also. So Dixon, after this recent consolidation or marginal uptick, we are again seeing the selling pressure emerging at the higher end, and in fact, it's a fresh breakdown from the consolidation range as well. So this may result in a gap that we have on the daily chart around 10,500 to be filled. So with that as a target, one can go short in Dixon even at current levels with 11,350 as a stop loss.
Okay, Ajit, so Dixon and Canara are the two names you gave us. Any play on, the AI trade, some of the names that have been gaining, and also this Pac Silica alliance that has been signed, GMDC, Nalco, and LC. Any opportunities there? Anything on your radar?
The GMDC definitely looks promising. Means it's been almost 2-3 months that the stock has been consolidating around its record highs. But every time we see that dip, it's largely maintaining its lower high, lower low structure. So this gives us confidence that eventually we might see a breakout above 620, 640 mark. So here, in fact, at current levels also, one can look for accumulation, considering that we have multiple supports around 540 levels. So here, definitely, you can go long with 640, 660 as a position target. At the same time, IT stocks, I still feel they're vulnerable for short-term volatility. And, for a time being now, if the view is short-term, one should refrain from any aggressive bets.
Thank you very much for joining in, Ajit. Get into a break. On the other side, we'll discuss market fundamentals. Nikunj Doshi, Managing Partner, CIO, PMS from Bay Capital Investment Advisors, joins in next.
Fly Emirates, fly better.
Welcome back. You have the frontline index now crossing 25,600 as we speak, just a few points below the day's high. That's where you have it. The bank Nifty again, trading with gains of almost 0.7%. Although, the advanced decline ratio, those crisscross lines converging a little, as we speak. But we'll see how it goes from here. But for now, the Nifty is above 25,600 as we speak. Let's bring in Nikunj Joshi, who's managing partner and CIO PMS from Bay Capital Investment Advisors, who's joining us now to discuss market fundamentals and his top sectoral picks. Nikunj, we're trading, a pretty volatile global environment. The trade deal is behind. The FII flows seems to be trickling back in, but now there's this US-Iran tensions that are lingering, on the markets domestically. Earnings, we've seen some, strong shows by some of the big names. How are you placed here in terms of risk reward? Where do you see, for the Indian markets in the near to medium term?
Thanks for the opportunity. And just a correction, my name is Nikunj Doshi and not Joshi. I think you mentioned Joshi. Just on the markets, I think overall the earnings season has been good. Most of the companies reported good numbers. So top line growth has been good. There was some pressure on EBITDA because of the one-time labor cost which most companies incurred. So overall, I think earnings-wise, we are seeing good positive trend going ahead. There's a capex picking up. And overall, we are seeing good trend in the earnings for FY27. As far as global flows are concerned, again, it's more dependent on geopolitical developments rather than anything else. And there, again, it's a fluid situation. So we can't take call on the global flows as of now. But if things stabilize, then we definitely see good flows coming into the Indian markets. And overall, we are very, very positive for calendar year 26 for Indian markets.
Nikunj, in that case, what are the sectors where you're more bullish? You see a strong bottom-up fundamental, and what are the sectors where you would trim your position?
So, we are focused mainly on four themes in the market. So one is digitalization, second is consumerism, third is financialization, and fourth is outsourcing. And in all these areas, we have been focusing not for last 6 months, but last 10 years, I would say. We have been focusing on most of these themes. And I think most of these themes have played out. What we don't invest in is commodities because we can't predict commodities prices. We don't invest in real estate, infrastructure, which are capital intensive businesses. So as an investment philosophy, we focus mainly on capital light, asset light businesses with a good kind of earnings momentum possibility and leverage in earnings also.
Nikunj, hi, Rima here. I remember in the last conversation you said you're not very focused on traditional IT services.
Yeah.
You're more bullish on companies benefiting from AI adoption, where AI productivity gains will drive earnings for AI adopters. Something on those lines is what you had shared. Can you share some names of companies which would be big beneficiaries where we will see AI productivity benefits flow through?
So I think most of the manufacturing companies, see, like right now, what we are talking of IT services and IT related companies, but what we see main benefit coming is for the manufacturing companies using AI. So definitely these are the capital, I would say engineering companies or the manufacturing companies, which are likely to benefit most from this AI adoption in terms of their operations and in terms of their productivity enhancement. So I think these are the sectors which are likely to benefit. For the IT as a space, I think any like development comes with opportunity as well as threats. And right now the market sentiment is such that it magnifies threats first. So for IT services, right now everybody is looking at what are threats possible and ignoring the opportunities. Whereas in digital companies, digital first companies, we see that there's a lot of potential of productivity gains and efficiency gains. So take example like Ixigo, which is using AI in most productive way, or even car trade also means everybody is now concerned about what will happen with car trade as a business model. But I think they are using AI rather to support their operations than being threatened by the AI development. So I think these are the digital first companies which are likely to be mainly being beneficiaries of AI adoption.
Sorry, so Ixigo and Cartrade, are these stocks that you're recommending to your clients on the back of the same theme, AI beneficiaries?
As a disclaimer, means it's part of our portfolio investments. Both these stocks are part of our portfolio investments.
Okay, Nikunj, on the financial space, we've seen a massive rally in the PSU names. I mean, take the likes of SBI, stellar third quarter numbers in the last 6 months alone. It's up 40-45%. Some of the Bank of Baroda and other names also, Union Bank, are up, anywhere in the range of double digit or more. Do you see a further rally from here for these PSU names? Because some of the foreign flows also seem to be adjusting away from their private peers, where the gap is narrowing into these PSUs. But do you see a headroom for further upside from here on, or what would trigger a re-rating?
So I think for banks, what most people look at is, I would say, growth in earnings, means NIM growth. And second is definitely their CASA ratios and other parameters which people look at. And PSUs, I think, are better placed in terms of CASA because of the client base that they have, as well as in terms of when the economy picks up and when capex cycle is triggered. These are the banks which have wider network to capitalize on that. So I think PSUs are benefiting from those kind of developments happening right now.
Yeah, I mean, they are showing an improved earning visibility, better ratios than some of their private peers. But Nikunj, any thoughts on the NBFC space as well? Any key themes, trends you're seeing there? Any buying opportunities?
NBFCs are likely to mainly benefit from the cost advantage, means the reduction in their cost of liabilities. So I think that is going to percolate over next 6 to 9 months, I would say. And that's where their cost of borrowing will reduce and they'll be able to improve on their margins. And growth-wise, I don't see any issues with NBFCs in terms of the asset growth. And quality issue also, I think for most of the NBFCs is behind. And most of them have provided for the poor asset quality credits. So I think overall, NBFCs are also better placed in the whole financial system.
Quick word, you said you also like manufacturing and they could be beneficiaries of the AI productivity benefit. So digital first companies you spoke about, any in the pure play manufacturing side?
So again, engineering companies, I would say, means capital goods companies, I would say, are the better placed to take advantage of A, capex cycle picking up, and B, productivity gains and operating leverage, what they will have going forward. So all means any engineering or capital goods companies, I would say, are beneficiaries.
Thank you, Nikunj. Great chatting with you for joining in. By the way, the Nifty's hit that 25,600 mark, now trying to cross it. Bajaj Finance, Bharti Airtel, L&T. These are some stocks where you are seeing an up move in the last 10 minutes. Get into a break. We'll come back with more on the markets.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back, and here's a CNBC TV 18 mega exclusive from the AI Impact Summit in New Delhi. Anthropic CEO Dario Amodei says that we are not trying to replace existing industries or sell-off across software and the IT companies. Take a look at that and all the other comments he had to make.
The Indian IT services companies have taken a large knock, really on account of what Anthropic is doing with Claude. Now, are you a bad dream or a nightmare for the IT services companies?
We certainly don't want to be. I mean, the stock market can move for all sorts of reasons, but, I think our intent is that if companies work together with us in like a positive way, they can gain a lot and we can gain a lot as well, right? We're not trying to like replace replace existing industries. Like,
but can you?
Hope,
you're not trying to, but can you?
I mean, again, there's different ways things can go. And our hope is that we can work with these companies. We build models, we build products on top of those models, but also companies can further build on top of those products. They can distribute those products. They can, I think of it as Lego building blocks, right?
Mm-hmm.
Like, we're not saying like, okay, we put together a few Lego blocks and that replaces everything. We're saying, okay, here are a few Lego blocks and you can continue to build. You can continue to extend on them.
How much do you believe that we're likely to see an elimination? How much of it is going to be displacement? And how much of AI washing are we really seeing when we talk about job losses today?
Yeah, so, I think it's really hard to predict. The economy and economics is hard to predict. So it's hard to say, will jobs go away or will they be downskilled or will they be moved in kind of a different direction? So the exact form that it takes, I don't know. What I do know is there will be potentially a lot of disruption because the technology is moving so fast. What is different about AI than previous technologies, it's not any different in that, there's some things humans could do before that, this new technology is now able to do, that's able to replace parts of it or all of it. What's different is it's moving quickly and it's broad because AI is a general technology. And so what we need to do, I think, more so than trying to figure out exactly what form the disruption will take, is help people to adapt. I will give an example. I can see the day when, even within, say, Anthropic, we need less software engineers than we have today, because the models are better at automating software engineering end to end. But we've been thinking hard about, what are jobs that those people could do? And, one thing is, there's this notion of the forward deployed engineer.
Yeah.
Someone who has technical skills, but who works with customers to enable technical systems and technical solutions with those customers. And as Anthropic grows and has more customers, there's going to be a need for a lot of them because the number of customers we need to talk to is large. And so that's one possible example where one thing goes away, but another door opens to take its place. And, I can't guarantee that more jobs will be created than are destroyed. We have to make that true. We have to figure out how to make that true, and it's going to be a challenge. But the earlier we see it, the more we're honest about it, the better the chance we can address it.
The possibility of Anthropic being blacklisted by the Pentagon, have you been in conversation with the authorities there? Is there an update on that you can share with us?
So we've worked, we've been deploying our models for U.S. national security for quite a while, and I think our basic position on it is we've offered the models in kind of a very wide range of for a very wide range of use cases, and I think the main areas of concern that we have are fully autonomous weapons where there isn't a human in the loop, and domestic mass surveillance of Americans. So those are the two areas where we have some concern, and we want to make sure the models are not used in that way. And we continue to have productive discussions about how to use our models for almost every use case. But while taking into account, I think these red lines are fairly important for making sure that AI is used in a way that's compatible with democracy and in line with the culture of our company. We're just attempting to make sure that we deploy our technology in a way that's compatible with and advances democratic values. The whole point is to defend democracy, and we continue to have productive discussions around this, and we're very excited to help national security of the United States and other democracies.
What an interesting conversation there, and it's all about AI, data centers, and where we're headed in terms of intelligence. I just want to quickly talk about Reliance Industries. That's up 1%. And this is the Morgan Stanley note. They say that Reliance Industries has pivoted every decade in its 48 years of listed history. And now they plan to invest 10 lakh crore rupees. That's $110 billion in AI, energy-related supply, and the entire digital ecosystem over the next 7 years. And this marks the next shift in their capital allocation. And Morgan says that their proposed investments, that's 10 lakh crore rupee, is as large as their telecom and consumer investments through 2014 to 2021. Morgan Stanley says that they see the company taking a partnership approach because the scale is massive. As I said, it's on par with what the company spent to build the entire mobile network and the retail stores over the last decade. And the money will not be just for software. It will include building massive data centers, making their own AI chips, creating renewable energy, to run those power-hungry systems, and spending on AI chips. As Mukesh Ambani said yesterday, Reliance Industries will begin with a 120 megawatt of capacity in the second half of this year. Work is already ongoing in Jamnagar. The other big question is on where will the capital come from this big investment? Will it suppress the free cash flows and the ratios? Now, Morgan argues that the company generates about $14 to $15 billion in cash every year from the existing businesses. But given its existing investment requirement, they believe the company will need to sell off parts of their other businesses like telecom fiber network to raise an extra $4 to $5 billion a year. Why is Morgan Stanley excited on Reliance Industries? Because they believe the intelligence business will be more profitable than their older investments, potentially earning double the return. That's 12% ROCE, which is why they have an outperform rating, target price, top pick, and a target price of 1803. Get into a break. We'll come back with more in the markets.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Let's get you a quick check of the macro signals from the day. The markets, by the way, the Nifty is just below the 25,600 mark as we speak. It's been a bit of a volatile day, but, still up about 130 points. Bank Nifty, though, that's outperforming the markets. It's up about 0.7%, while the broader markets as well, for the mid-cap, it's up about 0.4%, and the small cap also in the green as we speak. Now, the benchmark 10-year government bond yield, that's trading around 6.7% today, and it's higher by 3 basis points. Remember, the bond markets were closed yesterday. Today, again, the yields are higher despite that recent debt switch operation we saw from the government, because traders believe the further measures to cool these yields from here are unlikely and rare. Now, the rupee, that opened weaker today on the back of a stronger dollar. The dollar itself has been gaining strength because of the good U.S. economic data that we got, including a drop in the jobless claims as well. Now you have the rupee trading about 90.3 to the dollar. That's where it's at. But, these escalating geopolitical tensions that's been affecting the markets between the US and Iran, they've also driven investors towards the safe haven assets like the dollar, while also at the same time pushing the global crude prices to a near 6 to 7 month high. Oil prices up 5% this week, 15% this year so far, and you have the Brent crude now above $72 to the barrel mark, and that's tracking the rising tensions between the US and Iran. That's feeding back into this prices. The NYMEX also at 66.83 as we speak. So that's the macro setup as we bid goodbye on trading hour.
Well, thank you very much for watching. Don't go anywhere. On the other side is Halftime Report.
Stocks recover some ground after Thursday's brutal sell-off. Industrials, power, metals notched gains, while IT, realty are the drags.
Novartis India leaps after its parent inks an agreement with Chris Capital to sell its 70.7% stake for 1,446 crores. Chris Capital also make an open offer to minority shareholders at 860.64 rupees per share for 26% equity.
India can play a serious role in data centers and become a hub for hyperscalers, says former Bharti Airtel CEO Sanjay Kapoor, which is Nitin Soni says that it will help Jio diversify revenues and improve margins and cash flows.
Palo Alto Network CEO dismisses talk of AI replacing CEOs as marketing hype. He argues it took autonomous cars 15 years to get to where they are today. He adds that replacing complex human tasks with AI will take time and the transition period will be crucial.
India joins US's flagship effort on AI and supply chain security. Pax Silica Minister of IT Ashwini Vaishnav says the alliance will make India part of the semiconductor supply chain, harnessing its pool of 1 million engineers.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it is turning out to be a session where we are seeing a little bit of a pullback after what we saw in yesterday's trading session. So currently we have the Nifty just about at around 25,600 as we speak, so up around 0.5%, and an advanced decline ratio which is in positive terrain. So currently the advanced declines stand at around a ratio of around close to or a little more than 1:1 at this point in time. But let's see whether that crisscross takes place on the declining side. As of now, it's a little precarious. But overall, the markets have shrugged off concerns with regards to Iran as well as Brent crude, which is at multi-month highs at this point in time. Week to date, the Nifty is up around 0.5%, whereas the mid caps are absolutely flat. So that seems to be the trend which is playing out for this week, a marginal move on the upside for the Nifty.
Hi, Ekta. Good afternoon. Yes, so that is the update in terms of the Nifty. But let's look at some of the individual names also. For the week, when you look at it, look at some of these AI plays that did really well, you know, given the buzz that was going on at the India AI Impact Summit as well. Some announcements that came in. So Newgen Software, Netweb Technologies, all of them have seen a very sharp run-up in this week. And Netweb Technologies specifically today also has recovered from that day's lowest point, a sharp uptick that you're seeing coming in here as well. Now, in terms of the losing side, you do have Brainbees Solution. For the week, it is down, but today it has shown some signs of recovery. It's up 6% in the trading session today, but a lot of news flow that is there as well. ABB India's earnings that came in, and we're going to be talking about all of that. We have a very exciting lineup for you all on the show today. We're going to be putting the spotlight on the data center opportunity in India, the key beneficiaries, and we'll also bring you corporate voices who spoke on the opportunity of data centers in India. We will also get you a comprehensive breakdown of Novartis' exit in its India's arm and how it compares to other listed peers. And later on, we will get you a conversation with the management of ABB India, who speaks on the company's earnings and the data center opportunity. Now, first up, let's go across to Gaurav, who's here to take us through the stocks that are moving around in the trading session. Good afternoon, Gaurav.
Well, good afternoon. For Nifty, it is quite of a relief day, and the reason being that we are seeing some uptick after the sharp sell-off that we saw yesterday. And specifically, if you look at the gainers, let's talk about Nifty Energy, because let's begin with ABB India within Nifty Energy itself, because we saw good set of numbers, and at the same time, what surprised the market is the order inflow, which is up almost more than 50%, which is also supporting the stock. And at the same time, we are seeing stocks like Siemens, Power India, CSE, all of these stocks are up more than 2% within Nifty Energy. When we look at Novartis India, there also we saw stock hitting its upper circuit, and the reason being that although the promoter is exiting, Chris Capital is entering, and they are going to buy almost 70.7% stake at 1,446 crores. Other than that, let's focus on PV Fintech. Now, it is a Kotak Institutional Equities who are bullish on the stock. They have actually upgraded the stock to add because they believe that the risk-reward ratio has now become favorable for the stock. And lastly, let's also not forget about Pace Digitech. This company was in the buzz because of the order win in the last 2 days, and today also the company has received an order worth 89 crores. let's also not forget about some of the volume buzzers today. We are seeing Data Patterns, Brainbees Solution, Nitin Spinners, Tata Investment and KRN Heat. All of these stocks are not only up in trade but also showing some strong volumes. Remember, Tata Investment and Nitin Spinners were there as volume-led gainers yesterday as well. On the losing side, let's talk about Nifty Realty. If you look at stocks like Signature Global and Godrej Properties, Phoenix Mills, all of these stocks are under pressure, and that is the reason why at a sectoral level we are seeing some pressure building up in Nifty Realty. If you look at some of the stocks where we saw yesterday these stocks were gainers, but today we are seeing some profit booking, and they are in the likes of Newgen Software, NDL Ventures and Godfrey Phillips. And lastly, let's also not forget about stocks like Vikram Solar, Thyrocare and Interact. If you look at the company and the performance, we are seeing sharp volumes and sell-off in these companies. So let's see how it pans out for these companies in a day going ahead. But as of now, it seems that bulls are back in the market.
Okay, all right. Absolutely. Bulls are back in the market, Gaurav, at this point in time. But let's see whether that sustains. We'll take a short break, but we'll get you the details on the Novartis AG deal. They're going to be selling 70.68% stake in Novartis India to Chris Gap. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Now we're going to be putting the spotlight on Novartis India. The Swiss pharma company Novartis AG has entered into an agreement with Chris Capital to sell its 70.68% stake in Novartis India, and this is going to be for a value of 1,446 crores. Chris Capital will also launch a mandatory open offer to acquire up to 26% at 860 rupees per share, approximately aggregating to 552 rupees. So yes, we have that update that's coming in here, 552 crore rupees. Let's go across to Ekta now, who's at the wall to give us the update on this one. Ekta, over to you.
Well, yes, the big deal in the pharma space has finally played out 2 years after announcing a strategic review of its Indian business. Swiss pharma company major Novartis AG has exited its listed Indian arm. The asset, earlier eyed by players like Dr. Reddy's and Alkem, has been acquired by Chris Capital, valuing the company at 2045 crores. So what does it bring to Chris Capital? It's a ready-made platform with established brands across immunosuppressants. Its key products will be in transplant therapies as well. Now, a key driver is expected to be the transplant market, with the organ transplant market growing around 20%. And their organ transplant drug is expected to grow 14%. Separately, Novartis has a marketing tie-up with Dr. Reddy's, and that is expected to aid in terms of growth as well. Now, they believe that Chris Capital can bring focus and scale to Novartis' portfolio. It also inherited strong margins and a healthy balance sheet. For the 9 months, revenue was down 3%, but margins were close to 28%. The company also has cash of roughly 600 crores on its books. Let's leave you with some interesting trends. Several listed pharma MNCs in India trade at a premium to their parent companies, which is driven by strong brands, steady portfolios, and a surplus cash of around 600 crores. For the likes of Novartis, but the likes of Pfizer, GSK, Abbott, all of them come with strong cash in terms of what they hold on their balance sheets. And that's one of the key reasons why you're seeing this kind of premium for a lot of these Indian companies as compared to the global peers, along with their brand portfolios. So that's possibly one of the reasons why Novartis India did see that kind of interest from Chris Cap, especially with other companies such as Dr. Reddy's as well as Alkem bidding for it.
Okay, the interesting data there, and interesting point versus how Indian arms versus their global parent are trading at a premium. But let's bring on board Ashish Kyal of Wave Strategy Advisors joining us on the show right now. Ashish, before we take a check in terms of the markets, and let's actually talk about Novartis or any of these pharma names. Anything that you have looked at on the technical front and anything you like here?
Hi, afternoon to Vinny and to you and all the viewers as well. If you look at Novartis, we can clearly see that the pharma companies have been under pressure for quite some time. Even Novartis is falling on the downside. Having said that, I think it's better to be looking at an outperformer stock from this space, and we can expect Oro Pharma to form a base formation here and give a positive breakout on the upside. So from the pharma space, I think Oro Pharma is better poised than Novartis. We can expect it to move towards the upper end of the range around 1240 levels from a short-term perspective. On the downside, the support for the stock is around 1120.
Ashish, now your view in terms of the markets today, we're not managing to, we're around the 25,600. How important is it to close above these levels, and what are the targets that we're keeping an eye out on now?
See, Vinny, if you look at the markets, I think it's trending only for approximately 3 days in one direction. We saw that happening after a huge gap up that happened on 3rd of February post the India-US trade deal. It went down for 3 days, again rallied for 3 days. We can see that clearly happening. Yesterday, there was a massive fall of more than 350 points. Today, we are again trying to recover back. So it's essentially stuck in a broad range. I think 25,800, 25,850 is the upper end of the range. And the lower end of the support is around 25,360, which is also happening to be again square of 9 level. So it's going to be in range. My target on the upside is going to be back towards that 25,780, 25,800 levels from here on, as long as the low of today, which is around 25,380, remains protected. So use dips to buy and play out the range as of now. And if you're an option trader, then selling these 40M options or selling strangle can be a good strategy at this point of time.
Okay, just a quick word on a couple of these, MNC stocks, these pharma MNC stocks, which we were just talking about. We have stocks such as Abbott, Pfizer, all of these stocks which are in focus because of the big deal which has taken place in this entire space. Would you have a technical call on these pharma MNCs? Not very closely tracked.
Yes, absolutely. If you look at Pfizer, there was a very big gap up that we saw that happened on 10th of February. Post that, it is consolidating in a range which can be a continuation pattern, possibly a triangle pattern, which can be continuation on the upside. So Pfizer looks to be good at this juncture also. The gap support for the stock is around 4880. And on the upside, we can expect it to reach back towards that 5250 and possibly higher. So Pfizer looks to be very appealing at this point of time to create long positions.
Okay, Ashish, thank you so much for joining in this afternoon on the show, talking to us about individual names as well as in terms of the market, the outlook there. But on that note, we're going to slip into a very short break. We'll come back with more stock-specific action on the other side.
Welcome back. Let's now focus on our What's Trending segment on Halftime Report. We put the focus on India's data center opportunity. This comes amid the recent boost which was provided in the budget and India's fast adoption of artificial intelligence across sectors. Vinny, tell us more. What should we be looking at? What's the feedback that we've received?
Hi. So in terms of data centers, it's a very interesting opportunity. Back in 2018, when you look at it, the allocation or co-location of data center capacity in India was somewhere around 300 megawatt. By 2025, it's become 1,668 megawatt. That's currently. While in terms of 2030, the estimated capacity that would come in for data centers is going to be around 8,000 megawatt, that's 8 gigawatt. So a sharp increase in terms that we're expecting in the capacity of data centers as well. Why does this increase? Because obviously when the AI opportunity is increasing, you need data centers for that as well. So obviously with that, the data center opportunity increases. Now, what does it mean in terms of market opportunity for Indian players? What is the capex or capacity expansion opportunity that come in for different sectors and different players? When you talk about it total, it's a $30 billion capex opportunity that comes in terms of that, electricals and powers, that will be the capex opportunity of around $10 billion there. Key players that benefit from this are going to be Hitachi Energy, Siemens Energy, Schneider Electric. These are just some of the names. CG Power, ABB. These are some of these players who would benefit in this sector. There are going to be racks and fit-outs which are required. So that is an opportunity that comes in terms of capex of $7 billion. Players who would benefit would be L&T, Sterling & Wilson, NCC, among some of the other names. Land is required, so you have Anantraj, Brookfield, Embassy, Lodha, all these real estate players also do see. If they look at entering into this space, Anantraj, look at it, the data center benefit, they've spoken about it time and again, and they already have enough in terms of capacity expansion that they're looking over there as well. Cooling side, you have a $4 billion opportunity, Voltas, Blue Star, Hitachi, all of them have spoken about the opportunity, as well as network infra also is an opportunity of around $1 billion. Industrials, cable wire side, KEI Industries, Polycab, Phenolic, some of these other players that do see a benefit as well. And especially in this AI summit, a lot of announcements that have come in from big players. Reliance has spoken about a big opportunity, a vision of $110 billion to invest in AI side. And that's a very big opportunity that they're talking about. Their related energy supply, digital ecosystem over the next 7 years in terms of opportunity. Investments in multi-gigawatt data centers is what they've spoken about. TCS has spoken about it as well. So a lot of announcements that have come in here, and that is what is keeping them abuzz, and the data center opportunity is just becoming bigger. Let's listen into Blue Star as well as what KEI Industries have also spoken about it. Blue Star said 10% of revenue is expected to be contributed from data centers in the coming years, and the TAM also is something that is expected to see an increase, as well as KEI Industries has spoken about data centers being 3 to 5% of the cost is cables and wires. So what is the opportunity for them? Listen into their views.
The sector is going to grow manifold in the coming years. So the market size, first of all, I will talk about the MEP services, the electromechanical projects. In a turnkey way, we do the air conditioning or firefighting, electrical plumbing. That part of the business, the first answer is our order book at any point of a time has been at around rupees 1,500 crores. And I estimate the market size to be anywhere between 3,000 to 4,000 crores. This can even double in the coming years. If you look at the Blue Star's revenue, you take it as in the coming years, it will be somewhere around rupees 15,000 crores. It can be, the data center alone can contribute rupees 1,500 crores of revenue. That's the number.
Expected investment in data centers in the country is around $30 to $35 billion in next 5 years by 2030 or 31 in these sectors. We believe that overall 4 to 5% of the total data center investment is an opportunity for wires and cables. Imports are absolutely not a fair. It is purely a domestic supplies, and we are well equipped to supply any quantity and any amount of cables to these data centers and related power infrastructure.
Okay, all right. So that's the data center opportunity which is really playing out. We need to take a short break, but on the other side, we'll bring you a conversation with the management of ABB India. Stay tuned for that.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC TV 18. Now let's talk about ABB India. They posted their numbers for Q4 calendar year 25. Good numbers that came in terms of order booking. Revenue saw a growth of around 5%. Labor code impact at 65 crores. The stock is buzzing away in the trading session today. Now I managed to speak to the management of the company, and I started by asking them about the order book, the data center opportunity as well. Listen in to that conversation.
For quarter four, I think the signals are quite robust for us in terms of how order pipeline is showing up, in terms of what we captured in quarter four, and how the the business pipeline is picking up in the following quarter. So yes, that's the highlight of quarter four, and also what we see forward. If you recall, and if you have been following ABB, we had tremendous growth in last 5 years, but especially in 2025, few quarters have been timid. The growth was not foreseen, and one can attribute to a number of factors, but definitely Q4 was standing out for us, and the growth comes from multiple market segments, be it automotive, renewables, data centers, and also certain core sectors which placed some good orders on us.
Okay, and just to follow up, do you think this good order book or the order inflow that one has seen, that is going to continue in 2026 as well for you all?
So as we see the customer inquiry and the project pipeline build up, it is quite strong. So we will wait and watch for next few quarters to give you an absolute confirmation, but we do see there is a strength in the market going forward.
Okay, you do see strength in the market. Sridhar, coming on that, right, your order backlog also is very strong. More than 10,000 crores is what we're seeing. What would be a typical conversion in terms from backlog, order backlog to your revenue side? Because you all do have those fast-moving orders as well. So how much of that order backlog actually is fast-moving? And what does it entail in terms of revenues that we could see in maybe the next Q1 or even in 2026?
Thank you. Thank you. This is a good question. I think it, of course, gives a bit of a future direction as well. So what I see, 10,000 crores of order backlog, first of all, is a very strong order backlog as what we have seen, which is growing up and which is going to help us to plan our revenues for the future. That's very clear. Out of this order backlog of 10,000 crore, almost 30% is around the large orders, which got an execution cycle which exceeds beyond 1 year. So that means, technically speaking, you have 70% of that is what could get a conversion possibility for 2026. And therefore, naturally, you need to have a book-to-bill orders in 2027, 2026, and 2027 as well. So that's how we see.
Sridhar, numbers that we could see for data centers, given that, the opportunity for India, they say overall from data centers would be by 2030 around 30 billion revenue in terms of that. For ABB, what are the numbers right now? Maybe in terms of order book, how much is data center and the growth that you're seeing here?
So as you know, ABB has 18 business divisions. So that means 18 distinct business models. Out of 18, 2 business divisions are distinctly exposed to the data center segment. And if you recall some of the interviews we had with your channel a few years ago, that time the size of the data center market was $1 billion. And that looked like a big number. Today, as we speak, it's already expanded to $10 billion. And I believe in you that when you say it will be $30 billion soon. So I think there is a strong trajectory and a strong CAGR growth in this particular market segment. As far as our books are concerned, we capture for all the market segments, we capture about 15% of our books, order books into data center.
Okay, 15% of your data books, order book is into data centers. And the growth that you've seen maybe in the last 1 year, so that we could understand how is the growth going for data centers as an industry opportunity as well?
As an industry spend, I think the data center industry is growing at a CAGR of 14%.
Okay, and that's what you all are also growing at?
Well, these are the projects, so they come in, in different cycles. But yes, I think there have been years which have been very strong, and then you get a bit of a build period, and then you get the next scale and next expansion that comes along.
Okay. Sridhar, could you help us with the margin side as well? Obviously, the QCO impact, is that starting to ease out? I believe last time also you had said it'll take maybe a couple of quarters to ease out. So maybe by Q2 of the next year, will we be able to see it completely eased out? Also, is there any sort of commodity pressure you all are seeing, any increase in terms of prices that could be maybe a concern? Because EBITDA margins, if you adjust of labor code this time, has done well. Is that sustainable is my main point.
I think it's a good question, and of course, it naturally flows from orders to revenues to the margins, right? So that's how it is. So I think the material cost, as what we see, is very important ingredient of the total cost structure of the organization. We are today at 61% as what we see, and that's basically, we were at 58 and we have moved out to 65, and that's basically more cost because of 3 reasons. A, I think definitely commodities and metal prices are definitely going to has an impact. And of course, the next one is the forex volatility, which is also another impact what we have. And the next one is around the mix of orders and revenues we have executed in this current year, right? And so I think these two factors, which is the forex volatility and the commodity prices, is something which is not in our control. And we're a short cycle business, because 76% of our businesses comes from short cycle orders. That being the case, so our ability to adjust the prices in the market going forward is definitely an action which the company will take at appropriate point of time.
So can we all expect good margins? Because I know the focus is not on margins, focus is on growth as well. But all investors always want to know is whether good margins in Q4, would that continue in the next calendar year?
Yeah, I think today we are at a PAT of 12%, right? So we were earlier but higher percentages because we enjoyed the benefits of the pent-up demand of COVID in the earlier years. But I think all our actions are to maintain this particular margin as what we are today and definitely improve upon it. So it's basically a play of margins, a play of margins on the orders, what we secured, the volumes which we have, which will drive the efficiencies in the business, and of course the external factors which will of course have to be managed as risk in any business organization. So long story short, I think our efforts is all about to be sustainable on the margins, and that's how we will try to work.
Okay, and just the last quick update, the robotics division, obviously we have the parent company which has made announcements coming in here. What is the update on the India front here, and what is the strategy for India now?
I think robotics, it's a business which is identified for divestment. So we have gone to the shareholders to seek their approval as per the process what is mandated by the law in the country. So I think we wait for their decision to come on this, which should be available in the next 2 to 3 weeks. That's how we see.
Okay, all right. So that's management of ABB India. That stock up around 8.5% at this point in time, doing well in what is also a lively market today. We'll take a short break, but up next, Manisha Gupta will join us with her segment, Commodity Corner. Stay tuned.
Welcome back. Joining us on the show now is Sandeep Bhan of SD Guthrie International Trading. Sandeep, hi, thank you so much for joining in. And when you look at the palm oil prices, while they have gained quite a lot in Malaysia overnight, but it really is about the Indian import numbers that I want to speak to you about, because Jan was 50% higher month on month. Feb is expected even on higher side. What is the sense that we can see in Feb and then March and going forward?
Thanks for having me. In February, we are expecting close to 1 million ton exports from Malaysia and Indonesia, and of course Papua New Guinea, and maybe some little bit from Thailand also. It's mainly because there was a price differential of $50 to $55 in levy and export tax, which is expected to go up in March. That gave Indian buying a boost. Because of this $50, Indonesians were very aggressive. They wanted to clear their stocks, and India was also getting it very cheap. Compared to soybean oil, there was a price differential of $100. So India basically took the advantage of this price differential and bought bigger volumes in February. And we are now expecting close to 1 million ton exports possible. If not 900,000, it looks like done, 1 million ton possible. But March will not see that kind of numbers. March, I think, will drop down to 600 to 700,000 tons, mainly because of carryover from Feb.
Sandeep, are you saying that India consumes a lot more palm than it does any other edible oil?
Hopefully it does this year, because last year it did drop sharply by more than 1.5 million tons overall. But this year it will depend a lot upon how the price differential will be between soybean oil and palm oil, which at this moment for nearby shipments is $70 to $90. But forward months, it's just running neck to neck.
How are you also looking at the overall pricing from here on? As of now, we understand that India is price sensitive. Is the reason we are buying a cheaper oil there. But going forward, will the prices stay here? What is the range you're putting palm oil in?
Pricing is always a very tough call with the kind of things shaping global geopolitical issues. Then we have the US biofuel mandates coming up. The price looks like we are trading in a very narrow range. That would be likely between 4,000 to 4,200. But all these tweets and whatever happens globally into the geopolitical stuff can push the prices either side. And another big major factor is the Malaysian ringgit, which has been performing very well against the US dollar. In fact, it's one of the best performing currencies in the Asia. So stronger ringgit makes it futures weaker, but in terms of dollar prices will remain elevated. So we'll have to adjust the differential of forex into the US dollar pricing.
Oh, absolutely. Sandeep, the other thing is about the biofuel mandates. Indonesia, we understand, but US is still a wild card out.
Absolutely. That's what markets are waiting for, the US news. Because of that anticipation that biofuel news is coming, Chicago Board of Trade for soybean oil has jumped. It touched 60 plus yesterday. And everybody is expecting that bull run might come into the US soybean oil market. But that puts a pressure on the South American soybean oil market. But overall, it's positive for the markets.
Sandeep, India imports 60% of its edible oil requirement. And for the longest time, we have seen this come in from Indonesia and Malaysia. But would you say more and more countries are now coming into that mix? Thailand, LATAM, Argentina, Australia, you have so many more countries now producing for India.
Absolutely. Previously, for palm oil, we were completely dependent on Malaysia and Indonesia. But now, Indonesia, after the biofuel surge in there, there's slowdown in CPO exports, and India being a mainly CPO market, we have seen many other origins coming up. We have now Papua New Guinea, we have Thailand, we have Philippines, and very recently we have now started LATAM origin. LATAM last year, two shipments happened, but this year it looks like they might have a consistent flow to India.
How important as a country do you see India will continue to be in the global edible oil mix in sense of an importing country?
India remains now the key market for all edible oil complexes everywhere. It's now how much India takes. That's the reason why every country wants to ship to India now.
Oh, absolutely. How are you also looking at the overall mix as we move ahead from here in sense of price moves? It's cheaper when you look at palm, but then you have also soybean and sun oil and various countries eyeing India for that too.
See, sun oil is now a very premium oil, close to $250, $300 difference compared to palm oil. So it's a very niche market now. It has a very limited buying mainly from the south of India, but mainly it's now between soybean oil and palm oil. If palm oil touches at par with soybean oil, we will see more soybean oil coming. If palm oil drops $50 to $100 against soybean oil, we'll see more palm oil coming up. So it will be a matter of 1 to 1.5 million tons difference between the two. So it's who blinks first.
Oh, absolutely. Sandeep, one final question, and I do understand that India uses palm most likely in Horeca. But if there was ever a demarcation to be done on how much palm is used in eating and how much in an industrial use, how would you put that across?
it's still 80 to 90% goes. 80% goes into food and rest into non-food.
All right, Vinny. So we're eating 80% palm oil in the Indian markets right now. Dieting or not dieting, but that's what you're getting.
That's what we're getting. But yes, and sunflower oil and all of that is still very expensive and at a higher premium. But as of now, that's all about the edible oil, palm oil, soybean oil, and more updates there. But thank you so much, Manisha, as well as Sandeep, for joining us today on the show. And Sandeep, thank you so much for coming to the studios as well. But on that note, we're going to step into a very short break, because after the break, we'll come back with a conversation with the management of Biocon Biologics on the H2 FY26 outlook, demand trends. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Now bringing you a conversation from a BioAsia conference. Shreyas Tambe, MD and CEO of Biocon Biologics, says that next 12 months are far more exciting and new biosimilar launches to reflect in FY27 from the sidelines of the BioAsia Summit. My colleague Ekta Batra caught up with him, listening to what they are talking about, and started by asking about the margin outlook of the company and the growth going forward as well. Listen in.
Q3 margins, like we've guided, have been brilliant, needless to say. But like we said, the way to look at this is to see it over a 4-quarter period, not just one particular quarter, because you'll have some variability between quarters. We've said it will be in that mid-20s, and we expect the year to be in that mid-20s, in that 24 to 26%.
Okay. What is your guidance on biosimilar launches, such as, say, Aspart, Aflibercept, Denosumab? Should we expect a meaningful acceleration in terms of revenue and margin growth because of these launches, and when are they slated for?
Yeah, I think the good thing is that you asked for guidance on how they're going to move forward, not just numbers guidance. And I've always said the future, the next 12 months clearly are far more exciting than the last several months that we've had, and the last several months have been exciting too. The products that you just listed, we've launched them, so they actually start showing their performance in the full year 27. So you will see them come into the full year numbers in fiscal 27. To what extent we have refrained from discussing those guidance numbers, but we expect the year 27 to be a very good, exciting year.
What is the competition and pricing pressure like in biosimilars?
It varies. Like I would be amiss to say that there is limited competition in insulins. We don't see a competition there other than the originators, and it's a space where you are with the originator, and then you have to be a very responsible player, because these are chronic therapies. So when you take them on, then you want to be there for the patient for a very, very long time. So market share is only one indicator or one metric of success, but you want to make sure that you're there for a very, very long period. And we are doing that with Glargine, where we have a fifth of the market now in the US. And we expect to move with Aspart on a similar trajectory. But you should expect these products to take off to their peak somewhere in that 4 to 6 quarter time frame, or some of them maybe 6 to 8 quarters. And you look at our legacy products, which have been there since 2018, they still continue to deliver quite good margins and have a fourth of the market in the US.
What are you predicting in terms of, say, the insulin market, considering that companies such as Novo Nordisk are redirecting capacities towards drugs such as semaglutide and other GLPs?
Well, again, I mean, that's intuitive to say that they would want to redirect capacities, because that's more remunerative at this point in time. But we've seen them, participate in the US market at this stage, and we continue to compete in that. We also see that there is an increasing demand for insulins, which we hadn't seen in the past. So contrary to the belief that given the rise of GLP-1s, you would see insulins recede, that hasn't happened. We continue to see a very steady demand. And given that, as we just discussed, there is limited or no competition beyond the originator, there's a sizable opportunity that continues to unfold.
Okay, that's the word coming in from Biocon Biologics, Shreyas Tambe, and interesting conversation next 12 months is going to be far more exciting. So we'll keep an eye out on that. But with that, we are absolutely out of time on this edition of Halftime Report, leaving the Nifty just at 25,600 levels. But up next, our business lunch to take you through all the action.
Market builds on morning gains, but off the day's high as stocks recover some ground after Thursday's brutal sell-off. Industrials, power and metals notch gains, while IT and realty are the drags. Signing of the executive order on reducing India tariffs to 18% includes a number of aspects and will happen soon, says U.S. Ambassador to India Sergio Gore. Adds President Trump wants countries to stop purchase of Russian oil. U.S. Secretary of State Marco Rubio to visit India very soon. India can play a serious role in data centers and become a hub for hyperscalers, says former Bharti Airtel CEO Sanjay Kapoor. Fitch's Nitin Soni says it will help Jio diversify revenues and improve margins and cash flows. Novartis India leaps after its parent inks an agreement with Chris Capital to sell its 70.7% stake for 1,446 crore rupees. Chris Capital will also make an open offer to minority shareholders at 860 rupees a share for 26% equity. India joins US's flagship effort on AI and supply chain security, Pax Silica. Minister of IT Ashwini Vaishnav says the alliance will make India part of the semiconductor supply chain, harnessing its pool of 1 million engineers. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Good afternoon, guys. Let's take a look at how the markets are doing. Everything's in the green, and it's a big relief from yesterday's brutal sell-off that we witnessed. The Nifty at around that 25,600 mark, about 0.5% in the green. We've got that mid-cap index also rising in line with those blue chips. But the Nifty Bank faring slightly better, and for the week as well, it's outperforming the Nifty. But the mid-cap's absolutely flat. Now, the sectors that are doing well in trade today is those PSU Bank stocks. That's the top gaining index, over 0.5% in the green. We've got PNB, Canara Bank, Union Bank, all of them over 2% higher in trade. We've got those metal stocks which are shining in trade as well. Hindalco, SAIL and Tata Steel notching gains of between 1.5% to 3%. But Nifty IT still feeling the pressure, right? That's the only index in the red, and it's falling about over 0.5% right now. We've got Persistent Systems, LTI Mindtree and Infosys, all of them dragging the Nifty lower, all of them about 1% to 3% in the red. So IT continuing to do badly and lagging all of the other sectors. But moving on, U.S. Ambassador to India Sergio Gore says that a trade deal between India and USA will be signed very soon. Take a look.
I think we have a great relationship. I think it comes down to multiple things. The first thing is the great friendship between our president and your prime minister. The signing will happen very soon. In fact, even this week, we have both teams are talking to each other and actively getting to a place where both will be able to sign. Look, the reality is there's tens of thousands of points. We're not dealing with a small country. This is one of the biggest economies. And so we're thrilled that the interim deal is done. You have the few tweaking points that are left to do, but it's done. So the signing will happen sooner than later.
Speaking to CNBC TV 18, Sergio Gore also said that the signing of the executive order to reduce India tariffs to 18% is expected very soon. Take a look.
We have seen India diversify on their oil. There is a commitment. This is not about India. The United States doesn't want anyone buying Russian oil. The president has been very clear on this. He wants this war to end. And so anyone who is in a way still involved with that conflict is something that the president wants to see come to an end in hopes of peace coming with that. On the first part of your question, that is also, there's multiple mechanisms. It's not one executive order. So that is making its way through the pipeline. The executive order specifically on oil was already signed. So that's done. The second part of it on the tariffs being rebalanced, there's multiple things. It's not just one piece of paper. It's multiple things, multiple departments, multiple areas. And so that'll also happen very soon.
And speaking at the inaugural Board of Peace meeting in Washington, the United States president reiterated his argument that the joint Israeli-U.S. strikes against Iran last year paved the way to the ceasefire in Gaza. He suggested that Tehran has about 10 to 15 days to reach a deal with Washington or face further military strikes.
Good talks are being had. It's proven to be, over the years, not easy to make a meaningful deal with Iran. We have to make a meaningful deal. Otherwise, bad things happen. And we do have some work to do with Iran. They can't have a nuclear weapon. It's very simple. You can't have peace in the Middle East if they have a nuclear weapon. And they can't have a nuclear weapon. And they've been told that very strongly. And now is the time for Iran to join us on a path that will complete what we're doing. And if they join us, that'll be great. If they don't join us, that'll be great too. But it'll be a very different path. They cannot continue to threaten the stability of the entire region, and they must make a deal. Or if that doesn't happen, I maybe can understand. If it doesn't happen, it doesn't happen. But bad things will happen.
And as we slip into a break, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Fly Emirates, fly better.
अभूतपूर्व हैं और स्केल भी अप्रत्याशित है।
Jio, together with Reliance, will invest 10 lakh crores over the next 7 years. This is patient, disciplined, nation-building capital.
It's amazing to see the energy here. Every time I come, it feels like it's gone up another level.
We won't realize AI's full benefits unless we work together.
Indian IT services companies have taken a large knock, really on account of what Anthropic is doing with Claude. Now, are you a bad dream or a nightmare for the IT services companies?
We certainly don't want to be.
Multi-decadal change. Every company has to figure out, has to ask fundamental questions. What is my moat?
India does it its own way. Because we are not announcing the trillions and the hundreds of billions of dollars announcement doesn't mean we are behind. We will find our own frugal but very high quality ways of getting to the same level.
Prime Minister Narendra Modi interacted with CEOs of leading AI and deep tech startups on the sidelines of the India AI Impact Summit. The discussions focused on advancements in healthcare, cybersecurity, space technology, and other emerging sectors where Indian startups are making a strong impact. He lauded their stellar contributions and emphasized the government's commitment to supporting innovation, research, and entrepreneurship. The interaction underscored the role of cutting-edge technology in strengthening national capabilities and driving economic growth. Leaders also explored collaboration opportunities to scale solutions globally, positioning India as a hub for transformative AI and deep tech innovation. India has formally joined the US-led coalition Pax Silica that aims to secure the global AI and semiconductor supply chain and reduce reliance on non-aligned nations. The pact was signed in the presence of IT Minister Ashwini Vaishnav and US Ambassador to India Sergio Gore. Gore called India's entry into the Pax Silica alliance as historic and hailed India's efforts into the semiconductor and tech industry. Other countries that have joined this bloc are South Korea, Singapore, Japan, UK, UAE, Israel, Australia, Greece, and Qatar. My colleague Ashmit Kumar also spoke to Sanjay Mehrotra, the CEO of Micron Technology, on Pax Silica declaration, and here's what he had to say.
I think it's a great summit bringing together leaders from all around the world, business leaders, government leaders, and Pax Silica is a great example of US and India technology collaboration, particularly advancing semiconductors and building AI infrastructure.
What are the benefits, sir, that India can hope to realize from this association with Pax Silica?
And of course, focus on semiconductors, building advanced supply chains, partnering with US, and together building the infrastructure for AI and the future for a future for all good for humanity.
On to the mega CNBC TV18 exclusive straight from the all-important India AI Impact Summit. Shireen Bhan was in conversation with none other than Sam Altman, the top boss at OpenAI. Here are some excerpts from the chat where they spoke about India's AI push, the deal that they've had with various companies in India, and more. Take a look.
This is the fastest growing market for codecs. And it's amazing to see the energy here. Every time I come, it feels like it's gone up another level.
Sam, you've also shared the stage with Pratyush Kumar of Sarvam. The last time you were here, there were questions being asked on whether India can do an LLM. Have you had a look at what Sarvam has been able to put out?
India's, yes, but more generally, India is just building incredible AI, the entire AI stack, from, like data centers to models to applications. And I think there's no country in the world quite matches India for total AI energy.
The latest as far as the deal with NVIDIA is concerned?
We are building compute as fast as we can. Yes, we'll have more compute over time, for sure.
OpenClaw and the pivot towards more agentic future for you specifically, are we likely to, A, how do you use that? B, are we likely to see more acqui-hires from you?
So the models are getting good enough we still have a lot of issues around safety and sort of security to solve with an OpenClaw-like approach, but I think OpenClaw is the most exciting thing to happen in the AI space in quite some time. And this vision of the models getting good enough that you can have a local agent running for you on your computer or a different computer and do all of these amazing things is really quite remarkable.
IPO in 2026? The visibility for that?
Presumably, OpenAI will be a public company someday. In terms of timing, there's like a lot of factors at play, and obviously this is a super dynamic world.
GPT-6?
Presumably that will happen at some point too. I don't have a date to share with you yet.
In the first half of the year?
I don't know when we're going to call something GPT-6, but the model improvement trajectory remains extremely steep. If you look at the progress from 5 to 5.1 to 5.2 to 5.3 in Codex, what I would say is, names aside, you can expect a trajectory like that to continue.
On that note, it is time for us to head into a short break. But coming up next, but before we slip into a short break, here's a quick sneak peek into the stocks that we will address on your stocks today. Don't forget to catch fundamental and technical experts give their views on these at 2 p.m. today, only on CNBC TV 18. We're back in a minute. Welcome back. You're still with us on Business Lunch. The spotlight today is on Novartis India. Swiss pharma company Novartis AG has entered into an agreement with Chris Capital to sell its 70.68% stake in Novartis India for 1,446 crore rupees. Chris Capital will also launch a mandatory open offer to acquire up to 26% at 860.64 rupees a share, aggregating to 552 crore rupees. Ekta Batra is here with all of those details. Ekta?
The big deal in the pharma MNC space has finally played out. 2 years after announcing a strategic review of its Indian business, Swiss pharma major Novartis AG has exited its listed Indian arm. The asset, earlier eyed by players like Dr. Reddy's and Alkem, has been acquired by Chris Capital, valuing the company at around 2,045 crores or roughly 14 to 15 times EBITDA. So what does this bring to Chris Capital? Analysts call it a ready-made platform with established brands across immunosuppressants, neurosciences, oncology and pain. Key products include transplant therapy Simulect, pain brand Wolverine and neurosciences drug Exelon. A key driver is expected to be the transplant market, with the organ transplants in India growing 20% in 2024 to around 15,000 procedures, and their key organ transplant drug Simulect growing around 14% in FY24. Separately, Novartis has a marketing tie-up with Dr. Reddy's since 2022, covering brands such as Wolverine, which grew around 6% in FY24, its calcium portfolio drug, and a pregnancy drug. Now, the street believes Chris Capital can bring sharper focus and scale to the Novartis portfolio. It also inherits strong margins and a healthy balance sheet. For the 9 months, revenue was down 3%, but margins were close to 28%. The company also has cash of roughly 600 crores on its books. We leave you with an interesting trend. Several listed pharma MNCs in India trade at a premium to their parent companies, driven primarily by the strong brands that they have in India, steady portfolios, and surplus cash on books.
All right, Ekta, many thanks for those details. Now, moving on, King Charles's younger brother, Andrew Mountbatten Windsor, was released from police custody last evening after being arrested on suspicion of misconduct in public office over allegations that he sent confidential government documents to Jeffrey Epstein, the late convicted sex offender. Now, the second son of the late Queen Elizabeth has always denied any wrongdoing in relation to Epstein and said he regrets their friendship. US President Donald Trump also commented on his arrest, calling it a shame. And before we close the show, let's take a look at where the markets are at now. When we started the show, it was about 0.5% higher, but markets coming off their highs. The Nifty below the 25,600 mark at 25,541 as we speak. The mid-cap index, moving in line with those blue chips. If you take a look at that Nifty Bank index, it's doing better than the blue chips. It's about 0.5% in the green. And that's been the case for the week as well. It's outperformed, the Nifty, but the mid-cap index absolutely flat versus the Nifty. If you take a look at that advanced decline ratio, we've got 382 stocks advancing for 1,542 stocks that are falling. So now clearly in favor of the declines. If you take a look at some of those sectors that are doing well, on top we've got those PSU banks. That's the top gaining index today. We've got PNB, Canara Bank, Union Bank, all of them over 2% higher. We've got metal stocks gaining too. Hindalco is the top Nifty gainer. It's about 2% in the green. And we've got Sales, Tata Steel, all of them gaining over 2% in trade. When we started the show, it was only the IT index that was in the red. But now we've even got, the real estate stocks that are also in the red right now. IT extending its losses under pressure. And we've got Persistent Systems, LTI Mindtree, Infosys, all of them lower in trade today. So that's how the markets are stacked up. And with that, it is a wrap on this edition of Business Lunch. But Midcap Radar will take all the action forward.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Very good afternoon. Welcome to Mid Cap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it is turning out to be a day where we are seeing some amount of respite for the markets. And what stands out is the advanced decline ratio, which has been even keel. Remember, compared to yesterday, we're definitely doing better in today's trading session. We have the mid caps, which are up around 0.5% for the entire week, absolutely flat. But let's see whether we get going, at least in the next couple of hours of trade. Hi, Vinny.
Hi, Ekta. Good afternoon. Absolutely, whether we get going or no is something that we'll keep an eye out on. But 25,600, it's below that mark, is what the Nifty is trading at. But on that note, let's go across to the top headlines for today then, Ekta.
Yes, absolutely. Markets build on morning gains as stocks recover some ground, but off the day's high, PSU banks and metals notch gains, while IT stocks drag.
PSU banks lead sectoral gains in trade, led by Canara Bank, Union Bank, IDBI Bank. The index rises 5.5% for the week.
Novartis AG will sell 70% stake in Novartis India to Chris Capital for nearly 1,500 crores, valuing the company at over 2,000 crores. Chris Cap will also launch an open offer to acquire further 26% stake. The stock is locked in a 20% upper circuit, trading with a market cap of just over 2,000 crores.
ABB India reports an inline set of numbers. Q4 saw a growth of 50% in order inflows, taking its order book to over 10,000 crore rupees. The management tells CNBC TV 18 that there is strong growth trajectory, CAGR growth in data center market, and that they aim to maintain margins at current levels. The stock surges over 8%.
And shares of PB Fintech, Dabur and Lenskart gain in trade on the back of positive brokerage notes. Motilal Oswal initiates a buy on Lenskart. Nuvama maintains a buy call on Dabur, while Kotak Institutional upgrades PB Fintech to add from reduce.
Okay, those were the top headlines for today, but let's move on. In our special segment, Mid-Cap Movers, we will have Sudarshan, who's going to join in with us. But a quick check in terms of the markets then. What we're seeing is PSU banks, we spoke about them buzzing away and running away in trade. For the week also, PSU banks have done very well. They're the top sectoral gainer, followed by Energy, Nifty Energy, then comes second in line with almost 2% gains over there. Nifty IT on the flip side, as well as Media, are the top sectoral losers. So that is something that you should watch out for. A lot of individual names for the week also, whether on the AI play or the data center story. Some of the names like Newgen, NetWeb are surely buzzing away in the trading session. Even today, NetWeb Technologies managing to hold on to very strong gains. And for the week also, they have seen very strong gains. But like I was saying, we have a segment Mid-Cap Movers, and we have Sudarshan who is here to take us through all the stocks that are moving around in the trading session.
So we are seeing a big move in some of the stocks which are reacting to the news flow. On top of the list is Novartis India, in which parent company Novartis AG has decided to exit by selling its stake of 70.68% stake to Chris Capital. Also, open offer has been announced, and for that price is around rupees 865 per share. Second one is D Development. The stock is up almost 8% after company has announced an order win of almost $40 million from US OEM, and that's the reason there is a big up move in the stock. ABB India, inline set of earnings for Q4 CY25, but what has surprised the street was the order inflow. And also in the committee that company has talked about, while company was talking to our channel, they have given a positive outlook going forward, as well, especially on the order inflow. That's the reason you are seeing a big move in the stock, up almost 9%. Lastly, Persistent Systems, it's down in the trade, especially because one of its peers has released earnings in US market, and that stock see a big downtick. That's the reason you are seeing Persistent down almost 2%. Among all the other IT stocks too are trading with either minor cuts or in the red. Lastly, some of the mid-cap gainers which have gained in the last few minutes, Brainbees. In the last few trading sessions, this stock was under pressure, but today from lows, it has seen a big move, currently up almost 6%. KRN Heat is up 13% with big volume. GE Power 2 is moving higher, currently up almost 5%. BLB has been moving higher for the last few trading sessions. Today also, this stock is up almost 10%. And last one is Centrum Electronics, up 11% with healthy volumes.
Okay, all right, Sudarshan. Thanks very much for joining in and giving us all of those buzzing stocks in trade today. Well, interestingly, we have the entire pharmaceutical space which is in focus because Novartis has announced that big deal where Novartis AG, which is the Swiss parent company, has sold its majority stake in Novartis, which is basically its India arm. Remember, it decided to do so in terms of a strategic review in Feb of 2024, and finally the deal has culminated in 2 years after that particular announcement. But interestingly, how do all of the pharma MNCs stack up? Remember, it's a space which is not very well tracked by the sell side. So if you just look at it from its 52-week high, for example, a couple of these stocks which are quite expensive in terms of the absolute level, they have corrected around significantly from their 52-week high. So Pfizer down around 17-odd%, GSK Pharma down 27%, Abbott, which is just about close to those levels, down around 2-odd%, and Novartis, which is down around 11-odd%. But if you look at it, if you compare, how exactly they stack up in terms of valuations, a lot of these pharma MNCs are quite expensive, especially when compared to the parent company. So Pfizer, for example, trades at around 36 times on a trailing basis. GSK also 47.3 times as compared to the global peer at around 16.1 times, that is GSK PLC. Novartis, similar valuations there, but a slight premium in India. And Abbott is at around 39 times versus 30 times in terms of what is available globally. Now, one of the reasons for this is obviously, the kind of brands that these companies have, but a lot of these companies are very cash rich. That's because of the kind of strong brands that they sell, that they generate a lot of cash flow. A lot of the analysts actually describe pharma MNCs as, very great marketing companies as well, because they have excellent brands which resonate with consumers. So, for example, Pfizer has around 27 to 2,800 crores in terms of cash and books. GSK, just in their Q3 call, mentioned that they have 2,426 crores. Novartis around 550 to 600 crores, which is now going to be on Chris Cap's books. And Abbott, which is at around 1,600 crores plus in terms of, cash and books.
Absolutely. This is very exciting with the cash on books and the premium they hold versus the global parent company. But on that note, let's also bring on board Jay Thakkar of ICICI Securities for a technical check on the markets as well. Jay, good afternoon. Thank you so much for joining us on the show. Today, while we did see a run-up coming in the first half of the trading session, now we've seen a bit of a muted or a bit of a downtick from the day's highest point, though still managing to hold on to gains of 0.5%, so not complaining there. But what is the important level that one should watch out for in terms of today's close, or where do you see it headed in the next week as well?
Sure. Hi, very good afternoon to you, Vinny and Rima. Overall, as far as Nifty is concerned, yesterday we did see a huge sell-off, but then the FI numbers did not actually show up that much. I mean, when we had seen the similar kind of sell-off last week, Vinny, once upon a time, FI number was as much as more than 7,000 crore plus in the equity cash segment as far as their outflow is concerned. And likewise, the increase in index future shorts was also up by almost 10 to 12,000 contracts. But yesterday there was marginal increase in the, or rather I would say there was marginal outflow as compared to the sell-off which we saw, as well as the increase in index future shorts were almost like 3,000 to 4,000 contracts only as compared to the previous ones of 10 to 12,000 contracts. Hence, we are seeing this bounce coming in today's trading session, wherein we saw that 25,400 is acting as a very critical support now on the lower side. But with this bounce, we need the IVs have also increased in today's session, and they are up by almost 5 to 6%, and because of which the option price, the premiums are in fact going up overall. The straddle price are going up. This clearly indicates that on the upside, Nifty might face a resistance at the levels of 25,800, wherein we see the highest OI prior to 26,000 levels. So I think 25,800, that is the make or break level going forward for the Nifty for this monthly expiry, which is on Tuesday. And only about 25,800, one can assume that probably the downside or consolidation is over and the volatility is likely to come down. Else, the fear of testing or revisiting 25,400 is higher.
Okay, all right. Specific stocks, what would you be recommending?
Well, Ekta, I would say that from the FMCG names, Colgate Palmolive, which had actually shown a good short covering in last couple of trading sessions. In fact, few of the FMCG names are doing really good in this kind of a market. So that is one stock on the long side, which I believe can inch to the levels of 2350 to 2500 as well. I mean, that could be one of the stock for the March series. On the downside, I believe that 2100 levels on a closing basis would act as a very crucial support. So with that as a stop loss, one can buy Colgate Palmolive for the March series on account of in anticipation of short covering. On the long side, I believe that the public sector banks so far have done good, and Bank Nifty relatively is outperforming the Nifty, right, Ekta? So I think that from the PSU banking pack, Bank of India, I think is likely to head towards the levels of 185, 190. One can buy that from the PSU banking pack because that is relatively stronger. And on the downside, one can place a stop loss at 162.
Okay, Jay, thank you so much, for joining in today and giving us the view in terms of the markets as well as individual stock names. But on that note, we're going to step into a very short break. We'll come back with more on markets as well as stock-specific action on the other side. Stay tuned in.
Welcome back. Well, for the markets, it's quite range bound, you'd have to say. So the Nifty is just about higher by around 130 odd points. We have the Bank Nifty, which is up around 450 odd points at this point in time. The advanced decline ratio, like we've been pointing out, is even keel. Just want to point out that a couple of stocks, however, seem to be doing well at this point in time. So we do have Idea Forge, for example, which is up around 1.6%. A lot of the PSU banks seem to be running away today. So that's Canara Bank, for example, is up around 3 odd percent, and Dabur seems to be building on gains at this point in time as well. But PB Fintech, those shares are in focus following an upgrade from Kotak Institutional Equities. Sudarshan is here with details on that note. Sudarshan, over to you, and busy day.
So in the last few months, this stock has been under pressure, and mainly because of the concerns related to commission draft norms that we are expecting from the insurance regulator IRDAI. Now today, Kotak Institutional Equities has come out with a note upgrading the stock to, it's a basically double upgrade to add from reduce, but they have maintained the target price of rupees 1725 per share. They say that after the recent underperformance, the risk reward has turned favorable for the stock. So what's the concern? So IRDAI is going to come out with the commission norms in which commissions are expected to come down, which is one of the important metrics, or which is one of the important income source for PB Fintech. But Kotak Institutional Equities believes that this is going to be offset by the growth that they are going to see by term and health insurance premium, because these two form normally almost half of their business. Now in Q3, premium growth was almost 45%. Going forward also till FY27, Kotak Institutional Equities believes that premium growth is expected to be around 40%, and beyond that in FY28, growth is expected to be around 33% versus company's medium target of 30%. So here also premium growth is going to be more than what company is targeting. So this is going to offset the concerns that have arisen from the commission norms that we are expecting, or commission draft rules that we are expecting from IRDAI regulator. This is one of the main reasons why Kotak Institutional Equities has upgraded the stock.
Okay, Sudarshan, thank you so much for that. As of now, the stock is holding on to gains of almost 3% in the trading session. But let's move on and talk about ABB India. That stock is buzzing in trade. They posted an inline set of numbers in Q4 calendar year 25. The revenue reported a growth of around 5% on a year-on-year basis. The company also saw labor code impact of around 65 crores. And the management tells CNBC TV 18 that there is strong growth trajectory and CAGR growth that they are expecting to see in the data center market, and that they aim to maintain the margins at current levels. Let's listen in.
ABB has 18 business divisions, so that means 18 distinct business models. Out of 18, 2 business divisions are distinctly exposed to the data center segment. And if you recall some of the interviews we had with your channel a few years ago, that time the size of the data center market was $1 billion. And that looked like a big number. Today, as we speak, it's already expanded to $10 billion. And I believe in you that when you say it will be $30 billion soon. So I think there is a strong trajectory and a strong CAGR growth in this particular market segment. As far as our books are concerned, we capture for all the market segments, we capture about 15% of our books, order books into data center.
We are at a PAT of 12%, right? So we were earlier, but higher percentages because we enjoyed the benefits of the pent-up demand of COVID in the earlier years. But I think our all actions are to maintain this particular margin as what we are today and definitely improve upon it. So it's basically a play of margins, play of margins on the orders, what we secured, the volumes which we have, which will drive the efficiencies in the business, and of course, the external factors, which will of course have to be managed as risk in any business organization. So long story short, I think our efforts is all about to be sustainable on the margins, and that's how we will try to work on.
Okay, all right. So that's the management of ABB India. We'll take a short break, but we'll get you a lot more on the markets and stocks once we're back. Stay tuned.
Welcome back and thanks for staying tuned into CNBC TV 18. As of now, the Nifty is at 25,570 levels, up almost 119 points in the trading session as of now, slightly off the day's highest point. But let's move on to a mega CNBC TV 18 exclusive straight from the all-important India AI Impact Summit. Shireen Bhan was in conversation with none other than Sam Altman, the top boss at OpenAI. Here are some of the excerpts from the chat. They were talking about India's AI push, the deal with NVIDIA and a potential listing of OpenAI. Listen in.
This is the fastest growing market for codecs. And it's amazing to see the energy here. Every time I come, it feels like it's gone up another level.
You know, Sam, you've also shared the stage with Pratyush Kumar of Sarvam. The last time you were here, there were questions being asked on whether India can do an LLM. Have you had a look at what Sarvam has been able to put out?
India's, yes, but more generally, India is just building incredible AI, the entire AI stack. From like data centers to models to applications, and I think there's no country in the world quite matches India for total AI energy.
What's the latest as far as the deal with NVIDIA is concerned?
We are building compute as fast as we can. Yes, we'll have more compute over time, for sure.
OpenClaw and the pivot towards more agentic future for you specifically, are we likely to, A, how do you use that? B, are we likely to see more acqui-hires from you?
So the models are getting good enough. We still have a lot of issues around safety and sort of security to solve with an OpenClaw-like approach, but I think OpenClaw is the most exciting thing to happen in the AI space in quite some time. And this vision of the models getting good enough that you can have a local agent running for you on your computer or a different computer and do all of these amazing things is really quite remarkable.
IPO in 2026? The visibility for that?
Presumably, OpenAI will be a public company someday. In terms of timing, there's like a lot of factors at play, and obviously this is a super dynamic world.
GPT-6?
Presumably that will happen at some point too. I don't have a date to share with you yet.
In the first half of the year?
I don't know when we're going to call something GPT-6, but the model improvement trajectory remains extremely steep. If you look at the progress from 5 to 5.1 to 5.2 to 5.3 in codecs, what I would say is, names aside, you can expect a trajectory like that to continue.
Okay, all right. So that's the big exclusive there. But that's all the time that we have on Midcap Radar. Your stocks once we're back. Stay tuned.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of the markets, the Nifty is just around the 25,590. So 25,600 levels is around where the Nifty 50 is trading at. Yes, slightly off the day's highest point. Nifty Bank manages to hold out to good gains of almost 0.8% in the trading session. While in terms of the top contributors for the Nifty 50, you have names like L&T, two private bank names, Axis as well as ICICI Bank, NTPC as well as Reliance among the top contributors for the Nifty 50. On the drag, it's Infosys, HDFC Bank, M&M and Bharti Airtel. A lot of individual movers that are coming in on the broader end of the market as well. So look at something like an ABB, Siemens, Apar Industries, Hitachi Energy. All these capital good names are among the top Nifty 500 gainer for today, and all of these are, ABB was on the back of its numbers, but then we've seen steam pick up for Siemens, Hitachi Energy as well as Hitachi Energy as well as Transformer and Rectifier. So all these cap good names are something that are buzzing in the trading session. Thermax too in the last 1 hour has picked up pace. So interesting to watch out for these names. But with that, we're going to move on to our queries for today. And we have our guests who are joining us. Vivasta Jain, research analyst at Hem Securities, as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Leeradhar, to answer all the stock-related queries. Asta as well as Vaishali, good afternoon. Thank you so much for joining us on the show. Let's move on and get started with the first query for today. We have Gopal, who's writing to us from Bangalore. He's holding 25,000 shares of IFCI, and this is at a price of 64 rupees per share. Currently, the stock is trading at 60 rupees per share, so they're making some bit of a loss here, but wants to know whether he should book his losses or stay invested. Asta, good afternoon. IFCI, what's your view here?
Good afternoon to you, and good afternoon to Vaishali as well. It's good to see her after a long time, and good afternoon to all our viewers. So talking about IFCI, see, if I talk about the IFCI's fundamental seems to be okay, because what we have seen is a turnaround case, because in the last quarter of December 2024, they have posted losses. So against that, definitely they have posted profits. So that looks to be very, very good, but we really need to see from where it is exactly coming from. So yes, these profits are excluding other income and exceptional items, etc. So I think IFCI has posted a very good set of numbers, and on that basis, I think one should remain invested in this counter. We believe that this counter is well poised to move till the level of the cost price of our investor, which is 64, I suppose. In fact, I believe that this counter can move till the level of 68 to 70 also. So remain invested in this counter.
Okay, remain invested in this counters. Do not book out your loss as of now. 68, around that level is what Asta is saying. Vaishali, good afternoon. What's your view? Where do you see this reaching medium-term and long-term outlook? What is there on both of these on the technicals?
Hi, very good afternoon, Vinny, Asta, and all viewers. Yes, Asta, after a very long time. So, yes, talking about IFCI, I think the trend is pretty intact. We are seeing a minor retracement currently. So, I would say 58 acts as a good support. So, if by chance the stock goes towards 58, he or she can add furthermore at these levels to better your price. And as Asta says, it's 68.70. Well, my target's technically to match with hers. It's nearly 70. And above that, I won't be surprised if it goes to 75 to 80 levels as well, because seeing the long-term chartical projections, I think it can go, once it crosses 70, there is a further scope of 75 to 80 also. So continue holding, and you may perhaps add more at 58 levels.
Okay, can perhaps add more at 58 levels as well, but continue holding. That's the view on the fundamentals and the technicals. Let's move on then to the next query for today. We have Radhakrishnan, who's writing to us from Kochi. He's holding 1,200 shares of Indian Overseas Bank, and this is at a price of 44 rupees per share, making a loss on this one. The other one he's holding is 30 shares of SBI, which is at a price of 787 rupees per share. He's a long-term investor and wants to know whether he should continue to hold or sell this one. In SBI, he's making a profit. IOB, Indian Overseas Bank, he's making a loss. Asta, your view on both these banking names. You know, we've always obviously spoken in the recent past, or the commentary that comes in as well, that, you know, banking side is something that is expected to do well, or financials is expected to do well. But are these two stocks something that they should continue to hold?
Yes, I believe that definitely these two stocks are such that one should have these stocks in their portfolio. Now, talking about, first of all, Indian Overseas Bank, what we have seen in the Indian Overseas Bank is that they have shown a very good turnaround story. So that is really impressing us at this point of the time. And this story has come up even after, prompt corrective action, which is imposed by the RBI. So after that also, bank is able to show improvement not only in its profitability, but also in its capital adequacy ratios, etc. So I believe that definitely this counter will show its momentum in some time. So remain invested in this counter. No need to worry. And my idea here is that this counter is well poised to move till the level of 40 at the initial pace, and then we can assign the target of 43 to this. Now, talking about the SBI, it is a no-brainer. Definitely, one should remain invested in this counter. The kind of asset quality which this bank has posted, it is, I think, it's like in the last few years, we have not seen such kind of asset quality, and the margin, they have maintained their margin very well. So SBI is also looking very strong to us, and why not? Both these public sector banks are really showing very strong performance in their results. So remain invested in both these counter. For SBI, our target is 900.
Okay. And Vaishali, your view coming in for both these names for the long term and the targets for the long term for both these?
So I would say overall, full banking sector has been outperforming, but it's these, if you may say, these cash category, IOB, UCO Bank, etc. They've really not shown any participation so far. So it's about time that they need to show some momentum. So if I talk technically, I think it's very well placed. If IOB as well as UCO Bank, one can add these at these levels, because what I'm looking at, the near term resistance comes at around 38. Above that, there is another target of 42, 43. So I would say, never mind if you are in loss, continue holding, and you can in fact add more in tranches, because as I said, you can better your price, and well, of course, you can get good profit also once we see momentum in this. And now talking about SBI, of course, the king of the PSU banks, but I would say one needs to be cautious, either book partial profit or continue holding with a trailing stop loss, because now I think chartically 1250 acts as a good strong resistance. So we need to wait and watch at these levels, whether are we moving past 1250 or are we showing some retracement. So better book partial profit or hold with a trailing stop loss. So if we see some corrective move coming in, you have scope of again re-entering this score.
Okay. That's a word on SBI for y'all. But let's move on then to the next query for today. We have Pushkar, who's writing to us from Mumbai. He's holding 120 shares of Phoenix Mills, and this is at an average price of 1,580 rupees per share. They're making a profit on this one. He's asking whether he should continue to hold at these levels or look to sell. Your word on Phoenix Mills, Astha.
So first of all, for SBI, the target is 1400. It was not 900 by mistake. I have said those words, so I beg your pardon. The target 1400. And now talking about Phoenix Mill. Phoenix Mill is looking very good. Now the reason is, we all know, strong jump in their sales they have posted. In fact, the occupancy is also looking very strong. And what we are seeing, that they are really witnessing very strong consumption in the retail segment. So Phoenix Mill is looking very strong to us, and we recommend a hold for this counter. And this is one of the best counter in the reality space, we suppose. So right now, remain invested in the counter with a price target of 1900.
Okay, remain invested in the counter. 1900 is for Phoenix Mills. Vaishali, your view on the technicals for Phoenix Mills. Should they continue to hold this?
Definitely, because this has shown a very steady growth, and chartically also it's a very neat chart. 1600 acts as a support, and I think we would look at 2000 as the next target, above that even higher. So yes, for now, keep a range of 1600 as support and 2000 as your target.
Okay, that's the word there coming in for Phoenix Mills. But let's move on to the next one. We have Nayan, who's writing to us from Pune, holding 52,500 shares of BHEL, and this is at a price of 57 rupees is what they bought it at. Long-term investor wants to know the outlook for the stock, BHEL. When you look at it in terms of numbers for Q3, there was a bit of a miss that came in terms of the numbers. Power segment, which is 75% of the business, that's a good growth of 13%, but missing a bit in terms of expectations. But what happened also post that and recently was that the government said that they will be looking to sell around 5% stake via OFS, and that took place. So BHEL as a view, Astha, what should they be doing?
BHEL's order book is really looking very strong to us. It is at around 2.23 lakh crore. So, I mean, the order book is very, very strong, and it gives a very strong, because of 2.23 lakh crore order book, the revenue visibility which this company is giving is also looking very strong. Another positive about this company is that now their execution have started ramping up. So we believe that one should remain invested in the BHEL. And here I would like to congratulate, because he has taken it at very lower prices. So if he wants partial or profit booking in 25% of the total quantity is advisable, but not fully. I'm not advising to book full profit in this counter, because we believe that this counter is well poised to move till the level of 300 to 320.
Okay, well poised to move up. Maybe you can book some partial profits and 25% of the portfolio. Order book is strong is what Astha is highlighting. Plus execution, that's seeing an improvement. So key triggers and the fundamentals there. But Vaishali, your view quickly on BHEL, what should they be doing?
It's holding on to a good support level, and today's candle itself is showing a lot of strength. But I would say since it's been bought at very low price, keep a stop loss of 240, because below 240 it could damage the trend. But as of now, as per current scenario, there is a resistance at around 285. So I would say maintain a range of 240 to 280 and hold on. If we cross 285, we are in for higher targets.
Okay, that's a view coming in there on BHEL. But on that note, we're going to slip into a very short break. We'll come back with more of your stock-related queries on the other side. Welcome back to Your Stocks on CNBC TV 18. We still have with us Asta Jain as well as Vaishali Parekh to answer all your stock-related queries. Let's keep it going with the queries then, ladies. The next query for today is coming from Prateek, who's writing to us from New Delhi. He's holding... he's not mentioned the number of shares, but he's holding some shares of Aadhar Housing Finance. And this is at a price of 474 rupees per share. He wants to know if he should continue to hold or sell and what are the levels that maybe he should keep an eye out on as well. First up, I'll come to you, Vaishali. What should he be doing with this?
I think the stock is showing signs of revival, so continue holding. I think keep a stop loss of 470 now and hold for the near-term target, depending on your time period that you're ready to hold. The first target we look at is around 500. Above that, it can go to 530, 550 levels as well. So continue holding.
Okay, continue holding. Above 500, then 550 is something that one should watch out for as well. We'll move on to the next query. This is a long-term query, more in terms of perspective on the fundamentals is what Arvind wants, and he's writing to us from Karnataka. 200 shares of IREDA, IREDA is what he's holding at 183 rupees per share. So he's making a loss on this one. Wants to know the long-term view on the stock. Asta, how is the company looking fundamentally? At one point of time, you know, we had seen the stock see a very good run-up as well. But a bit muted in terms from their buy price. They're making a loss. So what should they do now?
I think one should remain invested in this counter because what we have seen is that there was certain, stress which was witnessed in the Q1 of FY26. But now what we are seeing by Q3 of FY26, the earning normalization has been started. And what we are seeing also is that it has not only limited to the earnings. Even if we see their asset quality also, we believe that the asset quality has shown a remarkable improvement. So we feel that this counter is now such a counter which can show more upside from here on the basis of fundamental. Hence, remain invested in this counter. Although cost price is high, which is 180 rupees, but I believe that this counter can move till the level of 150. So at least wait till those levels and remain invested.
Remain invested, wait till those levels, and then maybe you can look at it going forward. But Vaishali, a quick word on the technicals as well. Last 1 year, the stock has come down almost 26-27%, right? And even the viewer is making a loss. Is it a time maybe to look to average? Is that a possibility? And the long-term target?
Actually, I would say so because what we've seen is that the stock has fallen one way, right from even the recent data, what we see is right from around 165 to now quite in oversold. So no harm averaging out. And if Asta also says that this is fundamentally good, and indicators, technical indicators also show that it is ready for an up move to set in. So I would say average out at these levels. And technical targets as first target levels would be 140 and then 150. 150 is also a 200-day moving average, which would act as a tough resistance. We can have a relook at those levels once we see some clarity. But for now, hold and average out.
Okay, let's move on then to the next query. We have Omkar who's writing to us from Jaipur. He's holding 566 shares of Hindalco and the price that he's bought it at is 946. Slightly below right now is what the stock is trading at from his buy price. Wants to know if he should continue to hold or exit at the current levels. Hindalco, what is your view coming in on this one, Asta?
Our view is positive because what we believe that the Indian operations will definitely going to show good momentum on the basis of the higher aluminium prices. So definitely a good counter to remain invested in. Apart from that factor, I think one more factor is their capacity expansion is also looking very, very strong. So we believe that this counter is such a counter where one should continue his holding in, and price target can be set at around 950 to 980 at the initial levels.
Okay, interesting there on the fundamentals, but on the technicals also, should the viewer continue to hold this or exit? Given that the stock has seen an up move in the last 1 year, no, Vaishali, so what does it merit in terms of their move now and strategy?
The recent high that was at around 1030 levels, and from there we are seeing a retracement. So the view is positive as long as 880 levels are held on. The view gets negated of a positive bias if we see a close below that. So I would say continue holding for now. The stock would give further clarity if we see a close above 940. Then we are looking for a target of 980 from here on. But for this, continue holding with a stop loss of 880.
Stop loss of 880 is the key. Keep an eye out on that level over there for Hindalco. Let's move on then to the next query. We have Riju Prasad, who's writing to us from Mumbai. He's holding 500 shares of Eternal, and this is at a price of 258 rupees, making a profit on this one. Wants to know the long-term story for Eternal. Asta, I know we have spoken about Eternal a lot of times, but one more query on Eternal, and seems like all these food delivery apps are becoming the favorite.
Yes, and here in Eternal, there is one positive point that their net order value has seen a significant growth, and it has really accelerated not only on the year-on-year basis but also on the quarter-on-quarter basis. So I still believe that Eternal is a story which is still to believe on, and remain invested in this counter with a price target of 300 to 320.
Okay, remain invested, and do not forget, they did have a very good performance in even the quarter gone by. Strong overall performance, EBITDA level also very good in terms of quick commerce. Vaishali, your view on the technicals for Eternal?
Well, I would say continue holding, and if by chance it goes towards 250, you may add more, because when I'm looking at the longer term chartical presentation, it's coming to 300, 320 as the next target level. So 250 is the support level and 320 is the target resistance. So keep accumulating even at lower levels.
Okay, let's move on then to the next query. Krishnan is writing to us from Kerala, holding 265 shares of AWL Agribusiness. Price is 284 rupees per share, making a loss. Long-term investor, what is the future prospect, Asta?
I think what we have seen from the management commentary in the previous quarters, that they are believing H2 of FY26 to be a good quarter, and that too on the basis of the support in the rural demand, consumption demand, etc. So idea here is just to wait and watch how the things turn out to be for this quarter and remain invested in this quarter. I believe that this quarter maybe management or what believe is definitely going to turn true, and hence the stock can move till the level of 220 to 230.
Okay, surely we'll keep an eye out on those levels there. But that was the last query for today. So Asta as well as Vaishali, thank you so much for joining in. Hope you all have a great weekend. And viewers, thank you so much for tuning in as well. Hope you all have a great weekend as well. But remember, you can always send us your queries. That email ID is flashing at the top of the screens for y'all, as well as there is a number which y'all can either WhatsApp us or send us your messages on the queries there. Thank you so much for tuning in. Up next, you have closing bell now to take you through the last hour of trade.
go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
As of now, Hang Seng is indicating is down almost 1%.
It's not a big negative. I mean, these are not large numbers.
The Nifty IT index is going to play a very, very important role. It could start off near Friday's low.
The negative news flow has really not gone away, whether it's been around the AI trade, the tech trade, whether it's around Iran.
It's a big AI opportunity. There is a massive AI boom. It's not yet translating into numbers.
0.1 to 0.13% down on the Nifty Bank.
There are various reports also suggesting that the action could be as early as this weekend itself.
To retrain those kind of workforces is going to be a much, much bigger challenge.
And the Nifty Bank has outperformed with a gain of 1.5%.
4,000 crores approximately is the order inflow in the quarter that has gone by, Q4 calendar year 25 for them.
And at the same time, we are seeing stocks like Siemens, Power India, CSE, all of these stocks are up more than 2%.
2 years after announcing a strategic review of its Indian business, Swiss pharma major Novartis AG has exited its listed Indian arm. The mid-caps, which are up around 0.5% for the entire week, absolutely flat. But let's see whether we get going, at least in the next couple of hours of trade.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Rima, and we're going to be pulling through the next 60 minutes on Closing Bell. Rima, markets looking pretty good in the green. A good pullback after the kind of selling that we saw yesterday. We pulled back close to around half of yesterday's losses on most indices, with the Nifty Bank powering ahead.
Indeed, the Nifty Bank is up 1.5% for this week, outperforming the Nifty, which is up close to about 0.5%. So that's where the support is coming through. And we pretty much held on to levels of 25,600 on the Nifty. There was a little bit of a wobble around 1 o'clock, but markets, some buying emerged at lower levels, and we're back to levels of 25,600. Let's tell you what's on the tap on Closing Bell. Buying interest across sectors helps offset some weakness in IT stocks. The Nifty edges and is at 25,600. Mid-caps eke out small gains. Small caps lackluster. Metals, PSU banks are the consistent gainers today. Ola Electric scales yet another all-time low. It's a steep 56% correction in the last 1 year. What's ailing sentiment? A comprehensive analysis coming up. And ABB India zooms on the back of record order inflows in Q4. Top line grows across segments, coupled with strong demand from data centers, automotive, infra, rail, and metals segments. Excerpts from our chat with the management coming up on the show. And shares of Novartis India skyrocket following news of the company's Swiss parent looking to exit by selling stake to Chris Capital. A deep dive into the sector to unpack the key trends in this space. We'll focus on Pfizer, GSK, Abbott in just a bit. Kotak Institutional Equities upgrades PB FinTech to add versus reduce earlier. Target price 17.25. Also coming up on the show.
Well, first of all, let's tell you what's going on in the F&O market. The Nifty is holding in the green, and that's courtesy of the Nifty Bank. As we pointed out earlier today, I don't know whether it came in that wrap or not, but I clearly mentioned this morning, till the Nifty Bank holds on to that 20-day MA, you'll fancy a bit of a fight back. And if the Nifty needs to fight back, the Nifty Bank needs to find its form, unlike what we saw yesterday. The Nifty PCR at the start of today was around 0.7. That's bounced back up to around 0.95 or thereabouts. That's because put writers are back in play. 25,500 put, 25,600 put. On both those two, the open interest has surged up and the premiums have come down drastically, telling you there is writing as the premiums are down by close to around 45%. The key levels to track, well, as I said earlier today, the 25,250, 25,300 mark is very important. That almost tallies in with, the 20-day MA, which comes up for you, or 200-day MA, which comes up for you on the screen. And also you have today's low that came in at around 25,380 or thereabouts. So that's, the important range you don't want to break on the downside. Though at higher levels, so 25,900 will be a bit of a resistance zone. Individual stocks, Tata Steel is seeing fresh buying in today's trading session, but there's only so much a metal stock like Tata Steel can do.
What's really encouraging is Reliance Industries. That's an index by itself that's holding one end up, delivery-based buying, fresh long build-up is what we're seeing on Reliance Industries. And that big boy is doing much of the heavy lifting. Canara Bank has come in for a bit of a short squeeze in today's trading session, so keep an eye out on that name. Stock up 3%, open risk lower. And Sammaan Capital, there's a big bit of a short covering bounce that's playing out here. I think either by today or Monday, I think Monday could be the day actually that we could see the stock come out of the F&O BAM. Probably there is a glimmer of hope that it comes out today. Otherwise, on Monday, I'm expecting Sammaan Capital to come out of the F&O BAM. So keep an eye out on that. Net, it's a good trading session. Shots got added in the system. It appears there's a bit of a squeeze. Geopolitical tensions, top of mind. Let's see what comes out of that one. Hopefully, it doesn't escalate. How do you trade, though, in the final hour of trade? Mitesh Thakkar is back with us. Mitesh, we managed to defend the lower levels, 25,380. That's the mark that we defended. Where are we headed from here? And do you think the Nifty has enough to go back to around the 26,000 mark?
Yeah, I think very clearly the Nifty has managed to hold on to this level of 25,400, which is what I suggested would be the first pivot, and then 25,100 is that gap area. I think these are two important levels. Now, whether we have a reversal, it's still early to say. So naturally, I think, we had moved about 25,800 day before yesterday, and then got back from there. So 25,800, 25,400 to me are the two immediate triggers. And the market possibly for the time being is more choppy within this range rather than, giving you a directional sense. So on the index, my sense is avoid trading the index unless until, you are looking at the lower end of the range. And two, I think, stock-specific trading may not be a bad idea to look at.
Do you want to give some stock ideas? Any trading recommendations for the last hour?
I have a buy and a sell. I think a buy on Bajaj Finserv. That's a stock, which has done very well. In fact, in this entire decline, Bajaj Finserv has been either sideways or mildly uptrending. So this is a buy with a stop at 2040 for targets of around 2100. And Bharti Airtel has somehow gone into a corrective mode. Yesterday was a breakdown candle. Today is a follow-through candle in a positive market. So Bharti Airtel will take as a sell-side trade with a stop at 1996 for targets of 1935.
Thank you. We'll come back to you. Bharti Airtel entering into a corrective zone. Let's talk about Ola Electric. It's been in reverse here for a while now, and it's a 13% decline this week. It's lost about a quarter of its value in 2026. And if you look at the numbers from the all-time high levels, it's heartbreaking. Sudarshan, tell us more.
So as you have said, it's a continued underperformance by Ola Electric shares, and today also this stock is down more than 3%, and this week it's down 13%. 2026 so far, or say in the last 2 months, the stock has fallen more than 26%. What's the reason? So first, recently company has released Q3 FY26 earnings, and those earnings look very weak. Revenue is halved, losses remained elevated, and it's the first time that company has reported loss which was more than the revenue for the quarter. Second, company at the beginning of this fiscal had given the guidance, and that guidance had looked very strong if it had managed to deliver. But we have looked at the data of 9-month FY26. So company had given for auto business EBITDA margin, and the target was more than 5%. As of December 2025, company has delivered minus 6.4%. On the gross margin, target was in the range of 35 to 40%. As of now, it is at 29.6%. On the volumes, the guidance was in the range of 3.25 to 3.75 lakh units. And as of now, company has done just 1.5 lakh units. And on the revenue front, target was in the range of 4,200 to 4,700 crore. And as of now, they have done just rupees 2,000 crore. Second metric is market share data. Now, in January 2025, company had the market share of almost 25%. In January 2026, that has fallen to less than 6%. In January 2026, it was 5.86%. And in February also, so far, registration is looking very weak, and in all probability, its market share is going to fall further. And so far, registration is just 2,806 units versus whole month, if you look at of February 2025, they had done almost 8,675 units. Last one, what do brokerages say? So as per the Bloomberg data, total 8 brokerages have the coverage on the stock, and of those 8, 6 have the sell call, and lowest target price is rupees 20 per share, while the highest target price is rupees 55 per share. So if you take a look at the lowest target price of 20 rupees per share, brokerages believe that there is a further downfall that we can see in the stock price even from the current levels. So we'll have to see how the next few months pan out. But as far as the data is concerned for Ola Electric, it's looking very weak. Market share is falling. Even registration has been under pressure continuously.
Sudarshan, sorry, offhand, do you know the 2 brokerages who are bullish on Ola and who has the target price of 50 plus?
The highest target price is by Goldman Sachs. They have the target price of 55. But 4 brokerages have cut the target price recently after the Q3 FY26 earnings. One of them was Kotak, MK, and some of the other brokerages.
Thank you very much for that comprehensive wrap. That's Ola Electric. It's been a one-way slide for the company. Gurmeet Chadha is now joining in on the show. Gurmeet, thank you very much for joining in. I know Ola is not a stock that you like. In the past, you've spoken about Uno, Minda, etc. being the preferred auto ancillary, with a couple of others. M&M as well in the auto pack is a stock that you've liked. But tell us, in the auto and the auto ancillary space, there's a lot which has changed. Stocks have moved around both ways because of the tariff uncertainty, then clarity. What have you all been doing with your auto exposure? Where does it stand at now?
So, we are looking at the complete value chain as what we do. So we are looking at, let's say, in two-wheelers, TVS Motors, iQuick continues to gain market share. All segments, they are doing well. Plus, operating margins are improving. Last 3 years, TVS Motors has been almost if I can call a great turnaround story. Exports doing well. They're doing well in the IC engines. The premium part doing well. Then we have the likes of Uno Minda. Recently, we've added a company called Rajratan Global Wire. They make actually bead wires for tire. They had a Thailand business which got disrupted post-COVID with China dumping. I think that seems to have stabilized. The Indore unit continues to do well. And now we have the Chennai plant, which is where the bulk of the OEMs are. So that is something we've recently added. In addition to this, we obviously have M&M. M&M also has shown weakness, surprisingly, despite very good earnings as well as wholesale numbers. So we are actually looking at increasing some weight there. And if you see the PMI numbers, manufacturing continues to show a good surge. At some point or time, I think it will start getting reflected in the price as well.
And Sandhar Tech, I think in the past you've spoken about Sandhar, Tata Motors also.
Yes. So Sandhar basically has 3 divisions. One is the lock division. Then you have die casting, and then you have industrial cabins. Now, with commercial cycle picking up, even the cabin part is doing well. The casting and the die part is the one which is showing the maximum growth. And TVS is almost 55-60% of the client. Maybe 4 or 5 years back, it was Hero, which was the dominant one. So it's got spread as well. Little soft earnings, so stock has corrected a little bit, but looking pretty good. All 3-4 businesses eventually should do like 1,000 crore revenue over the next 2-3 years.
Okay, all right. Thanks, Gurmeet, for that. But let's get in Vinny. She's here to tell us about ABB India. That's surging in trade, post its Q4 numbers. Vinny in green. Stock well in the green. Tell us more, Vinny.
Yes, Nigel, stock well in the green today, managing to hold on to very strong momentum. Now, do not forget that ABB Global normally gives their order book, and we already had a fair idea that the order book for ABB India will be strong. Now, that's what has come in. 4,000 crores in terms of order inflow for Q4 calendar year 25 for the company. And that is a much better run rate that one has seen over the past few quarters. It was in the 3,000 crore range. Now, this 4,000 crore range has come in. The company has managed to see very good growth across their segments. They've managed to see good EBITDA margins, and especially ex of labor code impact, the margins are much better than what one was anticipating or expecting. Data centers has done well for them. Automotives, building, infra, railways, as well as metal segment is the key areas where they've gotten the order inflows from. Now, the stock had already seen a run up even in the last 1 month before today's trading session, and despite that, we're seeing a run-up coming in the stock. So the street seems to be liking it. Brokerages have maintained their call on the stock as well. There's no change in terms of their call, no change in terms of target price as well. When we spoke to the management, they did highlight certain important points, saying that, currently in terms of the data center order book, that accounts to 14 or 15% of the order book is dedicated to data centers. They expect that industry to grow at a 14% CAGR, and they expect to maintain and aim to maintain the margins at these levels and then start improving. Order pipeline for them remains strong. So listen in to what the management also had to say.
ABB has 18 business divisions, so that means 18 distinct business models. Out of 18, 2 business divisions are distinctly exposed to the data center segment. And if you recall some of the interviews we had with your channel a few years ago, that time the size of the data center market was $1 billion, and that looked like a big number. Today, as we speak, it's already expanded to $10 billion. And I believe in you that when you say it will be $30 billion soon. So I think there is a strong trajectory and a strong CAGR growth in this particular market segment. As far as our books are concerned, we capture for all the market segments, we capture about 15% of our books, order books into data center.
We are at a PAT of 12%, right? So we were earlier, but higher percentages because we enjoyed the benefits of the pent-up demand of COVID in the earlier years. But I think our all actions are to maintain this particular margin as what we are today and definitely improve on it. So it's basically a play of margins, a play of margins on the orders, what we secured, the volumes which we have, which will drive the efficiencies in the business, and of course, the external factors, which will of course have to be managed as risk in any business organization. So long story short, I think our efforts is all about to be sustainable on the margins, and that's how we will try to work on.
Got it. All right, Gurmeet, what do you make of this one? ABB, one of the biggest outperformers today. I'll tell you what, it's had a bit of a rub-off impact. You know, Siemens is up, Hitachi is up. So that clutch of stocks itself are doing well. Your view, they're not cheap. They're not meant to be cheap, and they've never been cheap. Your take.
So Nigel, obviously the order book has helped. I think they're already crossed 10,000 crores as of December. That's like a 12% growth. And I think data center is the flavor. Every market phase has one flavor. And I think some of the order book, other than the base business, is coming from data center, other than the infrastructure, mobility, automotive, etc. But I agree with your valuations. We do not have we have L&T in the portfolio. We have CG Power. So both of them have also shown. L&T made a new high today. CG Power also is doing well. We've also added Hind Rectifier, which is basically to power electronics other than transformers, which is both railway, and now they are diversifying into other sectors. So as far as this space is concerned, which you can call it energy, data center, and data center pick and shovels, which is your metals, your cable and wires, your power equipments, I think that is something that you should do well.
Got it. All right. And the point on Hind Rectifier, it's the railway play, right? And you believe that it's got some tailwinds as well?
So three things. One, it obviously is the main transformer business, which continues to grow at 30-40%. They used to do 100 crore revenue 6-7 years back. They've hit 1,000 crores this year. Now they've got into power electronics. So that is one segment which will do very well. They acquired a company in France, which should do well, which is D-Links. And then they're getting into MEMUs. MEMUs are just like the Mumbai local, Nigel, which is basically the engine is self-propelled. Right? You don't need a normal engine is one locomotive and you have like 10, 12 bogies. This is like a self-propelled, which is like even metro or a Vande Bharat. And there's large opportunity there. And once you get through it, you're then eligible for Vande Bharat as well. So that is something also which will do well. And then of course it's robotics and power electronics, which is a long-term view. They've done some backward integration in terms of having their own copper unit now, which would add to the margins. So this is one play which is looking good to us.
Got it. Okay. All right. Stay with us, Gurmeet. Let's talk about the pharma space. The likes of Pfizer, GSK, as well as Novartis, all of them are 11 to around 17% away from their 52-week highs. Ekta standing by with some interesting valuation comparison and a quick look at the balance sheet of these companies as well. Ekta?
Well, yes, the pharma MNCs have really come into focus because of the deal which has been struck between Novartis and Chris Capital, where Novartis will be selling their majority stake in the India arm, which is around 70% stake to Chris Capital for around 1,500 odd crores. Now, interestingly, the pharma MNC space is not that closely tracked by the sell side. But if you just look at a couple of valuations, if you look at how interesting the stocks are, in terms of the 52-week high, there's been a significant correction. So, for example, Pfizer is down around 17 odd %, GSK 27%, Novartis around 11 odd %. Abbott seems to be the most resilient at this point in time. In terms of trailing PE, if you compare it to their global listed parent companies, the Indian ones seem to have a premium. So, for example, Pfizer is at 36 times versus the global peer, which is at 19.7 times, GSK 47 times versus the global peer at 16 times, and Novartis similar levels, but Abbott also at a premium in India. Now, one of the reasons for this is because of the strong brand portfolio that they have. Remember that they have a very strong portfolio of drugs which they sell in the country, and that basically makes them possibly have a greater mind space amongst patients. And separately, they do have a strong balance sheet as well. So if you just look at the cash on books that these companies have, Pfizer, for example, has around 27 to 2,800 crores, GSK 2,426 odd crores, Novartis 550 to 600 crores, and even Abbott, which is at around 1,600 crores plus. So strong balance sheet in terms of what they have, and strong portfolio of drugs, which makes it a combination which gives them a premium in India.
Beautiful. Thanks a lot for that, Ekta. Gurmeet, you heard what Ekta has to say. Pharma, any of these names stand out? And what do you all like from the pharma pack? I think Loris is something that you all were holding on to.
So we've been very constructive on the entire CDMO space. Loris obviously has three businesses, which is the generic APIs, the FDF, CDMO, and a little bit of biotechnology. These are lumpy businesses, so you got to be a little patient. You can't really track them quarter on quarter. So that seems to be well. We have DVs in our portfolio. In branded generics, we have Mankind Pharma. And in hospitals and few of our portfolios, we have Narayana Hrudwala. So we play branded generics, we have CDMO, and there's a bit of a hospital play in Nigel. So continue to, if you see Nifty 500, pharma is about 5-6%. We are roughly about 10-11% in our portfolio.
Okay, got it. Gurmeet, from the metals pack, I don't think you'll have too much exposure, right? How are you all playing that? Today, metals are doing well. It went through a bit of a correction. Stocks like Hindustan Copper and all, I think, saw 15% correction in a few days after rallying big time. Anything you like from this space?
So, I'm generally a believer that you are in a hard metal structural cycle, Nigel, but from a stock point of view, you got to be more tactical. So we've been a little bit in and out between Tata Steel and Hindalco. But you're right, we haven't done much. And there's one special situation play we have, which is Mukkan Steel, where there's a lot of asset monetization expected with land parcel being sold for data centers in Thane. They've already monetized a couple of land parcels, couple of more should come. The land bank value itself is a little more than the market cap of the company. But they are into stainless steel, and a lot of exposure is in EU. So that part has been a little sluggish. But now with this FTA and things picking up, hopefully should do better.
Anything else in the data center opportunity? Maybe on the green energy side, maybe on the infrastructure side, anything, power cooling systems?
So as I said, we play the core one, Rima. So we have Bharti, I think, which is one of the larger play, and Reliance through Jio. Then, as I said, we have more the pick and shovels play. We have some, as I said, cable wire names. We have Polycab. We have a lot of companies in power equipment. We'll probably look at some more opportunities in transformers. So we are more in the pick and shovel play as far as data center is concerned. And I think it's one place which will continue to see a lot of traction.
But can you identify 1-2 good names where there's value at current levels?
So as I said, if we have Polycab in the portfolio, we have Hind Rectifier eventually, which should get some play of data center at some point of time. Right now, it's a bit of a more railway play. We're looking at some chemical companies, which is linked to the semiconductor part, because it needs, the wafer needs a lot of treatment through chemicals, both in terms of purification and testing. So that also we are looking at.
Thank you, Gurmeet. Always a pleasure chatting with you, and you enjoy your weekend. It's been a busy week. Thank you very much for joining in. We'll slip into a break. On the other side, Jitendra Arora, Chief Equity and Fund Manager, ICICI Prudential Life Insurance, will join in. Stay tuned.
Welcome back. Well, this is news coming in on ABB because the presentation has just come out and the stock actually has come off from the top. I think it was at the high around 6,250. It's come off drastically. That's because the margin adjusted for Forex as well as labor code, it's actually at around 15.5%. Now, that's lower than the 17% that the street was working with. So that explains why, in fact, you're seeing a bit of a dip out there. And the 1.7% EBITDA margin gain in Q4. That's because of Forex as well as commodity gains. And remember, if you look at it on a year-on-year basis, there's a Forex gain this time around. That compares with a Forex loss. So that's why the stock actually has come off close to 200 points from the highs of the day. Just a few minutes ago, I think we have the presentation that got uploaded on the exchange, which explains why that stock, in fact, has come off. And it slipped a little bit, from around that 2:30 odd mark, 2:30 p.m. is when that presentation came out on the exchanges. So a bit of a cool off from the top is what we're seeing on ABB India. Still up 5%, but come off from around that 7-8% that we saw earlier today. Let's welcome Jitendra Arora, Chief Equity and Fund Manager, ICICI Prudential Life Insurance, who joins us on the show. Hi, Jitendra. Good afternoon. Good to see you win. How are you all feeling about the markets? I think now the biggest skew is going to be what's going to happen on the geopolitical front. We were bracing ourselves for better times, but this is going to be a bit of a roadblock for global equities. How are you all positioned?
No, so what you're saying is absolutely correct in terms of the events which have developed over last week or so on the geopolitical side are clearly concerning for the markets, and that's why we are seeing reactions of this nature, wherein you see markets down 1.5% a day and back 60-70 bips the next. So we expect this volatility to stay here for some time. And that's what we have taken into account. However, what we have noticed in the past that these events last for a particular period of time and then they tend to go away. So we are trying to do some bottom-up picking in this market wherever we feel that there is good value in the stocks from a 4 to 8 quarters perspective.
Jitendra, at ICICI Pru Life Insurance, how are you all thinking about the IT sell-off, the valuations, and where it's headed? And what are the portfolio calls you are taking?
So we, as a house, have been underweight IT for last almost 18 months to 24 months now. The call was more basis the slowdowns which we thought we were witnessing in the business per se, and that has panned out over last 6 quarters. To top that, we also thought that the valuations were on the higher side, because if you look at IT company multiples prior to COVID and the post-COVID, there was a marked difference which had come. So on both counts, we thought that it makes a case for underweight IT. In the current correction now, obviously now we are also having a closer look because valuations have now come to a point wherein there is no more excess involved. Obviously, it can still correct further. But clearly, market is much more worried about sustainability of the business model. If you think that we may have an answer, honestly, I don't think we have a answer to that as yet, because things are evolving really fast. And we are also taking it slowly. There is no hurry to act to cut that underweight position as yet. I think we will let it run because we've seen that the markets tend to stretch or overshoot on both positive as well as negative side. We'll, I think, wait for another couple of quarters unless we see clear signs that the long-term fundamentals of the business still stay intact. Then only we are going to react in a more decisive fashion and try and build position into the IT.
So how underweight are you? At an index level, the weightage of IT is 10%.
Sorry?
How underweight are you in your funds on an aggregate basis?
In various portfolios, it will be somewhere between 100 to 300 basis underweight position that we are running.
Would you, look to further bring down your IT holding?
No, at this point in time, we're not looking to bring it down further, to be fair. The bias to act will be on the act of reducing the underweight rather than trying to increase the underweight.
All right, Jitendra, what about a couple of other spaces like the PSU banking stocks? They have outperformed by a margin, if I look at it in comparison to the private banks as well. But still, there is some kind of valuation comfort. Now, it's debatable whether you want to compare it with private banks or you want to compare it with the historical averages, do you think PSU banks still have more to go?
We can see some more rally in the PSU bank space, but that is much more likely to be news-driven rather than anything in terms of fundamental performance within the entire banking space. Because I think in terms of fundamentals, they've clearly caught up where there should be in terms of fair value. Because all said and done, we are still saying that PSU banks will on an average make a ROA around 100 bips compared to anywhere between 150 to 300 bips for private sector banks. So clearly, one model is making a much higher ROA versus the other, where they make up for the lower ROAs through higher leverage. And I think that leverage is now more or less played out, given the fact that on the CD ratio, PSU banks have caught up. On the LCR ratios also now, which were far in excess of 100%. They were almost 145 to 150% last year. They've come down to on an average of around 120 to 125%, which is where a private sector bank also operates. So hereafter, in order to grow their credit, they will also need to raise much more deposits than what they've been able to do in the last 4 to 8 quarters. So I think at least on the operational side, the gap is much lesser now. But the valuations, obviously, they seem optically lower in terms of price to earnings ratio or price to book ratio. But that also has to take into account the kind of ROA these books can generate over a sustained period of time.
So when you talk to your counterparts, the foreign money managers, what is the view that they're taking on India now? Are they willing to commit money?
Clearly, I don't think that is the case yet. And that's clearly seen in the data as well, when you see that there is no sustained buying which is happening in India. And reasons are, I think, well understood there, because everybody is right now trying to get into the trades which are on the positive side of the AI or global AI narrative. So that's why we are seeing that markets like Korea, China remain the beneficiaries of the current FII flows.
Got it. Okay. All right. Jitendra, the other sector that we have been looking at is metals. And metals has been actually glittering. Even on a bad day, you see there is some kind of buying at lower levels. From this pack, what do you like? Precious metals? I mean, then how do you play that? Or is it ferrous or non-ferrous?
So there is no clear way to play precious metals in India apart from...
Gold financiers?
Gold financials, yes, but there again, the point is we see still more as a leverage business rather than anything to do a direct way to play metals. We would rather play metals for what they are, which is essentially the hard commodities. So for there, our current view is we like ferrous more than non-ferrous at this point in time, especially in the Indian market, given that the non-ferrous space, the names which are listed and which are large have their own intricacies and quirks, wherein one of the companies is not doing well in US market. The others have seen a lot of rally because of the metal prices itself, per se.
Okay, all right, Jitendra, we appreciate you joining in, giving us all of those details. I'm wishing you a good remainder of the day and have a good weekend ahead as well. Well, by the way, ABB is the stock actually that you should look at. That adjusted margin picture clearly seems to have dampened the stock, because at the day's high it was 6,250. Since the adjusted margins are actually at around 15.5%, which has an element of forex gains as well as some benefit of metal price move. That's why, in fact, the street is now coming to terms that the margins are actually 15.5% and not 17% that they were hoping for. So explains why the stock has come off drastically actually from the top, from a 10% gain. Now it's up only around 4.5%. But it's a green day, so let's find out what's going on in D Street chatter. Nimesh joins us to help us out with a check in terms of dealing room. Nimesh, hi.
Hi, Nigel. Volatile, but decent recovery from yesterday's sharp sell-off. Even yesterday, while there was a big selling, the Nifty was on almost 400 points. At least the data didn't suggest that there was massive selling from the FIs. That was exactly the feedback as well. The flows were not that bad. In fact, today there is an MOC buy basket at the leading FI desk across most of the Nifty names. So maybe that explains that you've seen a bit of a recovery in the second half, and that can probably extend in the last 30 minutes of trade because of that MOC buy. I guess the sector which continues to seeing selling pressure is IT. Persistent is down another 2%. Remember, I flagged off a few days back that maybe a large acquisition is on the card, and that's the reason why Street is a bit nervous as well in Persistent. So that's relatively underperforming. And the overall IT index has been a big loser this week as well. Technically, it's been a 400-point range for the Nifty. 25,450 is acting as a bit resistance. Big support, and 25,850 is acting as a bit resistance as well. So clearly that's the Nifty from a technical point of view. But I guess today's pullback rally, especially in the second half, is to some extent backed by a decent amount of MOC buy basket at a leading FI desk.
Stocks, Nimesh, what's caught your attention? You spoke about Persistent and a potential acquisition there, and a large one. Coforge already did that.
Yeah.
And you're saying now Persistent could be scouting for one, but what else?
So in terms of a couple of stocks, as I said, there is an MOC buy basket. Two stocks that stands out in the PSU names, GAIL as well as NMDC. Both are going to see a very decent size MOC buy at leading FIDs. So maybe the delivery volumes could be quite high in both these names today. So that's the first stock. Second stock is PVR. It's been under pressure of late, but my sense is that large part of the selling from a leading FI seems to be largely getting over. That could be a last block which can potentially clean out that particular seller in the days to come. So that's PVR. And the last is a couple of stocks in a good market where there is delivery-based selling today. ITC and Axis Bank in the large cap name stands out. There is aggressive delivery-based selling is what I understand. So high delivery volume is expected, but on the sell side in both ITC as well as in Axis Bank.
Thank you very much for that. The IT index once again is down 1%. Intraday, it had attempted a recovery, had gone back to the flat line, had erased all the morning losses. But once again, as the day progressed, you've seen the index slip, and now down 1% for the day, 2% down for the week, and 15.5%, 16% lower for this month itself. By the way, Europe is trading in the green. The FTSE is up about 0.5%. The CAC is a gain of nearly 1%. The DAX is holding up in the green. So Europe is fairly resilient right now, similar to the gains that we're seeing in India. Get into a break. On the other side, we'll get you a few BTST calls from our experts. Stay tuned.
Some kind of profit taking is what you're seeing actually from the top on the Nifty. Adani Enterprises has suddenly seen a sharp downtick. I think we should get that one up for you on the screen. Pull up Adani Enterprises. HCLTech as well has dipped into the red. Now it's down close to 100%. Quite a sharp drop on Adani Enterprises. Adani Ports as well has slipped actually. So the Adani group has come in for some profit taking. Adani Ports, Adani Enterprises, both of them have moved down, and they moved down in the last few minutes as well. Bharti Airtel is the other one that's seen a little bit of a slippy slide. Let's get Mitesh Thakkar back with us on the show. Mitesh, on the Nifty Bank first, tell us what are the levels you're looking at out there, because if the Nifty needs to move up, then needs to bank on the Nifty Bank. So if you could help us out with that and fresh 2 picks.
I think very well said. In fact, it is the bank Nifty, it's not fallen. That's how the Nifty is still sustaining above, let's say 25,000 on the low of 24,825, which we made on the budget day closing low. So I think it's the bank Nifty which is showing strength, and the levels on the upside are 61,500, which was tested yesterday morning, and then 61,950, 62,000. The texture of the banking names as well as financials, I think, remains strong, and that is what is keeping the Nifty on hold. And if the Nifty bank starts to go, then I think I'll consider a test of at least 25,100 on the Nifty index itself.
Any BTST calls for the weekend?
Yeah. Canara Bank, I mean, you were just talking about the banking names. Canara Bank is at the day's high. That's looking good, and would suggest a target of around 158, and a BTST with a stop at about maybe 152.5, 152.4 is what I would expect. And a negative or a sell side call on Dalmia Bharat Cements. SCBT here with a stop at about 2087, which is just about the day's high, and a target of around 2030, 2025.
Thank you very much for that. In case we don't speak again, enjoy your weekend and look forward to our Monday chat. Thank you once again, Mitesh, for joining in. Let's talk about PB Fintech that's surging in trade because Kotak Institutional Equities has upgraded the stock. Now, Sudarshan is here to tell us why.
So in the recent past, the stock has been underperforming the market, and the reason is the concerns because IRDAI, that is the insurance regulator, will be coming out with the draft paper on commissions very soon. So in the last few months, if you would have seen all the regulatory firms, whether it's RBI or say Economic Advisory Council, everyone has been talking about the increased insurance commissions, and that's basically impacting the insurance penetration. And this is the reason why it has been asked to insurance regulator to have a discussion with all the insurance companies and come out with the draft norms, and that draft paper is expected very soon. And because of this, the stock was underperforming in the last 2 to 3 months. So Kotak Institutional Equities has today come out with a note that after the recent underperformance, risk reward has turned favorable. And what would be the reason that what would exactly help the stock? That's the premium growth. Basically, term plan and health insurance plan. These two form almost 50% of its total business. In Q3 FY25, premium growth was 45%. Will it sustain? Well, going forward, Kotak Institutional Equities believe that growth is expected to be around 40% as far as premium is concerned in FY27, and in FY28 it's going to be around 33%, but it will be more than company's medium-term target of 30%. So concerns will be the insurance regulator's norm on commissions, but that can be offset by the premium growth that the industry is going to see over the next few years.
Thank you very much for that. That's PB Fintech for you. And another stock which is moving up to a brokerage reaction is Lenskart, where Motilal Oswal has put a target price of 600 rupees. They believe the company has very strong moats. But the big story for the last 48 hours has been the surge in crude prices to $78 as tensions bubble in the Middle East. Will there or will there not be a conflict between US and Iran? Manisha is now joining in with the latest.
Well, thank you so much for that. Holding around those 6-month highs for the crude oil prices with 5% gains in this week, and it is up by nearly 15% for this current year. Well, as you said, there are various statements sloshing around when it comes to US and Iran. US especially now, the president saying that he's giving a 10 to 12 days, or rather 10 to 15 days of a deadline for a nuclear deal call with Iran therein. The US also, in the meanwhile, seems to be deploying largest military force since 2003. That was when the Iraq invasion happened. So this really seems to be building up in some sense. Most people that I have been talking to also says that the reason these 10 to 12 days have been given so that the US can ensure that there is no impact on Hormuz or that is not part of the strike or the deal therein. We also have a report suggesting that there has been military drills that have been done with Russia and Iran in the Oman Sea and the northern Indian Ocean as well. So all of these seems to be adding some geopolitical premium in case of prices. The stalled conversation that we've seen on Ukraine and Russia agreement as well is something that's adding premium to prices. You also have decline in US inventories by 9 million barrels in the previous week itself. So there are various factors that seem to be supporting crude oil prices right now. But what the street really seems to be working is with 3 war scenarios at this point in time. The street believes that if the US and Iran come back to table and there is conversation that is resumed yet again, you could be looking at crude prices coming back to $68, $65 per barrel. If there is no conversation but no military fight as well, then you could be looking at crude prices inching up to nearly $78, $80 a barrel. But if there is a military strike and then Strait of Hormuz is gotten in and you have Russia coming in and Israel and US are already talking, in that case, if too many countries get involved, then $100 can be a possibility as well, though most believe that this perhaps is going to be averted.
All right, thanks a lot for that, Manisha. Well, let's welcome our market expert, Anand Tandon, who joins us on the show. Hi, Anand. Good afternoon. Good to see you. When Anand, I wanted to ask you about ABP. Did you have a look at those numbers? From the morning, the street was celebrating those numbers, but the presentation came out at around 2:30 p.m. And from there, the stock has slipped. You know, I think it's slipped close to 5% from the highs of the day. Any view on this name today of ABB India that's doing well? Siemens as well has moved up. Hitachi, people talk about it being expensive at 10,000, 15,000, 20,000. It's almost at 25,000 rupees today. Your view on any of these names?
So I have not seen this particular company's results, but in general, I think capital goods is certainly an area worth looking at. Finally, the capex for private sector has moved up, but unfortunately, the market reacts very quickly. So if you see, there's a whole range of companies which are in the manufacturing space, which are actually doing very well, whether it is related to power or even in terms of other companies which are perhaps in the API space like KRN and so on. In the PLI space where they are looking at exporting capital goods. So it's certainly an area which is of interest. I have not looked at this particular presentation just yet.
Any contra view coming through on IT now?
Not really. I mean, it depends on what you mean by contra. If the idea is that you trade it on the upside a little bit, perhaps, should you be investing a significant portion of your portfolio in it? Not really. You have to remember when managements are in strong denial that nothing will change, it usually means that they are panicking. And that is what I hear them say.
So you're sensing panic in the management, the commentary that we heard from the IT companies.
They seem to be telling themselves that things are not as bad as it looks. That doesn't sound like a very confident, inspiring speech. And the reality is that, basic coding is something that is commoditized. We have to look at, and my own assumption is that we will be looking at much higher quality companies, which are much smaller, made up of people who are at the cutting edge of technology, and then a whole bunch of people who can just use the AI for applications. I don't see the companies that exist today as monoliths with 40, 50,000 people as surviving in this form and shape for too long.
Okay, all right, Anand, thanks a lot for that. Just hold on to that thought. By the way, from the broader markets, a few stocks are doing a thing of their own. Hyundai has moved to the high point of the day, so keep an eye out on that one. Suddenly, a big spurt is what you're seeing on that particular. I don't know whether that's something to do with the MOC or some kind of rebalancing, but a big up move is what you're seeing out there. On the flip side, Godfrey Phillips that has rallied very, very hard all through the week. That's come in for profit taking yet again. So that's moved to the low point of the day. It was more or less flattish. And now we're seeing a bit of a downtake. We'll slip into a short break, come back, we'll talk more about the markets and we'll wind down the week for you as well.
Welcome back. PSU banks continue to see buying, 1.5% up for the day. For the week, 5.5% surge. And this month, the index, PSU banking index, has gained close to about 7.5%. Strength visible in a PNB, Union Bank, Canara Bank is up nearly 3%. So that's a pocket which deserves mention. And Newgen Software, the up move, or the volatility and the share price move cuts both ways. Yesterday it was up 10%. Today it's fallen 10%, and it's fallen on very large volumes. MRPL too is correcting. It was one of the big movers yesterday. Today it's seeing some profit taking despite the rise that we've seen in crude prices. Anand, I remember from some of our old conversations, you used to look at textiles very closely. And then in the last 12 months, they got whipsawed, mostly on the way down because of the lack of the trade deal, the 50% tariff, etc. Now, some clarity is eased and the situation should improve. What is your expectation? Any stock that you'd like to recommend in textiles?
The same old kind of companies. At the end of the day, we are not so much a garment seller as we are perhaps a yarn seller to some extent. And of course, the garments that are being sold, they don't add too much value in terms of the amount of money that they actually make on it, but it's still a very large portion of the export. So to the extent that we have a trade deal which is not unfavorable to us currently, or so it seems, certainly it would be an area that would be of interest simply because of the fact it employs a large number of people. And therefore, you want to be able to export to the most expensive market in the world. That said, we are going to continue to face competition from our neighbors. So Bangladesh has been a problem in terms of exports. It's not like we have got quota removals. And therefore, that competition remains. More importantly, we will see a lot of textiles, etc., shifting to even lower cost countries like Africa and so on. So broadly, this is not a sunrise industry. It is something that will continue to potter around and will need significant support from the government, which it has been getting in the form of interest subventions and so on, which will allow it to actually make some ROI. Otherwise, the ROI is fairly low.
Anand, any view on Hyundai? We were just highlighting the stock before we went into the break. I recall when they came out to the IPO, there was plenty of questions. Cash being returned back to the promoter, valuations not very conducive, and the stock actually had a very flattish to a negative listing. But after that, it saw a big rally, and then it's cooled off a little bit from the top. The last few minutes, it's moved very, very quickly. I think more than 200 rupees, from the lows to the highs. And now it's cooled off a little bit. 2,300 rupees. Are you interested?
So, this has become a four-player market as far as the passenger vehicle business is concerned. And we are already seeing that even within that, the lower end of the market, there is not that much demand. So it's mostly the SUVs. Hyundai and Kia, if you were to look at them combined, have a decent portfolio, but they are not the outstanding players in that area. So from that perspective, if you are looking to play this segment, then you are probably better off staying with the market leader like a Mahindra. But that said, if you want to be in auto, I think the safer bet currently is actually the auto ancillaries, because with the auto sector in India showing signs of revival and the export market again beginning to open up, that would be an area where you'll be playing a more stable kind of demand scenario rather than just looking at the domestic cycle. It is a very high intensity, capital intensive kind of business, and with very few winners. So, it's not something that you can take a long-term bet on.
This entire data center opportunity, there is a race to build data centers in India. TCS signed its first anchor client in the form of OpenAI. Reliance Jio said that their 120 megawatts will come up on stream just in the second half of this year. And then there are other players in this system as well. Many big tech companies, there is a tax holiday. So clearly it's going to be this AI infrastructure could be a big theme going forward. Will it be a decadal theme? Is there any actionable trades, investment ideas on the back of that?
So, it's a very interesting thing that today we now have companies claiming that India's power is cheaper than in other places. For the longest time, we've had the exact reverse argument that power is more expensive in India. So if you look at what goes into the data center, land is not cheap in India. All the equipment is going to be mostly imported. We don't have either the CPUs, GPUs, memory, or any of the actual electronics that goes in. So it's land and power are the two major inputs that you will get from India. Everything else is imported. Manpower, which we are good at, is hardly used. So it is bound to be a segment which will thrive only because the government will demand that a lot of the data be centered in India. It's a regulatory driven demand, not something that is likely to give you extremely high ROI, especially since we don't own any of the technology. Now, coming to where you should therefore try and find ways to play it, I think you are better off buying companies like, Navin Fluorine. I mean, I'm not making that as a recommendation, but I'm saying those are the kind of areas that you want to look at where cooling, for example, if you've got liquid cooling as a potential market, because that is going to be one of the big areas. You might want to buy companies which can do things like that than worry about those which are simply, putting up land. I mean, it's quite hilarious to see that real estate companies are now masquerading as technology companies in the nature of data centers, given that their only capability is to be able to bribe the local government and get land and power connections.
Very quickly, yesterday, Anand Mukesh Ambani said that he will be able to bring down the cost of intelligence dramatically to make sure India is competitive. But now, given, as you said, the cost of power is high, the cost of real estate is high, especially if you're looking at it in Tier 1, Tier 2 cities. And right now, at least all the data centers are coming up in Tier 2 cities. Then is that possible? Very quickly, because we've got closing to do.
Well, I mean, Jio has the ability to do it. I don't think too many others can.
Okay. Thank you, Anand, for joining in. Just counting down to today's trading session. It's a good one. We're closing with a gain of about 0.5% on the Nifty, just shy of the 25,600 mark. So came off a tad bit from the high point of the day. The problem is the IT index. The Nifty IT index today ends with a gain of about 1%. For the week, it's lost about 2%. And it's been down now, the Nifty IT index, for the third consecutive week. In the last 3 weeks, that's basically in the month of February, the index is down nearly 17%. So IT was the problem. But other than that, you had, strength coming through in PSU banking index. That continues to be the star performer. In fact, the Nifty banking index, led by PSUs, did well. Metal saw buying. The Nifty metal index up nearly 1%. Run you through some of the big movers. Hindalco, NTPC, L&T saw buying. HUL, SBI Life, Coal India, Power Grid, Tata Steel, Nestle, and on the way down, Eternal under pressure. This week, Eternal has lost 6%. It's stealthily, come up as one of the worst performers this week. Infosys, Tech Mahindra, HCLTech. So no surprises. IT is down in that list on the way down. Mid-cap index ends with a gain of about 200 odd points. Thursday was a rough session. We managed to, rebound a tad bit today with a gain of about 0.4%. Well, we'll take your leave on this show. Thank you very much for joining in. But don't go anywhere, because on the other side is Editors Roundtable, and we're going to go full tilt on the tech sell-off and where the IT industry is headed from here on.
Anthropic's latest plugins for cloud co-work that automate data analysis trigger a slide in IT stock.
The problem is the IT stocks.
The Nifty IT is the problem. Nifty IT index is down nearly 1.5%.
1 year, 2 year perspective, we believe that Indian IT companies, they have shown that resilience in the past as well.
Stocks see a sharp slide with IT stocks getting battered after a slump in US tech names overnight.
Adoption takes time. Enterprises are very complex. They are, they are like countries.
Will you look at it as a half glass full and say, well, it's only 5%, which means look at the significant headroom for expansion.
We believe sometimes the bigger the disruption, the bigger the opportunity for us.
The Nifty IT index, which started strong, has now given out 1.8% from the high point of the day.
We're not trying to replace, replace existing industries.
Well, the global AI race has triggered a brutal sell-off, and Indian IT hasn't been spared. The latest shockwave came from Anthropic, unveiled a powerful new AI tool, intensifying fears that AI may not just assist software, but replace large parts of it. Sample this. The Nifty IT index has plunged 16% in February alone, erasing nearly 5 lakh crore rupees in terms of market capitalization. From its December peak, the index is down more than 30%. So is this a panic-driven correction and around AI disruption, or the beginning of a structural reset for IT services model? Well, over the next 30 minutes or 45 minutes, we'll decode the big tech meltdown. Hello and welcome to this edition of Editors Roundtable. I'm Nigel. With me, we have the tech expert Reema and Nimesh, who's been, peeping into all those dealing rooms, getting a sense in terms of flows. And we also have our expert, Nilesh Shah, founder, Envision Capital, joins us. Welcome to the show, guys. It's Nigel, no AI. It's actually me. And that's Nilesh.
Again, really, no, nothing.
Somehow. Reema, it's you, right?
It's me.
But what a week, guys. What a week in terms of, news flow. Tech was looking a little bit nervous. By the end of the week, you're looking at geopolitical tensions as well. But today, we're going to be discussing everything tech.
Only tech. That's why we thought we'll get Nilesh as well. He's been tracking IT for, what, Nilesh, 30 years now?
Yeah.
More than 30 years. He's been like an expert in IT for so many years now. So we always look up to you for any of the IT advices.
So we'll get further insights into it. But since you've been tracking it for so long, what do you think this time around? You have seen the fears in the past and the way they played out. This time, is it really intense? A short answer, and then we'll drill it down.
So Nigel, probably I think it's a mix of both views or the two extremes playing out. So I think there's one extreme view which says basically everything is over.
Yeah.
I probably don't agree with that, but it's honestly not. It doesn't remain optimistic. I think the challenge for big IT has been that the growth rates have been falling, and I don't see a situation or an outlook where the growth rates will come back.
Okay, got that. All right, I think I'll tell you what. Let's do one thing. Our in-house expert is Reema. Reema, take us through everything. The way things have flowed by for Indian tech, and how are things looking as of now? You have done so much of work, Reema. Day to day, we come to the studio, and Reema takes over. Reema, take over again.
Well, indeed, February has been absolutely brutal for the technology names. And it all started on 3rd of February, which is when Anthropic released Claude Cowork, an agentic tool which basically allows you to autonomously perform legal accounting tasks. And that's when the global sell-off continued. And the narrative changed from AI help software to AI perhaps is replacing software seats. So let's quickly run through the month-to-date sell-off that we've seen. Large cap IT names are down 15 to 20%. The carnage is just as deep when it comes to mid cap IT companies, with LTM down nearly 20%, Coforge down 18%, and this is all in the month of February. And if you step back from the daily charts, the damage looks even starker. From their all-time high levels, stocks are down 30, 40, 43% when it comes to the case of Wipro. And at the heart of this sell-off lies one single question. What does the long-term growth of IT look like? Given the AI disruption, is it going to be 2%? Can it be better? Can it be 4%, 5%? Can it get back to the long-term averages of 7 to 8%? Because only when you know what the growth is looking like, then maybe you can pencil in valuations, the PE, the PEG ratio. Now, brokerage house JP Morgan says that if the growth rate is 0, that's the long-term terminal average, then maybe the stocks can head down 30%. That's absolutely the bear case scenario. Now let's get to the valuation picture. Now, large cap IT companies, as you can see, stand at 15 to 17 times forward multiple. The post-global financial crisis, 2008, you saw the valuation sink to 11, 12, 13%. That was the bottom in, that's the bottom in F5, 2008. That is post the global financial crisis. FY13 to FY18 was a very slow growth, sluggish growth kind of a period for the IT companies, and that's where we saw the valuation multiples come down to about 14 to 15%, which basically means valuations today are 15, 17 times, and we're not too far away from the bottom valuation multiple of 12, 13 times. Are the valuations cheap enough, or are they just less expensive compared to what they were a couple of years back? And then there is the counter narrative. We've heard so many voices from the AI summit today, and they're saying that there's absolutely no reason to panic. There is a bit of a marketing hype right now. The Indian IT companies are in good shape. They're saying that the value of IT companies lies not just in coding. We're not just coders, but we add contextual understanding. And there's so much work to be done in modernizing legacy tech systems. Nandan Nilekani called it the tech debt. And it throws up a huge opportunity. So according to Infosys, we're talking about a $200 to $300 billion opportunity by 2030. And not just that, right? Companies are striking strategic partnerships, which means the industry is not standing still. And then just the near term, FY27 is likely to look better than FY26. So what we're going to do is try and address 5 key questions right now. 1, do IT companies face the risk of tech obsolescence? Secondly, can they pivot fast enough to capture the opportunity? They've done that in the past. Can they do it again, or is this time going to be different? 3, what do these partnerships bring to the table? Can it boost the kind of value that they do, the capabilities, and increase new areas of work? And 4th, jobs. That's the critical question, because IT is not just a sector. It contributes, 7.5% to India's GDP. It directly employs nearly 6 million professionals. So the impact of AI disruption on jobs is going to be very crucial. And finally, the question beyond IT services. There are data centers which are going to be set up. So what are the plays in the ancillary AI ecosystem? This is what we're going to try and address now in the next 30 minutes on our show with Nilesh. So Nilesh, let's begin, right? You're negative on the Indian IT sector. For how long have you been negative? Because what we've also seen is a confluence of AI disruption and macro slowdown. So since when are you, have you been negative on IT sector? And you said it's not all gloom and doom, right? It's not that there is an existential crisis. So at what point do we start looking for value?
I think the broad perception of IT is that it's a growth sector. And the challenge has been for the large caps, the big 4 or 5 companies, which have pretty much been growing in high single digit or maybe at 10 to 12%, which obviously is not a great place to be for a growth investor. So I clearly believe that if I were to kind of look at, say, over the last 30 years, every 10 years, the growth rate of the big IT companies has kept falling and falling steadily. Yeah. So right from those days of 40, 50% to 20, 30% to now 10 to 15%. And maybe we'll get into a phase where probably the growth rate will be probably 5 to 8% in rupee terms. So that's where it is. So I don't think there's a challenge of survival because spending on technology will continue. I mean, I've never heard any big company ever say that we're going to cut our spending on technology. So as long as there's going to be spending on technology, there's going to be work for our IT services companies. The challenge is only that the growth rate is going to be lower. And the current valuations are not supportive of that.
So if
change.
the growth rate is 5 to 8% in rupee terms, right, then in dollar terms or constant currency, it will be a little lower given the rupee depreciation that takes place annually. What are the appropriate valuation multiples?
I'd probably think that the big IT companies probably somewhere around 15 times trailing earnings. They currently trade at 19, 20 times. Somewhere around the 15 types kind of should be a good number. I think that would put them like at a 25% discount to the Nifty earnings. Nifty earnings will probably grow at about 12 to 15% because the outlook has changed or improved for Nifty companies. So I think versus a 12 to 15% growth rate for Nifty companies, getting 20p multiple versus that for a 5 to 8% growth rate or maybe at max 10%, probably think 15, 16 times
so
should be
about
a
a
good
10 to 15% correction from here on, assuming the IT companies, when we looked at the consensus earnings, we see it trading at 17, 18, 17, different companies differently, but broadly a 10, 15% correction would make it interesting?
Yeah, I think so. Yeah.
I want to put it the other way around, Nilesh. You've been tracking IT for so long, and you've said every decade you've seen, growth has fallen. From this 4-5%, do you see any signs of growth picking? One, and if not, how further can the growth fall? Because now we are penciling in that at a 4-5% growth, 15% multiple means another 15% fall. But if the growth has to fall to like say 1-2%, then even those P will look expensive, right? So one, are you seeing any signs of growth picking up for any companies? And if not, how further can the growth fall from here?
So I don't think growth can fall down to 1 or 2%. Okay. Because as long as the global GDP growth is at 3 to 4%, spending on technology in dollar terms will continue at 3 to 4%. So Indian IT services companies will keep growing at least at 3 to 4% in dollar terms. And I'm talking of the big companies, the big IT companies. And then you add to that another 3 to 4% of the rupee depreciation. You probably stand at about 7 to 8%. So I think that basically is more a normal.
This could be the worst in terms of growth for most companies.
I would tend to think so.
Sure. Now, so then the question is only about multiple. That what multiple a market wants to give.
One is that. Two is can growth go up because of 2 or 3 things. One is basically inorganic moves.
Yeah.
Somebody just goes and does some very big acquisition. 2 is a company like TCS has talked about investing in data centers. Let's assume that starts showing up 2, 3, 4 years down the road. That's an opportunity. Third is any of these companies unleash some solid services around computing, which is not just about data storage, but also around computing. That's one area which can lift up growth rates. So these are some of the areas which could essentially be growth lifters, which could take growth from say 7-8% in rupee terms to maybe 9-10% in 7 to 8% in dollar terms, so about 9 to 10% in rupee terms.
So Nilesh, you spoke about potential acquisitions by some of these companies to grow. We saw one big, very large acquisition by Coforge, and we've seen the market, derating the stock to some extent, and that's always been a worry in the very near term. My sense is maybe Persistent is looking for something really big. Even Tech Mahindra is looking for an inorganic move. Is that something as an investor you'll be watching out for, a potential acquisition? But again, the challenge would be if they buy something in AI, it's going to be very, very expensive. So how do you measure those things?
Yeah, so that's the dichotomy. That yes, on one hand, theoretically, an acquisition should essentially perk up growth rates. But on the other hand, so far, I can't remember any acquisition which has added meaningful value to an IT services company, say in the last 3 years, 5 years, 10 years. I mean, I can't recollect. Most acquisitions, if at all, have only basically destroyed value or probably diluted value. 2 is like what you said, if the acquisition is targeted towards AI, it's not going to come cheap.
Yeah.
And I don't think any of our companies are essentially in that mold of paying a very high valuation also. So to that extent, yes, in the short term, it can cheer up, but I'm not too sure whether it's going to add meaningful value.
Okay, all right. We've got some big questions. So let's get to the first one. The first big question we're asking today is, do IT companies risk obsolescence in an AI era? Let's hear out what the top brass at India's big tech firms have to say.
I think it's overdone. I mean, a lot of things that I've read in the social media and all of that feels overdone. But we do recognize that this is a big disruption. And if you really go after it, there are so many new opportunities. So I think as an industry, we will get through this very successfully, and that's what I believe. And we have responsibility as leaders to really make this transition happen.
AI is a very, very important multi-decadal change. Every company has to figure out, has to ask fundamental questions. What is my moat? IT services companies, rather system integrators, will have a greater job, greater responsibility. One other point, but the companies have, IT companies have to do a lot of work.
Yeah,
like every other time, they've got to equip themselves with all the skills that are required. They've got to go through that.
Well, Nilesh has already answered that Indian IT companies do not face a risk of obsolescence in an AI era. There is disruption, but not an existential crisis. So here's what we'll do. We'll slip into a very short break, but we'll come back and try and identify the AI opportunity. And if indeed the AI can spur Indian IT companies to higher growth rates. Welcome back. You're watching Editors Roundtable, and the focus is on IT and the sell-off that we've seen in the Indian tech shares since the start of this month. We already spoke about the fact that Indian IT companies perhaps do not face a risk of obsolescence or existential crisis. They're survivors. But can they pivot to capture the big AI wave and the opportunity which can push up their growth rates? Before we get to Nilesh's view, let's quickly listen in to some of the opinion that we got from the India AI Summit on this.
You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk, it's an execution risk.
The legacy modernization piece, this is a massive, large opportunity that we are seeing. In addition to customer service, one of the largest opportunities, where we are essentially taking large legacy organizations. We'll actually share a couple of examples of this, of the work we're doing at scale, and bringing them away from the legacy landscape into the modern landscape. Physical AI is something quite new, where AI software is embedded into devices, and that is becoming a growth area because everything will have AI built into it.
So there is opportunity. The risk lies in executing and not being able to capture that. Nilesh, come in on this point, right? How easy will it be for a large company? Look at TCS. Their top line is $30 billion annually, and Infosys is $20 billion. How easy will it be for large companies to pivot and capture this opportunity? Or would you bet on some of these challengers, like a Coforge, Persistent? They have managed to capture the niche opportunity in the last couple of years. So weigh in on that, and which company you think will do well and will be able to execute on this?
Yes, so clearly the big ones or the big names clearly have a bit of a challenge because obviously given the sheer size. And even if they manage to kind of do a good job, it's not going to translate into some significantly higher growth rate. So yes, the mid-sized firms would be better placed to essentially kind of take forward this agenda and create that relevance. But I think I've seen it that over a period of time, every 5, 7, 8 years, there is a new pack which emerges. And I probably think that that new pack might be kind of at a layer which is even below Persistent or Coforge.
Okay.
Because
so what's the right size in terms of revenues? Which
I would still think, companies which are probably between 300 to 500 million, I think that would essentially be a better kind of a spot to look at, where they can probably add, say, $100, $200 million of AI-led revenues, and essentially could kind of grow at significantly higher pace. I also believe that in this new world, which is the AI-dominated world, I don't think size is going to become important. I think earlier, the Fortune 500 companies would really look at saying is, okay, what's your bench? What's your head count? Do you have enough number of people? Will you be able to attract talent to be able to kind of deliver to us services within the timelines? I think in an AI world, I think that becomes irrelevant.
Okay, just one more question, what supported the Indian IT companies was their cash generation and the fact that they would give back cash. I think from FY 20 to 25, the top 4 or 5 IT companies doled out nearly 4.8 lakh crore back to the shareholders in the form of special dividends, buyback, etc. Now that they're pivoting to the AI world, TCS is making AI infrastructure investments, and everyone will do so. Do you think the capital return ratios will come down, and will that be a risk to valuations?
It will. I mean, there's undoubtedly it will. Still, I don't think these are yet meaningful investments as a proportion of the balance sheet or as a proportion of the cash.
But does it need to be meaningful?
Oh, no, I don't think. I think the market will be fine that instead of 25% return on equity, if you come down to say 18 or 20% return on equity, but if that translates into significantly higher growth, because equities is of course you need a base level of capital efficiency, but after that it's over to growth. So if that lower capital efficiency translates to better growth, I don't think that market will have a problem with that. The problem really will emerge is that when the ROE falls from say 25 to 18 or 20% and the growth does not move materially, I think that's really where the challenge is.
But these are long gestation investments. They take time to show reward.
It will probably take maybe 2 or 3 years. I think the time is all about basically acquiring the land.
So you would bet on the companies reducing the amount they give back to shareholders in the form of buybacks, special
I don't
dividends?
think they need to reduce because they'll be generating, I mean, I think the cash flow generation will still grow at 7 to 8%. I don't think there's a challenge to that. So I don't think they're going to end up kind of paying out less unless they kind of materially size up from here. Saying, okay, fine, so far we've made an X amount of investment in data centers, we're now going to increase it to 5X or 10X. That's something which can impact cash payouts. But I think at the current levels of what's already announced in terms of investments, I don't think that's going to materially impact cash payouts.
Okay.
So Nilesh, not specific names, but give us 1 or 2 things that you'll be watching out for very, very closely for you to turn positive on these IT names, whether it's large cap, mid cap or small cap. Two things that you'll be watching out very closely. What would be those?
I think the single important metrics to really watch out for right now basically is that if a company announces an AI implementation kind of a contract,
okay,
and if that's something which is materially in context of its existing size, let's assume there's a company which is at say $200 million of revenue and says, I've now won a contract which is basically $100 million to be executed over. And keep in mind, I think in the case of AI implementation, the project period is not going to be very long. It's not going to take a lot of time.
Yeah.
So to that extent, if there's a $200 million revenue company which says I won a $100 million contract to be executed in say the next 2 years or so, I think that would be a significant kind of a development. I think that's something which one needs to really watch out for.
Interesting.
Okay.
Yeah.
All right. I'll tell you what. We'll wrap up on this TV edition of Editors Roundtable. But on the other side, we'll continue answering all the big questions around AI and IT on our YouTube channel. So stay with us.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. A Friday rally helps the Sensex and the Nifty close in the green for the week, but the IT sell-off continues. The Nifty IT index has lost 17% in the last 3 weeks. Crude oil prices remain in a state of flux. U.S. military build-up near Iran continues to grow. President Trump says prospects for a deal with Iran will be clear within 10 to 15 days. Iran's foreign minister says the U.S. is risking a major crisis. Commerce Minister Piyush Goyal says the first tranche of the India-US trade deal is likely to be operationalized by April. The U.S. Ambassador to India, Sergio Gore, says an executive order to reduce tariffs on India to 18% includes a number of aspects and will happen soon. Officials from India and the U.S. are in close touch over the purchase of oil from Venezuela, says the U.S. ambassador. Adds, U.S. has seen India diversifying its crude imports, and President Trump wants countries to stop purchasing Russian oil. India signs the Pax Silica Declaration in a significant move to strengthen technology partnership with the U.S. Pax Silica is a U.S.-led initiative aimed at securing supply chains for AI and critical minerals. NVIDIA is close to finalizing a $30 billion investment in OpenAI, replacing a previously announced $100 billion multi-year partnership. This as per the Financial Times. Sam Altman sidestepped a question on NVIDIA when asked by CNBC TV 18, but reiterated the company needs more compute. I cannot guarantee AI will create more jobs than it destroys, says Anthropic CEO Dario Amodei. Adds the AI industry needs to be honest about the jobs challenge to address the same. That's a CNBC TV 18 exclusive. Swiss pharma major Novartis to sell 70% stake in its India unit to Chris Capital for nearly 1,500 crore rupees. Chris Capital will also make an open offer for an additional 26% stake. Novartis India shares rally in trade. The UK police searched the Royal Mansion as investigation over Andrew Mountbatten Windsor's dealings with convicted sex offender Jeffrey Epstein continues. The brother of King Charles was released 12 hours after his arrest yesterday. President Trump announced his agencies will release whatever files they have on the search for alien and extraterrestrial life. This comes after comments from former President Obama went viral this week. Obama has since clarified that he has not seen any evidence that aliens have made contact with us. Well, let's start with the day's market action. A positive close to the week on the Lal Street, with the Sensex gaining over 300 points and the Nifty adding about 100 points, reclaiming the 25,500 mark. Mid-caps also rose in tandem, closing about 300 points higher, 0.5% of a gain there. But that's the Nifty IT. That is where we're seeing pain, and that pain continues. 300 points lower there on the Nifty IT. IT stocks are seeing the pressure. The Sensex and the Nifty managed to close the week in the green, but the Nifty IT index has lost over 2%. It's lost nearly 17% in just the last 3 weeks, as fears of the AI disruption hurt sentiment. Now, TCS down 14%, Infosys is down 17%, HCLTech is down 15%, Wipro down 20%, and Tech Mahindra is down 15%. That tells you the story as far as the IT pack is concerned, the meltdown that we've seen this month for IT stocks. But the industry is not pressing the panic button yet. From N. Chandra of Tata Sons to Nandan Nilekani at Infosys, industry says the AI disruption presents an opportunity for the IT industry. Anthropic CEO Dario Amodei spoke exclusively to CNBC TV 18 and said his company is not trying to replace industries and instead wants to work with all IT companies in India.
AI is a very, very important multi-decadal change. Every company has to figure out, has to ask fundamental questions. What is my moat? IT services companies, rather system integrators, will have a greater job, greater responsibility. One other point, but the companies have, IT companies have to do a lot of work.
Yeah,
like every other time, they've got to equip themselves with all the skills that are required. They've got to go through that.
You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk, it's an execution risk.
I think it's overdone. I mean, a lot of things that I've read in the social media and all of that feels overdone. But we do recognize that this is a big disruption. And if you really go after it, there are so many new opportunities. So I think as an industry, we will get through this very successfully, and that's what I believe. And we have responsibility as leaders to really make this transition happen.
We want to work with essentially, we want to work with essentially, all the companies in India. So, we're going to aim to get partnerships with, all the household names that you could think of. They're in different stages of discussion, and Infosys was the one that was announced just yesterday. We're very, very, very excited for the partnership. I visited Infosys the last time I came to India in October.
So what will the road ahead look like for Indian IT services company? Is it all gloom and doom as the market seems to be making out to be, or is there going to be light at the end of the tunnel? We, of course, have special programming running on CNBC TV 18 addressing the big questions. In the money market now, the rupee weakened by more than 30 paise to the dollar. The Indian currency is now closer to the 91 mark against the greenback. And in the bond market, the 10-year bond also tumbled in trade. The yield spiked by nearly 1%. The money market has seen heightened trading activity today since it was closed yesterday. In the commodity space, crude oil prices on track to register their first weekly gain since January. This is on the back of escalating tensions between the US and Iran. The US has continued to amass military hardware near Iran. Addressing the inaugural meeting of the Board of Peace overnight, President Trump said that he will decide whether to launch a military strike against Iran in the next 10 to 15 days. US envoys held indirect talks with Iran on its nuclear program in Geneva this week. US Vice President J.D. Vance had also remarked that Iran did not address the red lines that have been set by President Trump in the talks.
Good talks are being had. It's proven to be, over the years, not easy to make a meaningful deal with Iran. We have to make a meaningful deal. Otherwise, bad things happen. They can't have a nuclear weapon. It's very simple. You can't have peace in the Middle East if they have a nuclear weapon. And they can't have a nuclear weapon. And they've been told that very strongly. They cannot continue to threaten the stability of the entire region, and they must make a deal. Or if that doesn't happen, I maybe can understand. If it doesn't happen, it doesn't happen. But bad things will happen.
Bad things will happen. That is President Trump with his threat for Iran. Back home, Commerce Minister Piyush Goyal has said the first tranche of the India-US bilateral trade agreement is now likely to be operationalized by April this year. Earlier, he had said it was likely to be done in March. Goyal said that the Indian negotiators are set to visit the US on the 23rd of February. Speaking on the sidelines of an event in the capital, Goyal added that the India-EU free trade agreement will be operational by the end of the year. The FTA is yet to be ratified by several countries of the EU bloc and the EU Parliament. The EU Commissioner had said that they expect it to be done by early 2027. And speaking of the India-US interim trade deal, US Ambassador to India Sergio Gore has said the executive order reducing tariffs of India to 18% will include, and I quote, a number of aspects and will happen soon. The US envoy also said that officials from India and the US are in close touch over the purchase of oil from Venezuela. Gore added that the US has seen India diversifying its crude imports, but President Trump wants countries to stop purchasing Russian oil. Here's the US ambassador.
I think we have a great relationship. I think it comes down to multiple things. The first thing is the great friendship between our president and your prime minister. The signing will happen very soon. In fact, even this week, we have both teams are talking to each other and actively getting to a place where both will be able to sign. Look, the reality is there's tens of thousands of points. We're not dealing with a small country. This is one of the biggest economies. And so we're thrilled that the interim deal is done. You have the few tweaking points that are left to do, but it's done. So the signing will happen sooner than later. We have seen India diversify on their oil. There is a commitment. This is not about India. The United States doesn't want anyone buying Russian oil. The president has been very clear on this. He wants this war to end. And so anyone who is, in a way, still involved with that conflict is something that the president wants to see come to an end in hopes of peace coming with that. On the first part of your question, that is also, there's multiple mechanisms. It's not one executive order. So that is making its way through the pipeline. The executive order specifically on oil was already signed. So that's done. The second part of it on the tariffs being rebalanced, there's multiple things. It's not just one piece of paper. It's multiple things, multiple departments, multiple areas. And so that'll also happen very soon.
Well, that's the U.S. ambassador speaking in Delhi. And it's interesting that even as the U.S. continues to maintain that all countries need to stop buying Russian crude, the imports of Russian crude by China have gone up significantly, even as imports of Russian crude by India have dropped significantly. Now, India has signed the final declaration to join a US-led strategic alliance. It's called PAC Silica. This on the sidelines of the India AI Impact Summit, and this marks a significant step towards expanding cooperation in artificial intelligence, critical supply chains, and semiconductors. PAC Silica is a US-led initiative aimed at securing supply chains for AI and critical minerals. Ashmit joins us now with more on this agreement and how it could benefit India. Ashmit, explain to us the significance of PAC Silica and how India benefits from it.
Well, to explain the significance, I'll borrow from the U.S. Undersecretary Jacob Hellberg, who was present as a part of the signing ceremony alongside U.S. Ambassador Sergio Gore and Indian IT Minister Ashwini Vaishnav. What Jacob Hellberg essentially had to say is that increasingly they are seeing that there are economic levers being used to pressurize sovereign nations, that is something that cannot be permitted, that economic security now in today's times is the same as national security. And to that end, we saw this PAC Silica initiative being launched by the United States in December 2025. The fact that it comes after the critical minerals crisis is no coincidence. While there was no reference made to the country of China, there's a very clear indication that there are certain levers being used by countries which are pressuring other countries. And to that end, the US had launched this initiative of like-minded countries. So the countries that count themselves as a part of PAC Silica, including India now, are countries like UK, like Australia. We have countries like Israel, Singapore, Japan, South Korea. These countries are increasingly forming an alliance for all things related to AI, for all things related to semiconductors, for all things related to critical minerals. There's a growing concern among these countries and a growing understanding as well that there's a need for interdependence, that one country can't do everything, and to that end, ensuring that there is greater cooperation. What this essentially means for India is that there is now a clear runway when it comes to supply of advanced chips. India is in the midst of a data center build-out. This is something that will be important. India is also in the midst of a semiconductor build-out. We've already seen 10 facilities being approved. ISM 2.0 is around the corner. This will also ensure greater cooperation between countries like the US as well as India. So a net positive as far as India is concerned. And what that translates into, in fact, we met up with Mr. Sanjay Mehrotra, the CEO of Micron Technologies. Let's hear what he had to say.
I think it's a great summit bringing together leaders from all around the world, business leaders, government leaders, and PAC Silica is a great example of US and India technology collaboration, particularly advancing semiconductors and building AI infrastructure.
What are the benefits, sir, that India can hope to realize from this association with PAC Silica?
And of course, focus on semiconductors, building advanced supply chains, partnering with US, and together building the infrastructure for AI and the future for a future for all good for humanity.
And there's more from the India AI Impact Summit. Adobe Systems CEO Shantanu Narayan says India has leapfrogged several nations in AI adoption. Speaking with CNBC TV 18, Narayan said Adobe is betting big on India's AI ecosystem.
It's been amazing. When you see the excitement around AI, I think India has really dramatically leapfrogged others in terms of adopting digital technology. And so when you see the monthly average users of all of these new technologies, it's clear that India is shepherding and leading that revolution. And so the first and foremost that I'm excited about is the fact that people are saying, that they want to understand how AI can improve whatever profession they're part of. So that's exciting.
Finally, India and United States have agreed on an interim trade deal. That's a big relief. Your thoughts on how this could bring businesses together and give more certainty to businesses on both sides?
Well, I think at the end of the day, it's the power of the two economies. I mean, business speaks. And when you take, the country that has the highest, sort of GDP in the world, and you take a country that's rapidly getting there, magic is going to happen. And so I'm actually really pleased that that's behind us, and we can focus on continuing cross-border trade.
Well, that's Adobe's global CEO Shantanu Narayan. And venture capital firm General Catalyst has promised to invest $5 billion in India over the next 5 years. The announcement comes after General Catalyst raised $8 billion for a global investment fund aimed at supporting startups. That was in October of 2024. Speaking to CNBC TV 18, CEO Hemant Taneja said the company is betting big on India because the next generation AI companies will thrive in the country.
It's been great. It's been exciting to see all the amazing people that have centered here, and I think Prime Minister Modi did a great job. I think it's been
okay. So
it's
what
been
is
exciting.
your expectation from India as a market when it comes to AI?
I expect it to be very vibrant in terms of next generation AI companies, and that's the reason we decided to expand our investment in India.
Okay.
With the announcement we made yesterday.
So there were a lot of announcements today in between India and US and the other markets as well. How do you feel about that from an industry perspective?
I think it's good. I think you want to see the US, European, Indian ecosystem getting stronger and more connected, because you need to see infrastructure across these geographies working together to make sure there's a democratic AI economy.
Well, that's General Catalyst Hemant Taneja on that fresh $5 billion commitment to India. NVIDIA is in talks to invest up to $30 billion in OpenAI. Now, this investment could value the startup at $730 billion. This investment will be separate from the $100 billion infrastructure agreement that both companies had announced last September. Reports have further stated that the $30 billion deal is not final and the details are still subject to change. While speaking to me at the AI Summit, OpenAI Sam Altman sidestepped a question on NVIDIA but reiterated that the company needs a lot more compute.
Those are big issues, but the number one issue being asked of leaders like you, how sustainable is this business model? The gargantuan spends that companies like yours are making, is it code red at this point in time?
I think, I may be wrong, but if AI stays on the trajectory that it appears to be on, I think we will say, man, we wish that people had invested more earlier and built out more infrastructure earlier. Clearly, the industry is making a very big bet on this mission of democratizing AI. That's part of why we think we need to invest so much, and we need to make AI so inexpensive, so abundant, so good, such that people can use a ton of it for whatever they'd like.
Do you feel comfortable where you find yourself financially today?
I wish we had more compute. Yes, I feel...
Will you have more compute, and what's the latest as far as the deal with NVIDIA is concerned?
We are building compute as fast as we can. Yes, we'll have more compute over time.
We will have more compute. Sidestepping the question on the deal with NVIDIA. That's Sam Altman in a CNBC TV 18 exclusive. Time for us to head into a short break, but up next, Swiss pharma major Novartis to sell 70% stake in its India unit to Chris Capital for nearly 1,500 crore rupees. That and more when we return. Shares of Novartis hitting the upper circuit today after the Swiss pharma major Novartis said it plans to sell 71% stake in its India unit to Chris Capital for nearly 1,500 crore rupees. This has been long pending. Chris Capital will also make an open offer for an additional 26% stake. After the transaction, Novartis AG will cease to be the promoter of the company. The acquirers will assume control and be classified as the new promoters. In fact, speaking to me at CNBC TV 18 in Davos, Novartis CEO Vasner Simon had said the company's commitment to India was absolute. The sale of Novartis India does not mean that Novartis is pulling back from India. Take a look.
It's really interesting how much focus there is on our company structure.
Yeah.
It doesn't change Novartis' commitment because Novartis AG is committed to India. These are all kind of structural things with our legal entities. So no change in the strategic review of how to structure ourselves. But the most important message I would want to get to all of the viewers, Novartis' commitment to India is absolute. We have over approximately 10,000 people now. We have 25 years in the Hyderabad area now with our Novartis corporate center there. And that commitment is long-term, and that's not going to change.
Well, that's Novartis' global CEO Vasner Simon. Shares of Ola Electric fell to another record low today. The stock has fallen 14% this week and nearly 57% in 1 year. Sudarshan is standing by with what looks like a very difficult road ahead for the company. Sud.
So in the recent past, the stock has been underperforming the market, and the reason is the concerns because IRDAI, that is the insurance regulator, will be coming out with the draft paper on commissions very soon. So in the last few months, if you would have seen all the regulatory firms, whether it's RBI or say Economic Advisory Council, everyone has been talking about the increased insurance commissions, and that's basically impacting the insurance penetration. And this is the reason why it has been asked to insurance regulator to have a discussion with all the insurance companies and come out with the draft norms, and that draft paper is expected very soon. And because of this, the stock was underperforming in the last 2 to 3 months. So Kotak Institutional Equities has today come out with a note that after the recent underperformance, risk reward has turned favorable. And what would be the reason that what would exactly help the stock? That's the premium growth. Basically, term plan and health insurance plan. These two form almost 50% of its total business. In Q3 FY25, premium growth was 45%. Will it sustain? Well, going forward, Kotak Institutional Equities believe that growth is expected to be around 40% as far as premium is concerned in FY27, and in FY28 it's going to be around 33%, but it will be more than company's medium-term target of 30%. So concerns will be the insurance regulator's norm on commissions, but that can be offset by the premium growth that the industry is going to see over the next few years.
Right. So also talking there about PB Fintech, which has been facing issues of its own. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC TV 18. Stay tuned. We're back in a minute with more.
welcome to the CNBC TV 18 exclusive. I'm Shireen Khan, and we've got probably one of the biggest headliners here at the India AI Impact Summit, OpenAI Sam Altman. Sam, great to have you join us on CNBC TV 18. It's wonderful to see you here back in India. You were sharing the stage with the Prime Minister just a few moments ago, talking about how important India is. But how significant is India for OpenAI specifically? It is your second largest market today.
It is our second largest market, and the energy here that people are what people are building with the technology is just amazing to watch. We have more than 100 million weekly active users of ChatGPT. This is the fastest growing market for Codex. And it's amazing to see the energy here. Every time I come, it feels like it's gone up another level.
You know, Sam, you've also shared the stage with Pratyush Kumar of Sarvam. The last time you were here, there were questions being asked on whether India can do an LLM. Have you had a look at what Sarvam has been able to put out?
India's, yes, but more generally, India is just building incredible AI, the entire AI stack. From like data centers to models to applications, and I think there's no country in the world quite matches India for total AI energy.
Sam, can you give me a sense of what we can expect now from OpenAI for India? How much can you customize OpenAI and ChatGPT for India? What should we expect?
The number one request we get is better support of local languages and dialects, which is something we're hard at work on, and we're open to taking any other requests if you have some.
Is that something they're going to double down on?
Yeah, we're hard at work on that already now.
Okay. You've just announced a partnership with Infosys, with TCS, and of course you're going to be one of the first clients as far as TCS's data center is concerned. What do you envisage as far as that relationship and that partnership is concerned? And do you believe you're likely to ink more partnerships here in India, especially on the enterprise side?
Totally. Hard to overstate, as I mentioned earlier, how much energy there is for building AI and building with AI in India. And I think you should expect to see more partnerships and much more activity here as we try to work with the Indian people to bring AI to the rest of the world in all of these amazing ways.
You know, you talked about democratizing AI. You also talked about AI and the need for regulation, or at least a watchdog akin to the nuclear watchdog. You talked about the IEA. That's an interesting comparison, or an interesting analogy that you made.
Well, I think all historical analogies are imperfect because every technology is new, every moment is new. But the thing that I like about the nuclear analogy is it was something that the world really did come together on, even countries that normally don't like each other very much, and figured out how we could address the serious concerns of misuse of the technology, but also figuring out how to share the benefits and get nuclear energy out into the world. So IEA has been imperfect. Nuclear technology is an imperfect analogy for AI, but it was a moment of real global cooperation.
Well, you know, you're expecting countries to cooperate, but companies are unwilling to cooperate at this point in time. It's a war out there in the valley, isn't it?
In some ways, yes, but around AI safety and AI alignment, I find the companies to be pretty collaborative.
Mm-hmm.
Same way for countries. I think countries will economically compete, but when it comes to safety and stability, I expect they'll collaborate.
You know, those are big issues, but the number one issue being asked of leaders like you, how sustainable is this business model? The gargantuan spends that companies like yours are making, is it code red at this point in time?
I think, I may be wrong, but if AI stays on the trajectory that it appears to be on, I think we will say, man, we wish that people had invested more earlier and built out more infrastructure earlier. Clearly, the industry is making a very big bet, but when we look at the economic utility of these models, as these models start to be able to create such value on their own, you know, we are again kind of running out of capacity, and I expect that to happen many more quarters into the future.
But, you know, what kind of investments do you believe are going to require? You're saying that this is not enough. What we're already seeing is not enough, and that's trillions of dollars being poured in at this point in time.
You know, in some markets, you can say, what's the total market? What's the total market? What would be enough? And then there's some other markets where demand is very correlated to price. If we can make intelligence very cheap and very abundant, I think there will be huge amounts of demand. If intelligence is limited and very expensive, there will be less demand. So I think you can talk about how much would be enough at a certain level of capability relative to a certain price, but in the abstract sense, it's hard. On this mission of democratizing AI, that's part of why we think we need to invest so much, and we need to make AI so inexpensive, so abundant, so good, such that people can use a ton of it for whatever they'd like.
But what is it going to eventually mean as far as your own bottom line is concerned and monetization? I mean, you've brought in ChatGPT ads with the purpose of being able to monetize and make the business model more sustainable. I know you had a comment to make on the ads that Anthropic put out, calling them crazy dystopic, but that is a fear that people have with what OpenAI can potentially do on that front.
Yeah, if we were, well, there's two parts of the question. There's sort of ads and then business models. I'll do ads first. I think if we were doing what those ads said of, having the AI response and give you a different piece of advice based off of who was paying, that would feel really bad. So our first principle of ads is we won't do that. But like a lot of other, most of the rest of the consumer internet, I think ads in a certain way, in a certain place can make sense as a model and helps democratize it to people that otherwise wouldn't pay for the subscription but still want to use a lot of AI. On the business model question more broadly, I think we're really starting to see enterprises realize how much they should be willing to pay for AI agents that can help do part of their workload. And my sense is we will see phenomenally huge growth there pretty quickly.
So do you feel comfortable where you find yourself financially today?
I wish we had more compute. But yes, I feel...
Will you have more compute, and what's the latest as far as the deal with NVIDIA is concerned?
We are building compute as fast as we can. Yes, we'll have more compute over time, for sure.
OpenClaw and the pivot towards more agentic future for you specifically, are we likely to, A, how do you use that? B, are we likely to see more acqui-hires from you?
So the models are getting good enough. We still have a lot of issues around safety and sort of security to solve with an OpenClaw-like approach, but I think OpenClaw is the most exciting thing to happen in the AI space in quite some time. And this vision of the models getting good enough that you can have a local agent running for you on your computer or a different computer and do all of these amazing things is really quite remarkable. It feels to me like one of these moments where we unequivocally get to see the future. In terms of will we do more deals like that? Yeah, probably. I mean, not a lot, but I would expect there'd be some more in our future.
IPO in 2026?
I don't know.
The visibility for that?
Presumably, OpenAI will be a public company someday. In terms of timing, there's like a lot of factors at play, and obviously this is a super dynamic world.
GPT-6?
Presumably that will happen at some point too. I don't have a date to share with you yet.
In the first half of the year?
I don't know when we're going to call something GPT-6, but the model improvement trajectory remains extremely steep. If you look at the progress from 5 to 5.1 to 5.2 to 5.3 in Codex, what I would say is, names aside, you can expect a trajectory like that to continue.
You know, you said in your speech that there's a lot that we know, but there's a lot that we don't know. Yeah. What worries you about the stuff that we don't know?
Well, I'll stick with OpenClaw as an example because, again, I just transfixed with how exciting it is. There was a really interesting example of emergent behavior there where you would see people's agents interacting and doing things together in a way that many people didn't predict or didn't have good intuitions for. And I think there will be a broad set of emergent behavior around very complex multi-agent systems in the economy, in society, in new kinds of social networks. And I don't know if I'd say worried about that, but I feel like the fog of uncertainty there is very thick.
Jobs, and I think that's what regular people are worried about, and that's the number one anxiety at this point in time. And every day you pick up the newspapers, and there's tech CEOs like you saying that it's going to be the end of jobs, at least in some sectors as we know it today. How much of this is, you know, AI washing of jobs at this point in time? How much of it is real displacement or on account of AI?
Yeah. I mean, obviously it's both. I don't know what the exact percentage is, but there's some AI washing where people are blaming AI for layoffs they would otherwise do, and then there's some real displacement by AI of different kinds of jobs. I expect we'll see more of the latter over time. Of course, we'll find new kinds of jobs, as we do with every tech revolution, but I would expect the real impact of AI doing jobs in the next few years to begin to be palpable.
Let me end by asking you, Sam, as a CEO running OpenAI today, you're obviously excited about the potential of this technology. As a parent, are you equally excited or are you also more concerned?
Well, I'm more excited to be a parent than run OpenAI, but those are the two great joys of my life in that order. But I think you meant, like, am I more excited or concerned about the AI impact on my kids?
And humanity in general.
Yeah. My kids will never grow up in a world without AI. They will never know that there was a time, I mean, they'll know about it, but only because of reading history books, that there was a time where every computer, every system they used wasn't smarter than them. And So I think it's going to seem very normal to them. I think it'll feel stranger to those of us that lived through the transition. I expect the future to get far better. There are real downsides. You can imagine things going wrong. We'll have to mitigate those like we have with lots of challenges throughout history. But the trajectory of human progress and the world getting better requires each generation to keep inventing new technology, to keep strengthening society. And then people can do more and build more stuff. And I'm excited for my kids to live in that world.
Sam Altman, a pleasure. Thanks very much for joining
you.
us here in India, and we wish you the very best of luck with the rest of your trip and your plans for OpenAI. Appreciate you joining us here.
Thank you very much.
Well, we are going to take a break. The headliners will continue here on CNBC TV 18. We're back in a moment with plenty more. Stay tuned.
Welcome back. The headliners continue here in the CNBC TV 18 studios at the India AI Impact Summit. It is my pleasure to welcome into our studios Dario Modi of Anthropic. Dario, many thanks for joining us here on CNBC TV, and it's great to have you here in India. You know, you've been talking about the energy, the palpable energy that you've been soaking in here in India. Let me start by asking you about the significance of the India market for a company like Anthropic.
Yeah, well, thanks for having me. I mean, I think the way we think about it is, Anthropic is a company that tries to work with other companies, right? We're not primarily a consumer company, we're primarily an enterprise company. And so we succeed when our customers succeed. And those customers can be individual developers, they can be startups, they can be large enterprises. And all of those exist to a really great degree in India. I've gone to events for individual builders. I've gone to events for startups who are just starting out, and of course we've met with both here and on my previous trip some of the biggest companies in India. And in all the cases, our philosophy here is how can we work together in a way that not just benefits Anthropic but also benefits the companies we're working with. Right? Many of the companies don't have as much AI expertise, but they have a network in India. They have distribution. They know the Indian market. They have expertise that's complementary to us.
Dario, what we've seen starting the 6th of February in the Indian stock market is a bloodbath. The Indian IT services companies have taken a large knock, really on account of what Anthropic is doing with Claude. Now, are you a bad dream or a nightmare for the IT services companies?
We certainly don't want to be. I mean, the stock market can move for all sorts of reasons, but I think our intent is that if companies work together with us in like a positive way, they can gain a lot and we can gain a lot as well, right? We're not trying to like replace replace existing industries like.
But can you? You're not trying to, but can you?
I mean, again, there's different ways things can go. And our hope is that we can work with these companies. We build models, we build products on top of those models, but also companies can further build on top of those products. They can distribute those products. They can, I think of it as Lego building blocks, right? Like, we're not saying like, okay, we put together a few Lego blocks and that replaces everything. We're saying, okay, here are a few Lego blocks and you can continue to build. You can continue to extend on them and, build things that make sense for a particular industry or for the Indian market in particular. And, I think that's the vision we're going for. Now, inevitably, I think there's going to be some disruption, not related to any particular company or particular industry, but we relate to the technology in general because it's moving so fast. But what we aspire to, what we try to make happen is for there to be more examples of us working together with companies and enhancing the joint value than we produce together. Then there is disruption, although inevitably there will be some disruption.
Inevitably there will be some disruption, but more partnerships. You've announced one with Infosys. Would you believe that more partnerships in India with enterprise customers like Infosys on the cards?
Yeah, we want to work with essentially all the companies in India. So we're going to aim to get partnerships with all the household names that you could think of. They're in different stages of discussion, and Infosys was the one that was announced just yesterday. We're very, very, very excited for the partnership. I visited Infosys the last time I came to India in October, and of course I was I just did a fireside chat at the Impact Summit with Nandan, chairman of Infosys. But we're excited to work with all the companies to to work with them in a way that allows them to grow with us.
Dario, you've been calling out the risks related to AI, not just the disruption for the jobs market, but issues related to security and so on and so forth. But let's address the jobs question, because you believe that 50% of the entry-level jobs may no longer exist over the next 3 years. But there are others like Meredith Whittaker at Signal who believes that it's not so much elimination of jobs as much as it is displacement or an invisibilization almost of jobs at this point in time. How much do you believe that we're likely to see an elimination? How much of it is going to be displacement? And how much of AI washing are we really seeing when we talk about job losses today?
Yeah, so, I think it's really hard to predict. The economy and economics is hard to predict. So it's hard to say, will jobs go away, or will they be downskilled, or will they be moved in kind of a different direction? So the exact form that it takes, I don't know. What I do know is there will be potentially a lot of disruption because the technology is moving so fast. What is different about AI than previous technologies, it's not any different in that, there's some things humans could do before that, this new technology is now able to do, that's able to replace parts of it or all of it. What's different is it's moving quickly and it's broad because AI is a general technology. And so what we need to do, I think, more so than trying to figure out exactly what form the disruption will take, is help people to adapt. I will give an example. I can see the day when, even within, say, Anthropic, we need less software engineers than we have today, because the models are better at automating software engineering end to end. But we've been thinking hard about, what are jobs that those people could do? And, one thing is, there's this notion of the forward deployed engineer.
Yeah.
Someone who has technical skills, but who works with customers to enable technical systems and technical solutions with those customers. And as Anthropic grows and has more customers, there's going to be a need for a lot of them because the number of customers we need to talk to is large. And so that's one possible example where one thing goes away, but another door opens to take its place. And, I can't guarantee that more jobs will be created than are destroyed. We have to make that true. We have to figure out how to make that true, and it's going to be a challenge. But the earlier we see it, the more we're honest about it, the better the chance we can address it.
I want to talk about the agentic revolution that everyone's sort of all in on at this point in time. And again, you call out the risks, and you believe that it's probably inevitable that we will start to see selfhood as far as these agents are concerned. Now, are we prepared for that future? You're stress testing agents at this point in time, and there are some pretty concerning things that have come up. Are we prepared to deal with that?
Yeah, so I would say things are going too fast and we are not yet prepared. And we need to ramp up, for all that. Every time we release a model, we have, 200 pages of analysis of these various stress tests that you mentioned, where we put the model in extreme situations, and see if it lies, if it blackmails, if it tries to gain power. It does that if you push it enough. I would think of it more as like, you're developing a car and you do a crash test of the car and you say, okay, well, let's make the car go really fast and let's put it on an icy road and let's make it turn a lot. And then, then you kind of see these horrific crashes. So these are not things that are happening in the real world, but there are things that could happen as the models get stronger and as they're put in extreme situations. And so we do everything we can to test for and to steer the models to not display these behaviors. But because progress is going so fast, I think we actually need to up our efforts even more than we have before to make sure that we are able to characterize and reduce these behaviors, and it is an area of concern to me.
Well, let's talk about the real world. IPO in 2026, working towards that?
I would say our focus is on trying to serve our customers as best we can, build our models as best we can, as we've seen. Financing in this field, requires a large amount of money, and there's different directions to get that money. But we don't have any definite plans for exactly when we will do or not do
You've
something.
just raised a significant amount of money, $30 billion. Is that enough runway at this point in time for the kind of growth plans that you have?
I mean, the technology is really, because the revenue is growing so fast, the needs for building data centers a year or two ahead of time are really great. And so, I would say, strange as it sounds, 30 billion helps with that, but the capital needs of this industry are actually, even in excess of that.
Making money. When are we going to companies start to make money?
Yeah, so, the economics of this field are interesting. What I would say is actually that every model we build, so, you imagine the company builds different AI models, right? Different versions of it. Every model that we build, if we take the amount that it costs to train the model and the amount that it costs to serve the model to customers, and subtract all of that from the revenue that the model gets, every model that we've made is actually profitable. The issue is that we're spending more money to train the next model. And so I think companies, including ours, will be profitable at the moment when we're no longer scaling up, the next model so much. So at some point, things will reach some kind of equilibration. And then I think us and perhaps the other companies in the space will be profitable.
You know, I want to end by asking you about something that's in the news, the possibility of Anthropic being blacklisted by the Pentagon. Have you been in conversation with the authorities there? Is there an update on that you can share with us?
So we've been deploying our models for U.S. national security for quite a while. And, I think our basic position on it is, we've offered the models in kind of a very wide range of, for a very wide range of use cases. And, I think the main areas of concern that we have are, fully autonomous weapons where there isn't a human in the loop, and domestic mass surveillance of Americans. So those are the two areas where we have some concern, and we want to make sure the models are not used in that way. And we continue to have productive discussions about how to use our models for almost every use case. But while taking into account, I think these red lines are fairly important for making sure that AI is used in a way that's compatible with democracy and in line with the culture of our company. We're just attempting to make sure that we deploy our technology in a way that's compatible with and advances democratic values. The whole point is to defend democracy, and we continue to have productive discussions around this, and we're very excited to help national security of the United States and other democracies.
Dario, I'll end by asking you, 2026, the breakthrough that you expect to see.
I don't know that it'll be just one thing, but I do think that the models will continue to get more powerful. They'll continue to get better at a wide variety of tasks. We're going to see a bunch of abilities. The models, I think, may be able to do end-to-end tasks much more than they could before in software engineering. We'll see progress in finance. We'll see progress in biomedical. We'll see progress in cyber, which I think will bring some safety and security issues. But I don't think there's going to be any one unlock. There's just a lot of momentum, and the models are getting better across the board.
Dario, it's been an absolute pleasure. Thank you so much for stopping by here in our CNBC TV 18 studios at the Impact Summit. We look forward to seeing much more of you here in India and hearing more from you about the partnerships that you intend to ink here in India as well. Appreciate your time. We are going to take a break, but the headliners will continue. That was Dario Amadi of Anthropic. We're right back with you after this.
India AI Summit isn't just about models, it is also about infrastructure that will power the next generation of intelligent applications. And to talk about that, we have right now Matthew Prince, CEO of Cloudflare, to shed some light on these conversations. Matthew, thank you so much for joining us in the CNBC AI Ed studio. The first thing that I want to start with asking you is that Cloudflare sits between a huge chunk of AI traffic and the internet, right? So how is that positioning changing as AI moves from pilot to real-world deployments?
Yeah, so 80% of the leading AI companies use Cloudflare's network in order to be fast, secure, reliable, and increasingly in order to actually power inference all around the world. So if you want to make sure that when someone is asking your AI a question, that it's fast and responsive in Delhi, in Rio, in Tokyo, in New York City, Cloudflare is the network that can allow you to do that. And so I'm incredibly proud of the fact that so many AI companies are relying on us to build the future of AI, and so much of the internet is relying on us, and being in the middle of that is just incredibly exciting.
All right, great to hear that. I also want to understand from you that you've talked about AI redefining the internet's business model and the rise of answer engines, right? So how do you see that affecting content creators and publishers in the next 2 to 3 years?
I think no matter what, the internet's business model is about to change radically. And it's, in order to understand it, you have to understand what the business model has been. For most of the history of the internet, the business model was create original traffic, or create original content, drive traffic, and then sell either things, subscriptions, or ads. And the great benefactor of the internet has been Google. And Google had a search engine, and you would type something in the search engine like, I want to figure out what the best restaurant tonight in Delhi is to get chicken tikka masala or something like that. And it would return back a list of 10 blue links. And the search wasn't over at that point. That was a treasure map. And then you as a user had to search through that to figure out what the answer was. And different sites would emerge to actually say, listen, we have the best list of restaurants in Delhi, so click on this and we'll give you reviews and information. We'll sell ads along with that, maybe help you make reservations. And that was the business model of the internet. What's happened though is that increasingly with these new AI systems, they're not search engines, they're answer engines. You ask them a question, and rather than giving you 10 blue links you have to go search through, it says, hey, the best restaurant in Delhi is X, and gives you the answer right there. That's amazing as a user, but it's putting some real strain on content creators. Ads, if the answer engines don't click on ads, they don't buy subscriptions, and the answer is right there without you having to go anywhere. And so what is the business model going to be if traffic isn't the currency of the future internet?
What is it going to be? Could you shed some light on that then?
Well, I think no matter what, we've got to find some way for hardworking journalists like yourself to still be able to eat. You should get paid for the hard work that you're doing. And so if people are going to get answers directly from the AI companies, and if the AI companies are going to be pulling all of that data from original content creators, journalists, researchers, academics, then there has to be some sort of value exchange.
Correct, true.
In the past, that value exchange with Google was they would take your content and they would send you back traffic. I think going forward, you're going to see increasingly that AI companies are going to take your content and they're going to send you back actually compensation for helping you, helping give them the information that trains the models. And that's what we're working through, and that's what we're talking to both the AI companies and the content creators about. What does that future business model look like?
Interestingly, when we talk about data, the first thing that also comes to our mind is security concerns on that front. So I want to understand that how are you reimagining AI safety tools at Cloudflare, such as AI Gateway and prompt protection, to address risks like data leakage, shadow AI, and model abuse?
Yeah, I think that what any company that's using AI needs to think about are what are their policies and how are they going to be enforced? And we provide the tools to allow a company to do that. So let's say CNBC has a policy that says, you can only use this set of approved models that we have agreements with.
Correct.
Let's say that they want to make sure that there are certain things that you can't ask the AI to do. You can't ask the AI to be, hyper offensive or act like a jerk or do those various things. What Cloudflare does is it provides ways of companies locking down access to AI so that it gets routed to both the models that are allowed, that it can be controlled in terms of what information is passed into those models, that gives some constraints so that even if a malicious employee says, "Oh, go act like a jerk," that the model can also be told, if someone tells you to act like a jerk, ignore that, right? Or if someone tells you to violate CNBC's policies, ignore that.
Yeah.
And then it can also route those requests based on what budgets are. So maybe there are very important requests that have to get done with the most expensive model, that can get sent in that direction. But something that is just kind of frivolous and fun. Hey, I need to create a fun card because one of our colleagues is celebrating their 5th work anniversary.
Yeah.
Maybe that doesn't have to go to the most expensive model in order to create something like that. And what Cloudflare is doing is we're giving companies the tools to be able to actually route and then control how AI is used and make sure that you as a company are never embarrassed by whatever the use cases are that your employees are using it for.
On the point of introducing new tools, you've also introduced features that combat unauthorized AI scrapping and even paper crawl mechanisms.
Yeah.
So does that signal a shift towards more regulated AI data access?
I think it gets back to what's that future business model going to
Yeah.
be. If the business model of content creation online isn't going to be ads, it's not going to be subscriptions, it's going to be something else, then we have to actually create a market for that. And markets need two things. One is they need demand, and the good news is there's insatiable demand. The AI companies want as much data as possible. They want to be able to learn as much as possible. They're constantly looking for new information that's out there, and they're willing to pay for it. But you also need, traditionally we think of, you need demand and you need supply, but that's not exactly right. Like, we're sitting here, there's no market for air because there's infinite supply of air. Unfortunately, online, there's been infinite supply of content for the AI companies. And so the first step to creating it is actually get scarcity. If I go scuba diving, all of a sudden there's a market for air because there's no air underwater and I can create it. If all of a sudden all of the different content creators, whether it's a journalist like yourself or someone who's just doing original art or somebody who's creating a movie, if they say AI can't get my stuff unless they compensate me for it, now you've got scarcity. And if you've got scarce supply combined with demand, that's the formula for creating a market. And so what we're trying to do is figure out what that next business model of the internet is going to be. And we don't know exactly what it will end up with, but we do know it needs two components. It needs demand, which we've got, and then what we're helping do is create scarce supply. And between those things, what we're seeing from content creators is more and more as they do that the AI companies are willing to come to them and say, what you're doing is really unique. We want it to be in our model and we're willing to pay for it.
Okay. Now, as India is pushing towards sovereign AI infrastructure and, production grade deployment, help me understand what is the role that Cloudflare can play in enabling that and scaling that infrastructure?
Cloudflare's in a really unique position to help any country that is looking for sovereign AI. And that's because we run infrastructure not only in almost every country on Earth, but in almost every major city on Earth. And so across India, we're in 20 different data centers where we can run all of our information and keep data local. That means not only when data is stored, but actually when it's processed, when inference happens. And what that allows is not only for the security and the sovereignty of the nation to be there, but also to make sure that Indian models respond as if they are India, respecting the local culture, the local heritage, the local tradition. And so we've worked—
the local dialect.
Absolutely. And
Right?
so we've worked with AI for Bharat, to be able to, which is a model that was created for all of the different languages and dialects that are spoken across India. And we've rolled that across our infrastructure so that you can actually have a Indian AI model running in India, servicing Indian customers. And we think that that's incredibly important. A lot of AI is going to happen on your device, but we think the next best place for it to happen is inside a network like Cloudflare, running as close to you as possible, usually in your same city, but for sure in your same country.
Hello and welcome to this very special conversation right from the nerve center of the AI Impact Summit right here in New Delhi. We're coming to you from our studios, the Edge AI Studio in the heart of Bharat Mandapam. And in fact, over the last few days, we've been unpacking key conversations with top tech leaders to get a sense of where we are and where we're headed. And to help us understand is with us Mike Haley of Autodesk. Mr. Haley, thank you so much for joining us. It's a pleasure to carry on the conversation that we had last evening to this morning as well. Let me begin by talking to you about the big news point, the big news takeaway. India has joined the US-led Pax Silica Alliance. What that now basically means is that this alliance will essentially act together along with other similarly placed countries to ensure supply chain resilience for everything AI, for everything semiconductor. How significant is it for AI aspirations, especially at a time when India is looking to go big on AI?
Yeah, I think it couldn't come at a better time, frankly. So thank you for having me. I honestly believe that things like chips and processing infrastructure is rapidly becoming a public infrastructure. Just we should think of it no differently than from the way we think of an energy infrastructure or a road network. Now, the reality is, as we all know, is it's arrived very quickly on our doorstep. So the systems and the mechanisms in place to ensure that there's equal distribution of this are not there today. If you go far back in history and you look at energy infrastructure, when in the time of Edison, when it was first created, it wasn't evenly distributed. It was in the hands of a few. Right. So it's very similar to what we've been seeing in the past right now with AI. So I think the fact that India has joined it is really a message now to say it's no longer confined to the shores of the United States or the shores of China or wherever it might be. It's a worldwide, phenomenon that everybody should be getting access to. But what I think is especially interesting in India is because you guys are, I think, are really leading the global South kind of in this. You are showing a way forward. I think other countries need to see India doing this. And the fact that you've done this, they're going to start mirroring what you're doing as well. So I think it gives India an opportunity to start building out that infrastructure based on Pax Silica, being able to get access to the right GPUs, but then building out an infrastructure that's correct for India. Because the infrastructure we're building in the United States does not necessarily translate. For most of my life, I've built software in the United States, and then I've seen sometimes how it gets, they try to use it in, say, the developing world, and it doesn't match all the needs because it wasn't designed there. So the fact that this enables India to design their own local AI. I spoke to the Shabam guys, looked at their local model here, the kind of stuff that they're doing. It's very, very exciting.
Let me also just get a little color on this with respect to the data center build out that India is now beginning to see. We've seen big investments already announced by hyperscalers, even domestic companies making big commitments towards that end, ensuring that there's data sovereignty. At a time when we're looking at this major data center build out here, does this alliance then perhaps give assurance in the near to medium term with respect to access to chips? Advanced chips, again, very high in demand. The costing is, of course, on the higher side as well. Does this give some sense of assurance?
I think it does. Yeah, absolutely. I mean, look, there has to be another body that starts to make this a more fairer supply chain, right? I mean, the reality that it's dominated by a few large companies right now that just have massive capitalization is creating an imbalance. So you need an organization. So I do believe it'll help. I do believe, I think a lot of the problems is not even just the cost, it's just the availability of being able to get to them, because they're being used and consumed at such a fast pace. We even I will tell you, even in the United States, as a company that trains large AI models, I struggle to get access to these things as well. So I think something that evens the playing field, that it's not purely based on whoever happens to be at the front of the line or whoever happens to have the most money, changes that. Now I will say, I don't think processing is the only part of it though, and I think something that India has going for it, which I actually didn't know about until a few nights ago, was that India actually has an enormous amount of power. There's an enormous amount of generated power. There's a lot of green power that's getting generated in India as well. So the fact that that's already there Because, I mean, even in the United States, we're trying to play catch-up with a lot of power because we're building so many data centers. We've got to figure out how we power them. India actually has a slight excess of power right now, which I think is that coupled with the availability of GPUs, that's two of your major requirements straight away.
Let's talk Autodesk specifics. You're in various domains, and those domains couldn't be further apart. All the way from infrastructure to you have movies being made. I want to talk about the latter. When you talk about movies and content being generated, how is that now changing with AI acting as a dynamic? And how does that now sit with global concerns being expressed on synthetic content? And that leading to regulations. India, for instance, from today has introduced regulations that all synthetic content needs to be labeled. Just want to get your perspective between how AI is changing creation and what that does to regulation.
Yeah, so one of the interesting things at Autodesk, because we're in so many different industries, media and entertainment is always the industry that is the predictor of what's going to happen in other industries, right? So what we're seeing that's happening there, you're absolutely correct. They are seeing the most incredible disruption. We're all seeing this right now. Now, the challenge in the media and entertainment space is there's kind of two perspectives. There's one perspective that the future of media is all going to be AI generated. We're going to put in a prompt and it's going to make a movie. And I guarantee you, neither you nor I ever want to watch AI-generated movies for the rest of our lives. It is taking away the creativity, right? So that's where the second camp lies. There's a second camp which is populated by creative professionals that are going, no, well, hang on. What if we just made better movies? What if we made better experiences by leveraging AI? What if we elevated this but still had the human creative element inside it, right? So now you've got a hybrid, right, of something that's created by AI and something that's created by humans. So that's where we're working. Where we're working right now, our customers are the movie studios, the creative people. We do not want to take creativity away. We want to make them more creative, be able to make better content faster, that kind of thing. So that's the first part of your question. Coming to your second part of the question about the regulation and like what we have to do around tracking and tracing AI-generated content. I love the fact that India has adopted this policy because we're actually at Autodesk we're big believers in putting in place the right regulations. There's absolutely the need. Now it requires governments and standards bodies to think through what are those right legislations. In this case, tagging and labeling and watermarking content as AI-generated content and letting people know that, I think is going to be essential. We're moving into a world where it's becoming, like you said, so easy to create content for manipulating people, for doing whatever, and you can make it dynamically now as well. So if we can both solve this creative problem that I talked about, but also make sure that when content is actually delivered, that the consumer of that content is clear what they're seeing, what's the provenance of that content.
Well, that's clearly something that's beginning to take shape. Mr. Haley, I'd like to thank you once again for joining us, for taking out time from a busy week. But we'd hope to continue this conversation to learn more about you, your experiences, and, of course, Autodesk. Thank you once again.
Anytime. Thank you for having me.
Hello and welcome to this very special conversation right here on CNBC TV 18. We're coming to you from the CNBC TV 18 Edge AI studio. We're coming to you from the nerve center of the AI Impact Summit. We've seen 4 days of hectic action, conversations. What this action will now translate into, what does the road ahead look like? Joining us now, we're of course joined by Ms. Arundhati Bhattacharya, the chairperson and CEO of Salesforce India. Ms. Bhattacharya, thank you once again for being a part of this conversation. Busy week for you, I imagine. But let's dive straight in. The way ahead, the road ahead is one that is dominated or will be dominated by AI agents. That's the way forward. Tell us from your perspective, what does the pace of adoption look like in terms of agents? What is the deployment looking like for these AI agents? Are they here and now? Are they being embraced by enterprises?
So if you ask me globally, yes. Globally, we have more than, at this point of time, around 20,000 customers in various stages of implementation. A lot of them have already implemented. At least 50% of those customers are refilling their tanks, which basically tell us that they are obviously using the agents. If I talk about India, I think the number of clients that we have live are lesser. Sure. But given the fact that, we are in various stages of implementation with a number of others, I think it's going to happen in India also. I would love to see it becoming a more urgent kind of agenda on the, on the things, on the roadmaps of many of our customers. Okay. But we do find that even today, a number of our customers are still sort of on the edge, okay, in the sense that they are considering ROIs, they are considering value, and they are not completely convinced that this is the way to go. Of course, the reason for that is that this is something that's so entirely new. Yes. And this is something where, you have to prove a point before everybody sort of jumps in. But I think we are now beginning to see the reportings of our earlier clients beginning to show that, yes, there is a lot of business value to it. And that, I hope, will have a knock-on effect shortly rather than in the medium term.
Which are the key sectors that are these early movers, which can then act as use cases for manifesting to other clients?
Early movers, I would say the BFSI sector, certainly. So also the auto sector. I would also say the healthcare sector. Some of these are early movers. The education sector, some of these are early movers, and they're beginning to show and also talk about the improvements that they have seen in their businesses, both top and bottom line.
From your standpoint, are they willing to make that leap and pay a premium for these AI-enabled services, these AI agents? Is that a willingness that you see?
Yes, I do see that. And some of them basically are willing enough to also become co-innovators with us, because they also realize that there is much that can happen here, that this is not an entirely matured offering, that this offering is changing by the day as we are going along, and that's how it's going to be. It's not something like, you had OpenAI and ChatGPT ruling the entire space, and then you had disruption by DeepSeek, and now you have disruption by Anthropic. Sure. So, this is a race that's not yet won, nor is it over. It's something that's revolving on a daily basis, and a lot of our clients are willing to sort of come in and co-innovate with us, which is, I think, a great thing.
You made a reference to Anthropic. I just want to borrow from the conversation Shireen had yesterday with Dario, where he talked about how February 4th was the day, which in fact caused some degree of fear psychosis as to what that will now translate into. With AI agents coming in, what happens to frontline service jobs, frontline sales jobs? Are they at risk, or do they now need to change, need to be disrupted?
I would say that they would need to change, more than the fact that they are at risk. I think today what's going to happen is the quality of conversation that these people will have will be of a different order of magnitude from the conversations that they used to have earlier. And as the quality of conversation improves, the customer satisfaction levels should also improve. Okay. One of the things that we have seen very strangely is that, our helpline is on the agentic layer. Okay. And initially we had thought that as this agentic layer becomes more and more powerful and is able to do a lot of first call resolutions, the number of calls will come down. Actually, it hasn't. It has gone up. And the reason for that is people are finding it useful to now call in and get their problems resolved rather than trying and doing it themselves. So to that extent, I believe that the use of agentic is going to increase our engagement with our customers and therefore would need people rather than the other way around.
Let me get your insight on a regulation issue. As of today, the SGI regulations come into effect, which is essentially the government norms on labeling AI-generated content. Is that becoming a bit of a housekeeping issue for you? How do you manage that?
No, I think it's something that the government is doing with full knowledge of the fact that there are risks if you don't do this. This is something, we are creating something which we are going to name, I think, maybe it's too early to make the announcement, but we are creating something called Label Force, which will actually enable you to label anything that you have used AI on. But I think it's for the best. Again, regulations are nothing is written in stone. I'm sure they will also evolve along with, our ability to do it. But at this point of time, I think it's something that is important because IP is important. You can't just take away IP by using AI and saying that I've used AI, so I should get away with it. That's not done. And so to that extent, trying and ensuring that everything is labeled, that this has been, you done with the help of AI, I think is the step in the right direction.
But is that something that perhaps requires little more flexibility to allow for smoother operations and transitioning to this new regime?
See, flexibility, at any point of time, very heavy-handed regulation will stifle innovation. So I think India has been trying to tread a very cautious path between being heavy-handed and being ethical and responsible. So again, time will show. It's not something that I can give you an opinion on right away, but I think time will indicate as to whether this is the right way to go about it or there is some other better way to do it.
Ms. Bhattacharya, always a pleasure speaking to you. Thank you for taking out time. This has been an interesting insight, and we hope to continue conversations with you to learn more about your journey ahead in 2026. Thank you once again.
Thank you. Thank you so much. Always a pleasure to be here. Thank you.
The Reserve Bank of India has released the minutes of the Monetary Policy Committee meeting that was held from 4th to the 6th of February, where the MPC unanimously voted to keep the repo rate steady at 5.25% and to continue with a neutral stance, with one member dissenting. Now, the members highlighted resilient domestic demand, improved external prospects following the recent trade deals, and broadly benign underlying inflation, while also flagging the global uncertainties that persist, as well as the pending release of the new GDP and CPI data series to assess the way forward. We're now joined by Dr. Nagesh Kumar, Director of the Institute for Studies in Industrial Development, and of course, member of the RBI Monetary Policy Committee, joining in now. Dr. Kumar, thank you very much for your time here and for joining us on the show. You know, in the minutes you've said that the economic outlook for India has brightened considerably thanks to these deals. And, you know, these developments have lifted India's economic outlook. You know, if that was the case, to begin with, why was maintaining status quo still the prudent choice for the MPC, with inflation also giving you the headroom, to cut if needed?
First of all, I must say that the Indian economic outlook definitely has brightened since the last meeting in December because of various things. First of all, the third quarter estimates and the first, provisional estimate for the GDP for growth for 2025-26 came, which were better than the expectation. The third quarter numbers suggested that manufacturing was picking up momentum. And then, there were certain concerns about the trade prospect, as we had been imposed very high tariffs by United States. There was a deal which is now bringing it down to more normal levels of 18%. Then there is also this India-EU, very long pending India-EU trade negotiation, which was concluded on 27th of January. So when we met in Mumbai for the meeting at RBI, the things looked much better than the previous meeting time. And in that context, we were, and also I must say that the budget, of 1st of February took so many new steps to further this or strengthen the momentum of Indian economy beyond what it was looking like by giving a further boost to manufacturing sector, including new data centers policy. And we saw that how the AI summit had a lot of new announcements of investments going into data centers and compute. And tourism boost, the infrastructure, capex, which has been there for last few years, was continued. So altogether, the outlook was very much brightened. That is what I felt. And your point about why did we not go for a further cut and all? So the point there was that we are expecting an overhaul of our data series, both on GDP growth and CPI numbers. So this is one thing. And second thing is that transmission of the earlier cutting, rate cut action, which was taken in December, is still happening. So we thought this time around, we have a pause, and then we see what kind of numbers are coming. So we get determined, in the future policy actions will be driven by the new number.
Well, we'll come to the new CPI and GDP series shortly, but Dr. Nagesh Kumar, what should we make of the fact that you have one of the MPC members, Professor Ram Singh, differing on what the stance of the committee should be, while everyone else voted, or rather agreed on neutral? He wanted the stance to be shifted to accommodative. So should we read it as a deeper debate within the MPC at the moment on how growth supportive the policy should become?
Definitely, all of us felt that the monetary policy has to support the overall, economic policy and overall vision, overall direction of the Indian economy is to support growth momentum, and on that, all of us are united. So the stance actually is something which is not really subject to voting, and we can always have difference of opinion on anything between us, and so accommodative stance could also be thought about, but the neutral stance that we have also provides flexibility to go either way if the data is suggesting that we need to move in this direction or the other direction. So it doesn't really limit the option.
But Dr. Kumar, the market seems to be reading this as an elongated pause. I mean, pretty much all of the economists, bankers that we poll at least show that they expect the MPC to not move for the rest of the calendar year. In fact, the next move, probably next year, will be a hike. I mean, given the current data and the limited now, we have the new CPI series, at least that's come. We'll get the GDP data next Friday. Is the market reading RBI's move as this pivot to an elongated pause correctly?
Oh, no, I mean, you see, I think the future action will have to be determined by the numbers of that day. And so everyone can have their view on what they expect. But I think for us, it's very clear. We look at the numbers of the day and decide and consult each other on that basis, not on the basis of a speculation.
So, Dr. Kumar, then what will, at this point trigger the cut? I mean, growth, you say, is expected to be strong in your statement. Again, all of the MPC members are pretty unanimous in saying inflation, with the revised series or not, is expected to be benign, remain under the 4% target. So what will trigger this next move?
We have to see whether we are going forward. Going forward, we have the same kind of benign, sort of inflation outlook. And if it continues to be benign as it is now, then there would be obviously discussion on, what can be done and how long this benign will remain benign. And that is something the numbers and projections will, provide to us some guidance. And the need for supporting growth momentum or trajectory change. In fact, in my statement, I have argued that right now, earlier we were, taking monetary policy action to support the revival of growth. Now that revival seems to have happened, outlook has been brightened. So we should aim higher for a change of trajectory, move to a higher trajectory. And for that, both monetary and fiscal policy working together would be the need of the hour. But all of these things have to be, taken forward gradually. And that is what over time, hopefully we will be looking at.
All right, Dr. Nagesh Kumar, out of time, not out of questions, but thank you so very much. It was a pleasure speaking with you and for joining us here on CNBC TV 18.
A pleasure as always.
Well, let's shift focus back to the India AI Impact Summit, where Adobe is betting big on India's AI ecosystem. My colleague Parikshit Luthra caught up with their CEO Shantanu Narayan. Listen into what he had to say.
Mr. Narayan, thank you so much for being with us here on CNBC TV 18. Your thoughts about the India AI Impact Summit. You spent a lot of time. What do you think is going to work for India in this global AI revolution?
Well, Parikshit, thanks for having me firstly. I mean, it's been amazing. When you see the excitement around AI, I think India has really dramatically leapfrogged others in terms of adopting digital technology. And so when you see the monthly average users of all of these new technologies, it's clear that India is shepherding and leading that revolution. And so the first and foremost that I'm excited about is the fact that people are saying, that they want to understand how AI can improve whatever profession they're part of. So that's exciting. I think the second thing that's exciting continues to be, the skill and the focus on talent and developing talent, because this is going to be a new era. And much like India has in every revolution sort of figured out how they can equip the employees or the citizens of the country to be effective. So I think those are my two key takeaways.
Right. And how do you think Adobe is going to change as a company over the next few years because of artificial intelligence? What are you going to be investing in, and how much of your capex is going towards redefining the company?
Well, India and Adobe has always been focused about, how do we transform based on every tectonic technology shift. We are incredibly proud of all of the innovation that we've actually already done. PDFs, for example, the entire information repository of the world is in PDFs. You can now have a conversational interface with a PDF. You can get summary, you can get insights, Photoshop that people use to, tell a story. We've now imbued that and infused that with AI. So that you can actually have the creation process be way more automated, way more efficient. Ideation, new business models that are emerging. In the marketing side, we're the largest provider of marketing technology in the world. So, the real answer to your question is we have infused AI across our entire portfolio, but we've introduced AI-first products like Firefly and Express, where the idea is that you just tell us what you want to do and we'll take care of the rest.
Where do you think is the missing gap right now for India in terms of staying ahead in the AI revolution? A lot of developments are already taking place. When we speak about AI startups, they often tell us 2 years means 14 years in the world of AI. So where are we falling short? What do we need to emphasize on?
I don't know that I would say that we're falling short. I think the ministry has correctly identified that there are 5 layers to the AI stack. Adobe is way more in the models and the applications. And I certainly believe that that's where the value creation is going to happen at the end, which is what's the application or workflow or tool that you use to accomplish something. And that is really just beginning. All the focus has been on GPUs and compute and what's happening as it relates to the energy. But the real magic is going to happen when new applications are created. And so I'm actually really optimistic about the fact that we're thinking about models in the right way and applications in the right way.
And finally, India and the United States have agreed on an interim trade deal. That's a big relief. Your thoughts on how this could bring businesses together and give more certainty to businesses on both sides?
Well, I think at the end of the day, it's the power of the two economies. I mean, business speaks. And when you take, the country that has the highest, sort of GDP in the world, and you take a country that's rapidly getting there, magic is going to happen. And so I'm actually really pleased that that's behind us, and we can focus on continuing cross-border trade.
Well, with that, we wrap up this special broadcast. Thanks for watching, but stay with us. More news and updates will continue right here.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. A Friday rally helps the Sensex and the Nifty close in the green for the week, but the IT sell-off continues. The Nifty IT index has lost 17% in the last 3 weeks. Crude oil prices remain in a state of flux. U.S. military build-up near Iran continues to grow. President Trump says prospects for a deal with Iran will be clear within 10 to 15 days. Iran's foreign minister says the U.S. is risking a major crisis. Commerce Minister Piyush Goyal says the first tranche of the India-US trade deal is likely to be operationalized by April. The U.S. Ambassador to India, Sergio Gore, says an executive order to reduce tariffs on India to 18% includes a number of aspects and will happen soon. Officials from India and the U.S. are in close touch over the purchase of oil from Venezuela, says the U.S. ambassador. Adds, U.S. has seen India diversifying its crude imports, and President Trump wants countries to stop purchasing Russian oil. India signs the Pax Silica Declaration in a significant move to strengthen technology partnership with the U.S. Pax Silica is a U.S.-led initiative aimed at securing supply chains for AI and critical minerals. NVIDIA is close to finalizing a $30 billion investment in OpenAI, replacing a previously announced $100 billion multi-year partnership. This as per the Financial Times. Sam Altman sidestepped a question on NVIDIA when asked by CNBC TV 18, but reiterated the company needs more compute. I cannot guarantee AI will create more jobs than it destroys, says Anthropic CEO Dario Amodei. Adds the AI industry needs to be honest about the jobs challenge to address the same. That's a CNBC TV 18 exclusive. Swiss pharma major Novartis to sell 70% stake in its India unit to Chris Capital for nearly 1,500 crore rupees. Chris Capital will also make an open offer for an additional 26% stake. Novartis India shares rally in trade. The UK police searched the Royal Mansion as investigation over Andrew Mountbatten Windsor's dealings with convicted sex offender Jeffrey Epstein continues. The brother of King Charles was released 12 hours after his arrest yesterday. President Trump announced his agencies will release whatever files they have on the search for alien and extraterrestrial life. This comes after comments from former President Obama went viral this week. Obama has since clarified that he has not seen any evidence that aliens have made contact with us. Well, let's start with the day's market action. A positive close to the week on the Lal Street, with the Sensex gaining over 300 points and the Nifty adding about 100 points, reclaiming the 25,500 mark. Mid-caps also rose in tandem, closing about 300 points higher, 0.5% of a gain there. But that's the Nifty IT. That is where we're seeing pain, and that pain continues. 300 points lower there on the Nifty IT. IT stocks are seeing the pressure. The Sensex and the Nifty managed to close the week in the green, but the Nifty IT index has lost over 2%. It's lost nearly 17% in just the last 3 weeks, as fears of the AI disruption hurt sentiment. Now, TCS down 14%, Infosys is down 17%, HCLTech is down 15%, Wipro down 20%, and Tech Mahindra is down 15%. That tells you the story as far as the IT pack is concerned, the meltdown that we've seen this month for IT stocks. But the industry is not pressing the panic button yet. From N. Chandra of Tata Sons to Nandan Nilekani at Infosys, industry says the AI disruption presents an opportunity for the IT industry. Anthropic CEO Dario Amodei spoke exclusively to CNBC TV 18 and said his company is not trying to replace industries and instead wants to work with all IT companies in India.
AI is a very, very important multi-decadal change. Every company has to figure out, has to ask fundamental questions. What is my moat? IT services companies, rather system integrators, will have a greater job, greater responsibility. One other point, but the companies have, IT companies have to do a lot of work.
Yeah,
like every other time, they've got to equip themselves with all the skills that are required. They've got to go through that.
You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk. It's an execution risk.
I think it's overdone. I mean, a lot of things that I've read in the social media and all of that feels overdone. But we do recognize that this is a big disruption. And if you really go after it, there are so many new opportunities. So I think as an industry, we will get through this very successfully, and that's what I believe. And we have responsibility as leaders to really make this transition happen.
We want to work with essentially, we want to work with essentially, all the companies in India. So, we're going to aim to get partnerships with, all the household names that you could think of. They're in different stages of discussion, and Infosys was the one that was announced just yesterday. We're very, very, very excited for the partnership. I visited Infosys the last time I came to India in October.
So what will the road ahead look like for Indian IT services company? Is it all gloom and doom as the market seems to be making out to be, or is there going to be light at the end of the tunnel? We, of course, have special programming running on CNBC TV 18 addressing the big questions. In the money market now, the rupee weakened by more than 30 paise to the dollar. The Indian currency is now closer to the 91 mark against the greenback. And in the bond market, the 10-year bond also tumbled in trade. The yield spiked by nearly 1%. The money market has seen heightened trading activity today since it was closed yesterday. In the commodity space, crude oil prices on track to register their first weekly gain since January. This is on the back of escalating tensions between the US and Iran. The US has continued to amass military hardware near Iran. Addressing the inaugural meeting of the Board of Peace overnight, President Trump said that he will decide whether to launch a military strike against Iran in the next 10 to 15 days. US envoys held indirect talks with Iran on its nuclear program in Geneva this week. US Vice President J.D. Vance had also remarked that Iran did not address the red lines that have been set by President Trump in the talks.
Good talks are being had. It's proven to be, over the years, not easy to make a meaningful deal with Iran. We have to make a meaningful deal. Otherwise, bad things happen. They can't have a nuclear weapon. It's very simple. You can't have peace in the Middle East if they have a nuclear weapon. And they can't have a nuclear weapon. And they've been told that very strongly. They cannot continue to threaten the stability of the entire region, and they must make a deal. Or if that doesn't happen, I maybe can understand. If it doesn't happen, it doesn't happen. But bad things will happen.
Bad things will happen. That is President Trump with his threat for Iran. Back home, Commerce Minister Piyush Goyal has said the first tranche of the India-US bilateral trade agreement is now likely to be operationalized by April this year. Earlier, he had said it was likely to be done in March. Goyal said that the Indian negotiators are set to visit the US on the 23rd of February. Speaking on the sidelines of an event in the capital, Goyal added that the India-EU free trade agreement will be operational by the end of the year. The FTA is yet to be ratified by several countries of the EU bloc and the EU Parliament. The EU Commissioner had said that they expect it to be done by early 2027. And speaking of the India-US interim trade deal, US Ambassador to India Sergio Gore has said the executive order reducing tariffs of India to 18% will include, and I quote, a number of aspects and will happen soon. The US envoy also said that officials from India and the US are in close touch over the purchase of oil from Venezuela. Gore added that the US has seen India diversifying its crude imports, but President Trump wants countries to stop purchasing Russian oil. Here's the US ambassador.
I think we have a great relationship. I think it comes down to multiple things. The first thing is the great friendship between our president and your prime minister. The signing will happen very soon. In fact, even this week, we have both teams are talking to each other and actively getting to a place where both will be able to sign. Look, the reality is there's tens of thousands of points. We're not dealing with a small country. This is one of the biggest economies. And so we're thrilled that the interim deal is done. You have the few tweaking points that are left to do, but it's done. So the signing will happen sooner than later. We have seen India diversify on their oil. There is a commitment. This is not about India. The United States doesn't want anyone buying Russian oil. The president has been very clear on this. He wants this war to end. And so anyone who is, in a way, still involved with that conflict is something that the president wants to see come to an end in hopes of peace coming with that. On the first part of your question, that is also, there's multiple mechanisms. It's not one executive order. So that is making its way through the pipeline. The executive order specifically on oil was already signed. So that's done. The second part of it on the tariffs being rebalanced, there's multiple things. It's not just one piece of paper. It's multiple things, multiple departments, multiple areas. And so that'll also happen very soon.
Well, that's the U.S. ambassador speaking in Delhi. And it's interesting that even as the U.S. continues to maintain that all countries need to stop buying Russian crude, the imports of Russian crude by China have gone up significantly, even as imports of Russian crude by India have dropped significantly. Now, India has signed the final declaration to join a U.S.-led strategic alliance. It's called PAC Silica. This on the sidelines of the India AI Impact Summit, and this marks a significant step towards expanding cooperation in artificial intelligence, critical supply chains, and semiconductors. PAC Silica is a U.S.-led initiative aimed at securing supply chains for AI and critical minerals. Ashmit joins us now with more on this agreement and how it could benefit India. Ashmit, explain to us the significance of PAC Silica and how India benefits from it.
Well, to explain the significance, I'll borrow from the U.S. Undersecretary Jacob Hellberg, who was present as a part of the signing ceremony alongside U.S. Ambassador Sergio Gore and Indian IT Minister Ashwini Vaishnav. What Jacob Hellberg essentially had to say is that increasingly they are seeing that there are economic levers being used to pressurize sovereign nations, that is something that cannot be permitted, that economic security now in today's times is the same as national security. And to that end, we saw this PAC Silica initiative being launched by the United States in December 2025. The fact that it comes after the critical minerals crisis is no coincidence. While there was no reference made to the country of China, there's a very clear indication that there are certain levers being used by countries which are pressuring other countries. And to that end, the US had launched this initiative of like-minded countries. So the countries that count themselves as a part of PAC Silica, including India now, are countries like UK, like Australia. We have countries like Israel, Singapore, Japan, South Korea. These countries are increasingly forming an alliance for all things related to AI, for all things related to semiconductors, for all things related to critical minerals. There's a growing concern among these countries and a growing understanding as well that there's a need for interdependence, that one country can't do everything, and to that end, ensuring that there is greater cooperation. What this essentially means for India is that there is now a clear runway when it comes to supply of advanced chips. India is in the midst of a data center build-out. This is something that will be important. India is also in the midst of a semiconductor build-out. We've already seen 10 facilities being approved. ISM 2.0 is around the corner. This will also ensure greater cooperation between countries like the US as well as India. So a net positive as far as India is concerned. And what that translates into, in fact, we met up with Mr. Sanjay Mehrotra, the CEO of Micron Technologies. Let's hear what he had to say.
I think it's a great summit bringing together leaders from all around the world, business leaders, government leaders, and PAC Silica is a great example of US and India technology collaboration, particularly advancing semiconductors and building AI infrastructure.
What are the benefits, sir, that India can hope to realize from this association with PAC Silica?
And of course, focus on semiconductors, building advanced supply chains, partnering with US, and together building the infrastructure for AI and the future for a future for all good for humanity.
And there's more from the India AI Impact Summit. Adobe Systems CEO Shantanu Narayan says India has leapfrogged several nations in AI adoption. Speaking with CNBC TV 18, Narayan said Adobe is betting big on India's AI ecosystem.
It's been amazing. When you see the excitement around AI, I think India has really dramatically leapfrogged others in terms of adopting digital technology. And so when you see the monthly average users of all of these new technologies, it's clear that India is shepherding and leading that revolution. And so the first and foremost that I'm excited about is the fact that people are saying, that they want to understand how AI can improve whatever profession they're part of. So that's exciting.
Finally, India and the United States have agreed on an interim trade deal. That's a big relief. Your thoughts on how this could bring businesses together and give more certainty to businesses on both sides?
Well, I think at the end of the day, it's the power of the two economies. I mean, business speaks. And when you take, the country that has the highest, sort of GDP in the world, and you take a country that's rapidly getting there, magic is going to happen. And so I'm actually really pleased that that's behind us, and we can focus on continuing cross-border trade.
Well, that's Adobe's global CEO Shantanu Narayan, and venture capital firm General Catalyst has promised to invest $5 billion in India over the next 5 years. The announcement comes after General Catalyst raised $8 billion for a global investment fund aimed at supporting startups. That was in October of 2024. Speaking to CNBC TV 18, CEO Hemant Taneja said the company is betting big on India because the next generation AI companies will thrive in the country.
It's been great. It's been exciting to see all the amazing people that have centered here, and I think Prime Minister Modi did a great job. I think it's been
okay. So what is your expectation from India as a market when it comes to AI?
I expect it to be very vibrant in terms of next generation AI companies, and that's the reason we decided to expand our investment in India.
Okay.
With the announcement we made yesterday.
So there were a lot of announcements today in between India and US and the other markets as well. How do you feel about that from an industry perspective?
I think it's good. I think you want to see the US, European, Indian ecosystem getting stronger and more connected, because you need to see infrastructure across these geographies working together to make sure there's a democratic AI economy.
Well, that's General Catalyst Hemant Taneja on that fresh $5 billion commitment to India. NVIDIA is in talks to invest up to $30 billion in OpenAI. Now, this investment could value the startup at $730 billion. This investment will be separate from the $100 billion infrastructure agreement that both companies had announced last September. Reports have further stated that the $30 billion deal is not final and the details are still subject to change. While speaking to me at the AI Summit, OpenAI Sam Altman sidestepped a question on NVIDIA but reiterated that the company needs a lot more compute.
Those are big issues, but the number one issue being asked of leaders like you, how sustainable is this business model? The gargantuan spends that companies like yours are making, is it code red at this point in time?
I think, I may be wrong, but if AI stays on the trajectory that it appears to be on, I think we will say, man, we wish that people had invested more earlier and built out more infrastructure earlier. Clearly, the industry is making a very big bet on this mission of democratizing AI. That's part of why we think we need to invest so much, and we need to make AI so inexpensive, so abundant, so good, such that people can use a ton of it for whatever they'd like.
Do you feel comfortable where you find yourself financially today?
I wish we had more compute. Yes, I feel...
Will you have more compute, and what's the latest as far as the deal with NVIDIA is concerned?
We are building compute as fast as we can. Yes, we'll have more compute over time.
We will have more compute. Sidestepping the question on the deal with NVIDIA. That's Sam Altman in a CNBC TV 18 exclusive. Time for us to head into a short break, but up next, Swiss pharma major Novartis to sell 70% stake in its India unit to Chris Capital for nearly 1,500 crore rupees. That and more when we return. Shares of Novartis hitting the upper circuit today after the Swiss pharma major Novartis said it plans to sell 71% stake in its India unit to Chris Capital for nearly 1,500 crore rupees. This has been long pending. Chris Capital will also make an open offer for an additional 26% stake. After the transaction, Novartis AG will cease to be the promoter of the company. The acquirers will assume control and be classified as the new promoters. In fact, speaking to me at CNBC TV 18 in Davos, Novartis CEO Vas Narasimhan had said the company's commitment to India was absolute. The sale of Novartis India does not mean that Novartis is pulling back from India. Take a look.
It's really interesting how much focus there is on our company structure.
Yeah.
It doesn't change Novartis' commitment because Novartis AG is committed to India. These are all kind of structural things with our legal entities. So no change in the strategic review of how to structure ourselves. But the most important message I would want to get to all of the viewers, Novartis' commitment to India is absolute. We have over approximately 10,000 people now. We have 25 years in the Hyderabad area now with our Novartis corporate center there. And that commitment is long-term, and that's not going to change.
Well, that's Novartis' global CEO Vas Narasimhan. Shares of Ola Electric fell to another record low today. The stock has fallen 14% this week and nearly 57% in 1 year. Sudarshan is standing by with what looks like a very difficult road ahead for the company. Sud.
So as you have said, it's a continued underperformance by Ola Electric shares, and today also this stock is down more than 3%, and this week it's down 13%. 2026 so far, or say in the last 2 months, the stock has fallen more than 26%. What's the reason? So first, recently company has released Q3 FY26 earnings, and those earnings look very weak. Revenue is halved, losses remained elevated, and it's the first time that company has reported loss which was more than the revenue for the quarter. Second, company at the beginning of this fiscal had given the guidance, and that guidance had looked very strong if it had managed to deliver. But we have looked at the data of 9-month FY26. So company had given for auto business EBITDA margin, and the target was more than 5%. As of December 2025, company has delivered minus 6.4%. On the gross margin, target was in the range of 35 to 40%. As of now, it is at 29.6%. On the volumes, the guidance was in the range of 3.25 to 3.75 lakh units, and as of now, company has done just 1.5 lakh units. And on the revenue front, target was in the range of 4,200 to 4,700 crore, and as of now, they have done just rupees 2,000 crore. Second metric is market share data. Now, in January 2025, company had the market share of almost 25%. In January 2026, that has fallen to less than 6%. In January 2026, it was 5.86%. And in February also, so far, registration is looking very weak, and in all probability, its market share is going to fall further. And so far, registration is just 2,806 units versus whole month, if you look at of February 2025, they had done almost 8,675 units. Last one, what do brokerages say? So as per the Bloomberg data, total 8 brokerages have the coverage on the stock, and of those 8, 6 have the sell call, and lowest target price is rupees 20 per share, while the highest target price is rupees 55 per share. So if you take a look at the lowest target price of 20 rupees per share, brokerages believe that there is a further downfall that we can see in the stock price even from the current levels. So we'll have to see how the next few months pan out. But as far as the data is concerned for Ola Electric, it's looking very weak. Market share is falling. Even registration has been under pressure continuously.
Right. So also talking there about PB Fintech, which has been facing issues of its own. With that, it is time for us to wrap up this edition of Business 360. The news will continue on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and these are the top headlines that we're tracking for you this evening. EdTech firm Classroom files its DRHP to launch an initial public offering on the SME platform of the BSE. Proposes a mix of fresh issue and an OFS by existing shareholders. Proceeds will be used to repay debt and strengthen tech stack. Peak 15 and Tiger Global-backed ProcCap nearly doubles revenue in fiscal year ended March 2025, reduces losses by 87%. ProcCap facilitates debt capital for underserved micro and small businesses. AI apps building platform Portkey bags $15 million in a Series A round led by Elevation Capital. Will use the funds to enhance support for agent-based systems. India signs a Pax Silica declaration in a significant move to strengthen technology partnership with the United States. Pax Silica is a US-led initiative aimed at securing supply chains for AI and critical minerals. NVIDIA is close to finalizing a $30 billion investment in OpenAI, replacing a previously announced $100 billion multi-year partnership, according to the Financial Times. Sam Altman sidestepped a question on NVIDIA when asked by CNBC TV 18, but reiterated that the company needs more compute. The India AI Impact Summit is underway, and CNBC TV 18's Aishwarya Anand caught up with InMobi founder and CEO Naveen Tiwari on how AI is reshaping digital advertising, consumer platforms, and the future of monetization.
We have to understand the labeling laws. I don't think we have had time to look through them yet. But let's talk about the construct of what you're saying. Okay. The construct is that it should carry it if it is required, and that is absolutely okay, because end of the day, what we are really trying to do is make advertising very personal. And what that means is that with artificial intelligence, we should be able to do creatives which are very specific to a user. And that is okay that they are generated through artificial intelligence, because we're not trying to mislead. I think the fundamental issue is that, are you trying to mislead? That's not the scenario at all. It is to say, hey, we'll make it a lot more personal so that it does not seem jarring to people, right? So in my view, with AI being put into the creatives, internet is going to become more beautiful, which is exactly what we would want, whether we are thinking about commercializing the internet or whether we're thinking about it from a consumer lens.
Absolutely. Now, AI is now a core part of every advertising stack, correct? So how is InMobi using AI to redefine mobile ad targeting and user engagement in 2026?
You got to think about advertising very differently. If you think about the future of advertising, you got to think about the future of consumption first, correct, right? Because advertising follows consumption, it does not lead consumption. So if you think about that, if the consumption is going to be led through generative AI applications, which are effectively going to look at, using LLMs, both text-based and visual-based, you got to essentially think about embedding your advertising model inside the LLMs. Absolutely. And therefore, look, at the end of the day, what is the core objective of advertising? It is not to disrupt the experience. It is to essentially make any ecosystem free for consumers to use. It enables democratization of the technology, right? So when the internet came, advertising allowed it to become democratized and to be accessed by everybody. Similarly, for artificial intelligence, advertising is going to democratize that and be used by everybody. And therefore, you have to think about how do you embed a very transparent economic model in various different LLMs, etc., that applications will start to use. And I think advertising would become far more embedded into the content than it has ever been. And so we are very excited about it, because if you think about it, when the world moved from traditional consumption to digital consumption, we all used more content because it was subsidized, but also because advertising became more efficient. When you move from a world of digital technologies or internet technologies to AI-led technologies, the big shift is in the delta of intelligence. And therefore, our belief is that advertising will play an even bigger role in democratizing AI-led all of these applications that are going to come out. Because think about this $500–600 billion that has gone into the electricity, into chips, into data centers, etc. How are you going to monetize that? how are you going to essentially generate anything out of it? So therefore, advertising is going to play a huge role in making that happen.
Absolutely. And, InMobi is empowering millions of...
Billions.
Billions.
Yeah.
Billions. Okay, billions of mobile users with insights. So what are the biggest ethical considerations you grapple with when deploying AI at scale?
Well, you got to think about, look, AI in a very interesting way. If you think about digital technologies, right? Digital technologies allowed for a lot of disruption in the consumption because you could manipulate the experience of users, not through ads or anything in general, right? So if you think about social networks, all these social platforms have been manipulating consumers' psyche, have been dealing with them in a very different way, and creating a need out of, probably wrong incentives for human behavior. But I think we have a chance to think about, as this new technology comes up, learning from the past to say, hey, AI should be far more ethical. What does that mean? It needs to be transparent. AI has this ability to say, cannot be a black box. It should be able to have your reasoning of why you showed something to be transparent. And so think about it. If you think about AI, we should be making, what does ethical AI mean? It means, please tell the user why you showed them what you showed them. And if you're able to explain the why, that means you're being transparent. Think of it in a very overtly simple example of that is, you used to go to restaurants, the kitchen would be at the back. In order to improve performance of kitchens, they actually made it open. Frankly, exactly the same thing's happening, but now it's open kitchen. Open kitchen leads to better practices. That's what AI needs to do. It needs to be transparent.
And on What's Brewing today, India's automotive sector is undergoing a massive transformation from mechanical machines to software-defined connected platforms. And right at the heart of this shift is deep tech startup 6sense Mobility, which has just raised 44 crore rupees in a pre-series A round led by ace investor Ashish Kacholia with participation from Piper Serica Angel Fund. Now, the IIT Delhi incubated company is building full-stack automotive electronics from telematics to intelligent control systems and positioning itself as a Tier 1 technology partner to leading OEMs like Volvo Eicher Commercial Vehicles and Sonalika Tractors. Joining us now to discuss this further is Sumit Roy, the CEO and co-founder of 6sense Mobility. Sumit, thank you so much for taking time out and being here with us on Startup Street. Like I just pointed out, you've positioned yourself as this full-stack Tier 1 supplier, right? How does that sort of differentiate you from traditional auto component manufacturers in India? If you could sort of take us through what you have on offer.
Thank you so much, first of all, for having me here on the show. And to answer your question, being a full stack company allows us, number one, to cut down the design and development time and go-to-market time for any technology considerably. The traditional standards were about 3 to 5 years before a technology could be taken onto the roads. We have been able to do that in less than 12 months, sometimes even lesser. And number two, the cost associated with it, since not multiple parties are involved, we are the only ones who's developing the hardware, we are the ones who's developing the firmware and the software, and also manufacturing the full product. Being a full stack company allows us to cut down on the cost considerably and allow the OEM to procure our material at a much cheaper price. So effectively bringing down the cost of the entire vehicle and making the technology more available for the OEMs to use.
So you're sort of democratizing the technology stack that's available for the players that you're working with, and you're bringing down the cost, right? So you've got about 25,000 to 30,000 devices already deployed and 160 crore rupees order book, right? What's your current revenue and margin benchmarks at the company?
So we're targeting to do about 15 crores of revenue this year, but in the next 18 months, and that's again considering the electronic supply chain has gone through a bit of a rough patch here. But in the next 18 to 24 months, we are targeting to do over 200 crores because we have that order book and we have the visibility. One of the reasons of setting up a plant exceeding a capacity of 1 million units is the order book that we have. So yes, I mean, it's exciting times for us right now.
Exciting times, but you did point out, the supply chain has had a bit of a tough time, right? So is that back to normal? What are the challenges right now ahead of you?
The primary challenge, I'd say, is maintaining the supply chain and making sure the global crises don't impact India. And I think we have positioned ourselves well enough. We've got fantastic vendor supports from our network, and we've built a fantastic supply chain management system. So I think we are very well positioned to deliver to our customers exactly what they need. And in the next 18 to 24 months, I think we can't just meet our targets, but I think we'll be able to beat our targets as well.
So not just meet your targets, but beat your targets over the next 12 to 16 months. But, you've raised these funds, right? So how much of this fresh capital is going to go into that new Noida manufacturing plant, versus the other places that you plan on deploying it, which is R&D and product development?
So a considerable amount will be going towards the Noida manufacturing plant. I mean, we are spending about roughly about 12 to 15 crores to set up the manufacturing facility. And this would be one of the most advanced facilities that will come up, around the Noida vicinity, specifically for manufacturing of automotive components. We'll have the entire manufacturing chain from hardware, firmware, software completely in-house, and the entire building will have a product control system where you can see the product coming to life from a prototype stage to completely going to a manufacturing stage and a full-scale supply from the same plant. So yes, that's the plan for the Noida plant.
That's the plan for the Noida plant. And, India still imports a large portion of high-end automotive electronics, right? So how realistic is it to fully indigenize this segment, and what technical barriers remain on this front?
India used to and still continues to import a considerable amount of electronics, and when it comes to advanced engineering material. But I think startups like us and other startups are now slowly breaking down that barrier and indigenizing these technologies. I mean, complex technologies like telemetry communication units aren't simple GPS tracking systems. They are extremely complex technologies. And not just that, we're also building the V2V vehicle to vehicle and vehicle to everything network that is in line with the government of India's vision, along with ADAS. So all of these technologies that we earlier India considered, that we need to import from other countries, I think over the next 12 to 18 months, you'll see them being indigenized completely in India, and suppliers like Sixth Sense Mobility will be supplying to not just domestic OEMs, but global OEMs as well.
So not just domestic, but global OEMs. And speaking about that, you're working with major OEMs. How long is the typical sales and integration cycle in automotive? And what does scaling partnerships actually look like? And, what are these global OEMs that you're eyeing? And are you already in talks with them?
So honestly, this is not an easy journey. And I think we've been extremely fortunate. Our partners, our mentors, and especially my team has been a phenomenal support in this. Cracking an OEM, being just a 2.5, 3-year-old company isn't really easy. You really need to have solid tech in your corner to be able to crack these OEMs. And a typical sales pipeline would look like about 6 to 8 months of journey is the least that you could expect from an OEM. And then comes the product development and conceptualization. But we've been able to break down the entire length of the sales cycle down to 12 months. So first 2 months of conversation and product conceptualization, and then to prototyping and validation and final delivery of the product.
All right, Sumit, we're completely out of time, but thank you so much for joining us on the show, and we wish you all the best on this journey going forward.
Thank you so much for having me. Hope you have a great day. Bye-bye.
Thank you. On that note, it is time for us to head into a short break. But coming up next, Zepto brings its quick commerce model to the Bharat Mandapam at the India AI Summit. We take you inside to see how 10-minute deliveries are powered in real time. Stay tuned. Welcome back. You're still with us on Startup Street at the India AI Summit here at the Bharat Mandapam. Zepto has brought its quick commerce model on ground with a live dark store setup. Aishwarya Anand takes you inside to see how 10-minute deliveries are powered in real time.
I am inside Zepto's delivery hub, which is right here at India AI Summit, and this is essentially a fully operational quick commerce setup built right on the summit floor. You've got real inventory, real pickers, real packaging happening in real time, and every order being placed by attendees is actually getting processed from this very space. From AI-led inventory planning to rapid fulfillment on the ground, this is a working demo of how a 5-minute delivery promise is powered behind the scenes.
Hyperlocal e-commerce is a format unique to India. There's a lot of technology and operational excellence that goes into making it possible for customers. We think it's a world-class service that you don't find even in developed countries, makes people's lives easier. And thousands of people have experienced it. Hopefully people are going to take back stories when they go back to their home countries in Europe or the US or other parts of the world, in Asia.
A social media user shared that she received food within 5 minutes of ordering during a packed summit. So is this indicative of Zepto's real-world delivery promise, or was this a curated demo?
If you look at the store behind me, it's like an actual dark store that we have on the field. It's obviously smaller, but it's processing, like you mentioned, 1,000 orders. Yesterday we did 1,700 orders in that space. So the demand is there. The operations are as close to the real thing as we can get in this place.
All right. Now, having a dark store inside Bharat Mandapam is unusual for a quick commerce player.
Sure.
Okay. So do you see this kind of deployment, micro-fulfillment infrastructure co-located with large events becoming a more regular strategy for Zepto?
So look, I mean, obviously this is relatively small in the grand scheme of things of our overall business. So I don't think it'll become a business vertical, definitely not. But it is just an opportunity to showcase, the innovation and the tech stack that we've built and the operational stack that we've built, right? So we'll definitely take up opportunities to keep showing the good work we've done, because we feel like we're on the cutting edge of, tech-native companies in India. We feel like we're on the cutting edge of the implementation of AI in real-world use cases, and we think it's an example that, the industry is an example that the country can be proud of, because not only is there's a lot of software and operational excellence that goes behind it, there's a lot of job creation and real-world economic value, right? There are hundreds of thousands of delivery partners, pickers, packers on our rolls as well, and we think it's a good thing for the country, so we're excited.
Another thing that I want to understand from you is that your value proposition has always been super fast delivery in metros, right? Have regulatory conversations around 10-minute delivery impacted or changed the way you're looking at your operations right now? Is that something that you're considering?
Look, no, our operations stayed exactly the same. No changes over the past 2 years, 3 years per se. We obviously have spoken about, our engagement with the Labour Minister and the Labour Ministry about, suggestions that he had. I spoke about it publicly. Mansukh Ji was, is very supportive. In a way, the environment the government has created for innovation and corporate growth and companies to grow has created all this employment. So his point of view, we want to. I believe at least the government's point of view is how do we keep creating this employment flywheel and how do we keep accelerating it. Within that, how do we make it seamless so that it's not, controversial or creates issues. Of course, there are, basic constraints in businesses, right? But within those constraints, if there are constructive suggestions on how we can improve, always happy to do it. But so far, so good.
Okay, one final question. While I know you're in the silent period, just want to understand some of the milestone targets that you would have in terms of your economics, in terms of your expansion. What does that look like?
So obviously you can't talk about it, but hopefully soon it becomes a public domain and then we can talk about it more freely. We're just heads down executing. We think execution is the key component of this business. If you execute, you'll do well, and that's what we're focused on. Just heads down execution.
India's manufacturers are increasingly turning to AI and robotics to boost productivity and improve quality. In an interaction with CNBC TV18's Meghna Sen, Saugan KM of Teradyne Robotics said policy frameworks are in place and partnerships like NVIDIA are accelerating human-robot collaboration. He added that automation will create more value-added jobs, even as factory and IT readiness remain key hurdles.
I think India is becoming the global manufacturing hub. So definitely there will be an adoption of robots and cobots on large scale. The policies and the frameworks are in place. I think Indian manufacturers who look for high productivity and great quality are looking at cutting-edge technology to improve their factory output.
You're working closely with NVIDIA. So how do you think NVIDIA's AI platforms, will help collaborate Indian humans and robots work together in the next decade?
Again, they're a very strong partner for Universal Robots and MIR and as a part of Teradyne Robotics. The platform that they provide and the compute power that they can offer us is phenomenally strong. So that is where we thrive on and then take it to the next level with that.
To what extent do you think automation and AI will replace human jobs, and which sectors are at risk?
I don't think replacement of jobs is usually seen as a part of such technology. There will be, so what we're trying to do is we are going to move from dumb, dirty, dangerous task to very meaningful jobs. So the whole idea what we're trying to do is, even this training kit that we have in display over here, is to say how colleges of today can adopt this, learn robotics and automation, and produce very high talented resources for the market.
What are the challenges that enterprises are facing these days to deploy AI-enabled robots, especially when you talk about emerging countries like India?
One of them is our operation factory ready to adopt these. One is their operation factories and the maturity of it. The other one is their IT maturity. Both of them have to come together. And then there's always a vision of a leader. So with all these three, if it's combined in the perfect mix, I think that's not a big challenge. It's just a hurdle that we should be able to overcome and bring in high quality manufacturing into this country.
It's time to take stock of all the deals from the startup world. According to Venture Intelligence, this week saw a total of 20 deals worth $124 million. Some of the notable deals include fixed return investment platform Stable Money, which raised $25 million from Fundamentum. EV charging network Static raised $18 million from Shell Technology Ventures, while chip design company C2I Semiconductors raised $15 million from Peak 15 Ventures. That's not all. AI apps building platform Portkey gets $15 million from Elevation Capital and Lightspeed Ventures, while jewelry chain Jiva raises $12 million in an extended CDC round from Kenro Capital, Premji Invest and Titan Capital. This year has seen a total of 146 deals worth $1.1 billion, according to Venture Intelligence. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
25 when it was 0.6. If we look at the pricing index, not good news here. 3.6. We were looking for 2.8. 3.6 is 0.2 lower sequentially, but much higher than expectations. 3.6 would equal where we were in the first quarter. We got down to 2.1 in the second quarter of 25. Of course, last quarter is higher at 3.8. Finally, if we look at the PCE core pricing index, 2.7, one tick hotter than expected, 2 ticks cooler than the rearview mirror, which was 2.9. Personal income up 0.3, exactly as expected. And last look, it's upgraded to 0.4. On the spending side, looking pretty sharp here, up 0.4. And last look, downgraded from 0.5% to also up 0.4. That 0.4, by the way, is 1/10 better than expectations. Now, if we look at real spending, accounting for inflation, it was up 1/10 as expected, but that's 0.2 light to history. It equals September. To find a lower number, you're going back to May of last year when it was slightly negative. Now, let's get into the meat on the bone. PCE pricing index month over month is 0.4%, 1/10 hotter than we were looking for, and it's double the rear view mirror at 0.2. 0.4, well, that would equal February of 25. To find a higher number, you're going all the way back to January of 24 when it was up 0.5%. Now let's look at the longer look year over year. Comes in at 3% on year over year PCE, and I'm sorry, year over year, PCE is 2.9. Excuse me, 2.9. If we look at month over month core, talked about, and year over year, up 3%. And 3% would be the highest level going back to April of last year. So if we look at these numbers and take them all in stride, I think the market did a good job of divining. And I would have to say that many, including Steve Leisman, thought this number would be hotter than expected on the PCE front. And indeed it is. But if we look towards history, we have made a little bit of progress on some of the numbers on the GDP side, but not much progress on this side of the equation. On the week, well, where were 2 years last Friday? Last Friday, a two-year close at 341, Joe. That was the lowest yield close going back to SEP of 22. Right now, it's hovering at 346. And if we look at the 10-year at 406, it closed last Friday at 405. That was the lowest yield close going back to the end of November of last year. So markets are taking this somewhat in stride. If you look at the pre-opening equities, the Dow futures are basically on the lows of the session, down a little over 110. Back to you.
Thank you, Rick. Steve Leisman can join us now and make sense of some of this. Steve, I figure if you get half of what people were expecting for GDP, that the yields would go lower, but you got the inflation maybe being a little bit hotter, so they can't really go lower. What did the government shut down? How much is that involved with that was during this period? And then we had some trade deficit numbers that caused people like the Atlanta Fed to bring down GDP to, what was that, exports? But 1.4, if it was expected to be 2.8, how did it come in at 1.4?
Joe, this is great. You set me up perfectly for exactly what I was going to want to say. Two things about this number. The inflation numbers are bad. I'll get to that in a second. But the overall GDP number is not as bad as it looks, and was not actually as bad as expected, which could explain the market's kind of calm with this. Let me explain. As Joe just said, that trade deficit number came in yesterday, and it was worse than expected. We don't have that number when we estimate the fourth quarter GDP. Of course, all the timing on the data is all messed up. But anyway, that number came in, and on the street, what we call the tracking forecast, the forecast that plug in the numbers as they come into their estimate, they came down. I was thinking a number more like 2, but it came in quite a bit lower than that. I need to investigate why that is. But this precise answer to Joe's question is 1.15, or rather minus 1.15. That's what the federal government shut down, along with, by the way, the general decline in spending that is part of the administration's policy here on the federal side. But federal spending cost the GDP number 1.15 percentage points. So you can add that back, maybe, not all of it. The consumer was okay. The trouble here you're going to get to, Joe, and I think it's pretty clear, is the inflation numbers. You have two different sets of numbers, the CPI number and the PCE number. Won't go into all the details here. The PCE number that the Fed follows has less housing in it, so that positive data we got on the housing side on the CPI number, not as important inside. Also, you have more healthcare inside the PCE number. Fed likes the PCE also because it shows substitution and it's a broader index. Anyway, that's what we got. That's their preferred indicator. It is a little bit hotter, and I'll just conclude by saying, Joe, my take is that this gives some strength or support to those on the committee that want to wait a little bit longer and let this inflation pass through the system before cutting. The CPI, well, that gets support to the doves on the committee. Joe?
Right. So you can explain the weak GDP, but you can't explain the hot inflation numbers. So, yeah, I was wondering. Yeah, I was wondering because everybody's.
But
yeah, go ahead.
It's explainable, Joe. I need to look into the data. I don't know if there was some particular carryover or some particular element that raised it up inside the PCE this month. It could have been the healthcare component and the lower housing data in there.
Okay. All right. Thanks, Steve. And Rick, with us in studio, Aditya Bhave, senior U.S. economist at Bank of America. You were expecting around 2%, but the first thing you said for GDP, first thing you said, a large drag possible from the shutdown. Is that part of this?
Absolutely. I mean, Steve mentioned 1.1 to 1.2 percentage points lost from the shutdown. So X of that, you were at 2.5, 2.6. That's totally fine, right, in terms of GDP. I'm 100% on board with his take. The concern here is prices. GDP's fine. The consumer's fine in the fourth quarter. Solid momentum going into the first quarter. If anything, now you're going to get fiscal stimulus hitting the economy very, very imminently. So the folks that are concerned about inflation, I think they'll stay concerned.
Will the stimulus that you're talking about lead to higher inflation?
It could. I mean, the question here is we know that tariff pass-through so far has been somewhat incomplete. So will this pickup in demand provide an opportunity for firms to now pass those tariffs through?
Do you think that that's been part of the problem, that they didn't feel like they could pass the
to a degree
the tariffs through, and so they were eating some of it with margins?
To a degree. So our estimate is that about 40 to 50 basis points of what you see in the core PCE right now is tariffs. So X of tariffs, you'd be at 2.5, 2.6, which is better than 3%, obviously, but it's still quite a bit above what the Fed targets.
Right. What is the going rate? What is full growth right now? What are we able to where are we able to grow? Could we grow at 3%? Real growth or not?
We very much could in the first half of this year. We wouldn't be surprised if actually we get 3% for the full year, because if you look at the policy stance versus where we were last year, fiscal policy is turning easier. The Fed has cut to a level that we think is neutral, possibly even accommodative. And then I think even trade policy, you're not going to get that kind of big trade uncertainty shock that we got last year. So the policy backdrop is just so much more supportive for growth this year. If we could do, I believe this is going to be something like a 2.2% 4Q over 4Q for 2025. We could easily do 2.5% plus this year.
You said the consumer's fine.
Yes.
Is that across the board?
No.
Fine?
No. It's a K-shaped consumer. When I say the consumer is fine, that's definitely a comment about kind of aggregates, averages, because that's what we deal with in macro. That's the most that the Fed can control from their perspective. But there's definitely, if you look at the data granularly, and we're able to do that using our internal data, so spending by folks that have B of A credit and debit cards, what we see is really nice acceleration in higher income spending, but some struggles with the lower income cohorts.
I guess that's the affordability thing, Steve, and why so many people just, in what looks to be some okay economic conditions, they don't feel like it's okay.
Yeah, and we'll see how they feel, Joe. This is a bit of a political race, an economic race. You have those refunds coming through, as you said, and I still think, and I don't know if you and I disagree with this, I still think the economy is battling these tariffs, which is why I kind of side with Aditya that, hey, this is not a bad number. And I just want to show you a chart that kind of backs up what Aditya was saying. This is what we call real GDP, real final sales to GDP for private domestic purchasers. And what this does is it gets rid of the inventory distortions, the export distortions, and the government distortions. And it's pretty good. It's a 2.4 number. We're adding back a bunch of things that we've been doing 2.9. If you think about still, and I don't know what Aditya thinks about this, what potential growth is, we're maybe a half a point above it there. So all things considered, it's a pretty good GDP number. And we'll see whether or not there's a special case here on the inflation number, Joe.
Steve, I think potential growth is above 2%. The Fed keeps saying it's 1.8. I don't really understand that. We've been running well above that for a while. I think it's somewhere between 2 and 2.5%.
I think that's a fair number. I would only point out it's a little bit. You've been running 2 and having a little bit hotter inflation, so maybe the potential is a little bit lower. But there's a big question here, and it's a big question for the administration. Is this investment that the president talks about, is it coming to the U.S.? And what is the impact? And I mean beyond AI. We know AI is happening, but the president has talked about really sinking concrete and building factories in this country that could be dramatic in terms of the impact on investment and employment in this country. If it's really going to happen, it could have a big impact on the numbers.
Yeah, I think we're expecting continued solid growth in investment. I haven't had a chance to see the investment numbers for the fourth quarter, but definitely lower rates will help a little bit. And the AI story, I mean, that's probably the driver for this year. Other stuff is maybe more of a longer-term issue.
So the sticky inflation, Aditya, is it, do you attribute it to tariffs that they're finally passed through? Is it because the labor market doesn't seem like, is the labor market strong enough for people to be demanding wage increases? Is that where it's coming from? Is it housing? Where's the sticky inflation?
There's a couple components there. Part of it is tariffs, as I mentioned earlier, about 40, 50 basis points. Basically, goods inflation usually runs 0 or negative. Right now, it's running somewhere between 1 and 2%.
A one-time event with tariffs? Or?
Probably a one-time. But then services as well, outside of housing, have been somewhat sticky. If you look at the share of services that are running above 2%, it's well above where it needs to be.
All right. Very good. All right, everybody. Thank you, Aditya. Thank you, Steve, Rick, Andrew. Thank you thank you.
You're welcome. Thank you. Okay. Coming up next, Florida Governor Ron DeSantis on big businesses moving to his state. We're going to talk about it all.
and billionaires who are relocating to Florida. The AI titan joins a long list of others who started a footprint in the business-friendly state, including Ken Griffin, Citadel, Ken Griffin's Citadel, Amazon, Apple. Others join us now. Florida Governor Ron DeSantis. Governor, it's good to see you. Thanks for joining us.
Yeah, look, we've got a lot going on in Florida, and you mentioned Ken Griffin, who had moved Citadel, a few years ago. Obviously, that has a big economic impact for a state. I mean, these are high-paying jobs. The footprint has really expanded. But one thing people don't talk about, and I can say certainly for Ken, he's donated in terms of philanthropic efforts, I mean, hundreds of millions, maybe even billions of dollars already in Florida. And obviously, he probably would have been doing that in Illinois had he not done that. So there's a big ripple effect that happens with all of this. Joe, I saw you in California, and I will tell you, this wealth tax is having a huge impact on people fleeing to Florida. 6 months ago, everyone was talking about Mindami causing New York to flee. I don't know that we've really seen that. But on this California thing, these are really, really big folks who are coming to Florida. We'll see whether they decide to move some business here. But I think they're in a situation where this has already either been taxed or it's an unrealized gain. It's a horrible tax policy to basically just seize some of the wealth. And then the founders of these companies, the way this provision is, they're imputed their voting rights as if they have equity. So for some of these big companies like Google, that's hundreds of billions of dollars that the founders don't actually own. And I think there's a sense of, hey, this is a ballot initiative. 50% plus one shouldn't be able to just vote and take away some of your property. Certainly our founding fathers didn't want to do that. So when I've talked to people, maybe it gets on the ballot, maybe it doesn't, maybe it passes, maybe it doesn't. But eventually something's going to get on the ballot and something's going to pass. And so I think people are taking action accordingly.
It's safe to say you're one of Mamdani's biggest fans, I guess.
Well, I think we're going to see. I don't think that story's been written yet, but I do think we're going to see an impact on that. I think it'll take a little longer. I think the California impact was very sudden at the end of last year because people saw the writing on the wall, and you saw a lot of big names noticeably, getting a foothold in Florida.
I mean, he's talking property taxes now if he can't get some other tax increase from the governor. What are you doing with property taxes? You're going to phase them out completely?
Well, first of all, didn't he run on affordability? How is it more affordable to raise property taxes on working class people? I just don't understand that. So what we're working through, and we got to work with the Florida legislature, is phasing out the property tax for Florida residents and their primary, what we call a homesteaded property. And the way it works in Florida is that's about a third of all the property tax revenue because, these local governments are taxing investment properties, snowbirds, second, third homes, businesses, all those other things. And so the context of this is in 2019, local governments in Florida brought in $32 billion in property tax revenue. Now they're bringing in $60 billion. So if you go back to that 2019 level of spending, you give them population growth, you give them the inflation, even add a couple % a year on top of that, you're not even close to $60 billion. So they're obviously getting a lot of this because property values have gone up. A lot of people moved to Florida, particularly during the COVID era, but people need relief. And what's happening, Joe, is you've got older people that have been in their home for a long time. They've had protection against valuation increases for 30 years. They're not downsizing because if they go from a 3 or 4 bedroom home to a condo, the tax basis is going to be so much higher that they can't afford it. So that hurts young people having access to be able to do it. So it needs to go on the ballot. It needs to get 60% of the vote, and we'll be working on that through the balance of the year.
Governor, you've had all the success getting all of these folks to come to Florida. That's the good news. The harder part seems to be the new challenge. You hear from folks who have moved who say it's hard to get into schools. There's all sorts of housing. Obviously, the price of housing has gone up. That can be considered a good thing in certain cases. For others, what do you see now as the biggest challenge of this success, if you will?
Well, I think on some of the school stuff, I mean, that is a very, very elite problem, and since they want certain types of schools that maybe they had in New York City or whatever. We've got a lot of very good schools, charter schools, public schools, and even traditional private. I think they're looking at things that are a little different than what the typical family would do, and people are starting to build those, at that level to kind of attract the talent. And I think that'll all work itself out. On the housing, I'm a big believer in, we shouldn't be trying to juice the housing market. We shouldn't be doing it. These things go in cycles. And I think what happened was during COVID, there was a massive rush in Florida. You could sell a 3-bedroom house in Newport Beach, California for $2 or $3 million, and you could get 3 times the size of that in like a Sarasota. Well, that caused these values to go up. These things kind of go up and down. I think most people look at the housing market now, and there's just not as many buyers as there were 3 or 4 years ago. I think that's true nationwide, but certainly in Florida. So I do think that will moderate, and I do think you'll see a correction. But it needs to be done naturally, and it's not something that we can do from government.
We're going to talk AI. We'll talk about your Bill of Rights. My idea, just as an aside, I was in Miami, went up to Jupiter and drove. I can't take the lights, Governor. I can't take the traffic lights. I can't take them. I can't take them anymore. I was like, there's 6 lanes everywhere all around, and first they got to turn left, then they got to turn left, then they got to turn left, and sometimes it just seems like nothing is synchronized. Is AI a possibility, or do I just have to realize there's a lot of people that like to be in a state with no income? It's crowded. Is that it? Is it that simple?
I think there's a couple things. So, I did like $6 or $7 billion of accelerated infrastructure because we saw the people coming, and it's like some of these projects needed to be done. They weren't even scheduled to start till next decade. So we accelerated them. We're going to be able to deliver a lot 5, 10, even 15 years ahead of schedule. Now, Miami, Fort Lauderdale is tough because it's basically all built out. And so to be able, you really can't build a beltway. You really can't build. You can maybe do double decker. Some people have talking about doing tunnels and things like that. But those are not easy solutions. So if there is technology, that can help it, that obviously something that I would be involved, that I'd be interested in. In a lot of other parts of the state, once you get north of West Palm Beach, we've had success in being able to do things like on I-4 near Disney to be able to widen that, increase the flow. But some of this is just to keep our head above water because we've had so many visitors over the years. We just set another tourism record in 2025, and obviously the population has grown over the last few years.
I was leading into the idea of an AI Bill of Rights to protect the kids. We talked earlier about, kids are getting it from all sides at this point. And I don't know what we do, but this is probably one part of a solution.
Yeah, look, technology is great, but it needs to be harnessed in a way that is going to be beneficial for Americans. It's going to reinforce our values as Floridians and Americans. And that requires a framework. And so when I have a mom, like we have in Central Florida, whose son committed suicide, in part because of an AI chatbot and the relationship that was developed there and things the chatbot were telling the teen, who was a very vulnerable teen, that's a big, big problem. When I have moms who had teens where they would have sexually charged discussions with an AI chatbot, is that really the society that we want to have? And I think we look at the social media era, there were probably some things that could have been done to provide some guardrails that would have mitigated some of the damage we've seen on that. So our AI Bill of Rights is basically protecting young people, protecting parents, providing transparency. It's all very important, but there's not a single thing in that AI Bill of Rights that is going to stymie any type of legitimate innovation. If we're stymieing sexually suggested chatbots talking to 13-year-olds, well, that would be a good thing. We don't want that in our society. We also want to protect ratepayers against having costs of data centers given to them, which I think we've seen in other parts of the country, and we'll be the first state, I think, to lay down that marker to say, look, you got to pay your own way on this. We don't want to see our folks having to pay more for electricity.
Governor, we just had Chris Christie on the broadcast, and we were talking about prediction markets and states' rights in the context of gambling. And I wonder where you land on that.
Well, it's interesting. This is something like really within the last year has really become a big deal. So in Florida, We kind of have a unique relationship with the Seminole tribe of Florida. There was things done long before I was governor to give them exclusive rights over gaming. They also have the exclusive rights over sports betting. And so the question is something like Kalshi, is that clashing with the laws of the state of Florida, or is it separate? It's more of a prediction. So we're kind of trying to get our mind around that. But it obviously is a different situation.
Thank you,
and,
Governor.
You have the way information is. I'm not sure.
Please come back.
TV18 weeknights at 7 p.m.
what they seem
See, David, with that, let's not be political. Let's have no politics for a second. If you just looked at these numbers, you would say, who in the Fed is saying, you know what, we should tighten? Are they that much worried about that little bit PCE? I'm looking at an economy that definitely needs help.
Right.
Needs help.
You could forgive people for being a bit confused, given all the different metrics we get, some of which indicated our economy is running fairly hot in some way. How much does this go against that narrative, and or what do you think?
Yeah, look, I was doing some work on rents. Rents is a good example. Rents are going down. They're in the CPI. But there's a bunch of cities, 18 out of 25 rents are going down, 7 are going up. And you look at the numbers and say, well, geez, I don't know, rent's not coming down like we thought. But it is. We see these areas of the country, Carl, that are so red hot. They're just fantastic. And then there's these other areas of the country. We talk about this K economy. I'm a someone to that because Walmart was willing to do it. I'm willing to do it in their conference call. But the real issue here is the two economies, the part of the country that is just ready to roll and is rolling. The part of the country just can't get moving. And I think that when we saw yesterday that Japan was willing to put a huge gas turbine in Ohio, well, that's great. You'll get them in 2033. So there's a lot of illusory commitment to capital. And then there's capital that's committed in Florida, in Louisiana, and mostly in Texas. The big capital commitments are in Texas.
Yeah, I mean, the Japan, that's 7% of that promised 550 out of Japan. And some argue they're trying to slow roll us on some of that stuff. Now, the president did try to get in front of this print and say it was somewhat due to the shutdown, and government did take about 9/10 of a point, Jim, out of the number.
Well, I'm not sure, but okay, if that's what he says. I guess I'm thinking about, well, you're getting a number which indicates that whatever you may think about the economy, I still think that there's a justification for cutting rates here.
Okay.
Well, I think that's important because that's not a political judgment.
Right.
I mean, even though PCE at 2.9 headline,
right,
this was a 2.3 number in April.
Right now, look, you can argue that oil's up very big. You could look at cattle. Then you go with rent. Then you go to heating, and heating's high. I mean, you can split the difference. Food's a little lower, away from cattle. I'm just saying that the agglomeration is not that frightening to me, especially after I listen to Walmart. See, I like to take my data from a Walmart. Walmart says things have peaked. I trust, David, when you look at numbers from a Labor Department, I don't know what's going on with Labor Department secretary. I think that's neither here nor there. But when I look at Walmart's numbers, not the fact that the stock reversed, I like the stock here, they're a better indicator of inflation than PCE, whatever.
Sure, I'll take that.
Do you think that Jay Powell says, wait a second, what is Walmart saying, or are they just agnostic?
No, I would think they are aware of that and focused on it to a certain extent.
That was very positive.
In terms of all they have incoming. I'm not sure what any of this has to do with the price of Caterpillar.
Caterpillar's directed by engines that can produce 2 megawatts. 1,000 engines produce 2 megawatts in West Virginia. I mean, you got to focus on Caterpillar. That stock doesn't double.
I just mentioned it for that very reason. Of course, you're just focused on these engines that they're creating to help power data centers.
Well, look, I love Deere.
Which gets us back to more of the heart of the matter here.
Well, where are the data centers being put? I mean, then nobody works at a data center to put it up. These are gigantic products. There's billions of dollars. So it should be producing something, but there's just. You can't get the natural gas to them, or we don't have your building a power plant. We know the power rates are really high. The team that's looking at Ohio Power was surprised by the Japanese offer. I mean, it's just all done. It's not smoke and mirrors, but there is a sense that unless you get the power in, then it doesn't matter what's in the data center.
Right. Well, yeah, data centers need power to run. There's no doubt. Run all those NVIDIA chips, in fact, Carl, is what they need.
How much is NVIDIA down?
I don't know if NVIDIA's down at all.
Down $1.50.
I don't know.
You have to
yeah.
$1.50. Probably.
I think erased some gains from earlier in the pre-market. CNBC can confirm the chip giant is in talks to invest up to $30 billion in OpenAI as part of that funding round that could value the startup at $730 billion pre-money. Source says the investment is separate from the $100 billion infrastructure memorandum agreement that both companies announced in September. Source adds the $30 billion is not tied to any deployment milestones.
That's very important because the earlier way this was portrayed was that it was a cut. And what you just said is that whoever reported that and stated that is wrong. And I think that's important because when I heard it early on this morning, I said, oh my God, David's going to turn to me and say, you know what, I told you.
What did I tell you, Jim?
NVIDIA that it's not a real commitment.
Well, it's never been clear exactly about the $100 billion commitment, and we've asked Jensen Huang about it in the past, never gotten a completely, what I felt like was a complete explanation, other than it was tied to certain milestones in terms of megawatts and gigawatts deployed by them.
Bullish.
But this is $30 billion. This is going towards, well, of course, a lot of the compute that will then end up.
Oh, are
being,
you going circular?
Oh, come on, Jim. I mean, it's $30 billion. Where is OpenAI spending their money? Yeah, of course. But that's only a part of it.
Do you know that?
Why do you get so offended by that?
Because it was offensive.
Why is that offensive?
Because it flies in the face of. It's fanciful.
Why is it fanciful?
Because if you take a look, NVIDIA's been selling things that allegedly were circular. They've been selling things. Take a look at their most recent report of what they own. They're all floating some of the stuff that I heard was, whoa, be careful.
My only point is that the money that is being
just
raised by OpenAI, $30 billion here, $30 billion from SoftBank, and perhaps a much larger amount from Amazon, though we haven't seen the full nature of the fundraise, could be well over $100 billion, is going to go towards building compute.
But look,
and when you build compute, you buy GPUs from NVIDIA.
They could drill the CoreWeave bid right now, right? They've made a fortune of the CoreWeave deal. Remember, the only reason why that deal 40 worked in the IPO was because of NVIDIA. They could just, boom, and don't be surprised. Now, they would say, look, I think CoreWeave's going up much higher, but this stuff has a bid. I mean, we're going to be talking about what has a bid and what doesn't have a bid shortly in the next block.
But aren't you kind of proving David's point that the bid is from NVIDIA?
Well, no, CoreWeave could bid. CoreWeave had, I mean, they could.
CoreWeave could bid on what? I'm sorry.
No, NVIDIA could do a secondary right here.
What are you talking about?
CoreWeave is a huge percentage of CoreWeave is owned by NVIDIA.
Yes.
And so NVIDIA could do a secondary right here.
Selling CoreWeave, the stock they own.
Because I remember
although, I mean, CoreWeave is obviously still up greatly from the IPO, though down from its highs.
But why? I mean, they could do it. And the reason I mention is because a lot of times in the 1999-2000, it was fanciful. There was no real bid for InfoSpace. But here, there's a...
but that has nothing to do with the fact that the money still went to CoreWeave, and CoreWeave took the money.
Well, but they could... Okay.
They're not selling CoreWeave stock. They're selling their own.
I don't want to get too... And I was joking on the offensive thing.
I'm never offended by you.
Okay, but I do feel that I'm just saying that I don't want to compare to Lucent. I remember speaking to the CEO of Lucent and to the CFO of Lucent, who was a pretty terrific guy. And the CFO of Lucent was saying something different from the CEO. The CEO was like saying, listen, the reason why the Brazil deal had worked, we would have made the quarter. And the Brazil deal was I give Brazil money and then Brazil buys stuff.
You're right to make that to make that specific judgment, because it is not. There's a similarity.
Right.
First of all, the scope and scale of it right now is just so much larger than even the telecom bill in terms of the dollars.
Who else are they going to give it to?
Who else are they going to give
Caterpillar.
it to? Yeah, Caterpillar.
It all comes back to Caterpillar.
Don't joke.
That's why
we might walk in here one morning and that might be something we see.
I have to tell you I think the Caterpillar, the resurrection of Caterpillar, and the great secular growth story, which started with Jim Umpleby and is now continuing with Joe Creed, is one of the remarkable things. And I want everyone to look at the Caterpillar chart and realize what can happen to a great American company if it puts its mind to it. That's what happens. What a company.
All right, up next, something else we've obviously been very focused on here. We'll have an exclusive with Blue Owl's head of credit, Craig Packer, joining us at Post 9. More Squawk in the Street straight ahead. Other alternative asset managers stocks have been under pressure. This certainly was the case yesterday after the firm said it would halt quarterly redemptions in its retail-focused debt fund, opting instead to return capital via episodic payouts, as it did sell down $1.4 billion of assets to allow for that. The move did reignite concerns around liquidity and valuation for many private credit vehicles. Joining us now in a CNBC exclusive is Blue Owl Capital co-president and the head of credit as well, Craig Packer. Craig, good to have you here. Thank you for being here
Great,
as well.
Thanks for having me.
Want to start off with the $1.4 billion because today's story or the focus on Blue Owl now has been around the sale itself. And I guess my first question would simply be, did you sell a cross-section of loans from across Blue Owl? So, you know, whatever percent of this and this and this, whether sector or companies, or was it you cherry picking the loans that were a particular, value, and therefore you could sell at what was 99.7 cents on the dollar?
Yeah, no, thanks for having me, and thanks for the opportunity to clear it up, because I think there was a lot of confusion, in part because the headline said we were halting redemptions. We're not halting redemptions, just changing the form, and if anything, we're accelerating redemptions. But to your question,
yes,
we sold $1.4 billion across 128 names in the portfolio. It represented a cross-section of about half the book, generally consistent with all of our industry sectors, all the types of loans that we make, and we sold them at par. Fair value, 99.7. I think most in the industry that follow this say the ability for us to sell that size at these prices is actually a validation of value. And people have been asking questions about marks, and here we are with significant third-party sales at par.
So again, right, to that point, then you would argue this is a reflection of the overall credit quality of the portfolio, not you selling what you knew you could sell.
We had ample demand for these names. We certainly, as you know, this particular transaction is a result of us calling off a merger of one of our smaller funds. In November, I was here. I said we have a number of options. We're going to come back relatively quickly and outline those options. This fund originally was raised about 9 years ago. The plan was either to IPO it, merge it. We tried to merge it, wasn't the right time. Or the third option was to return the capital to investors. We wanted to accelerate the return of capital to investors, so we opportunistically chose to sell a fairly sizable chunk. It's about 35% of the fund, OBDC2. And instead of doing a 5% program,
Hello and welcome to CNBC TV 18 special broadcast here live from the India AI Impact Summit. I'm Shireen Bhan. We're broadcasting from our studios. As you've been noticing, we've been live streaming here for the last several days. It is my pleasure to welcome to our studios here the Minister himself, Ashwini Vaishnav, also with us, K. Krithivasan, the CEO of TCS. Gentlemen, thank you very much for joining us. Mr. Vaishnav, let me start by talking to you about the milestone that's just been clocked. A record has been created in the Guinness Book of World Records. Please tell our viewers about that.
Our Prime Minister inspired us to involve the students in responsible use of AI. So that's why we reached out to the colleges and spoke with the faculty members as well as the students. And they all came out in large numbers to take a pledge on responsible and ethical use of AI. Guinness was expecting a number of 5,000 for a record. We finally came out with 250,000, 2.5 lakh students taking pledge. And just now Guinness gave us the world record certificate for largest number of people taking pledge to use AI responsibly and ethically.
Well, the certificate is on its way, and we should hopefully be able to show it to you by the end of this conversation. But Mr. Vaishnav, speaking about the ethical use of AI, and while this milestone is a significant one, the government has also brought in regulations, including more recently the labeling norms, Score AI for synthetic content. I want to start with that, sir. That's the first step. How far do you believe the government needs to move on regulation to try and address this issue?
This is very important because when people look at a video, should they trust that video or should they not trust that video? Is that a real video or is that a fake content, that choice in people's minds has to be clearly an informed choice. That's why it's very important that any video which is generated using AI and it's a deep fake, in that case, that label should be there so that people can make the choice whether they want to believe it or not.
Well, moving away from AI and labeling norms and regulation, let's talk about the big theme here. One of the big themes here at the India AI Impact Summit, and that is building out AI infrastructure. And I'll get quickly to come in on that as well. I know that you've firmly believed that the amount that's been committed to India by the likes of Google, etc., that's only the tip of the iceberg. You expect much more to follow. On the back of the conversations that have happened here, sir, the number you gave me in Davos was about 90 billion. What does it look like for the road ahead?
Over the coming years, we can expect about $200 billion investment in the AI infra layer. And simultaneously, we can expect more than $17 billion in VC funding for the startups and deep tech, especially deep tech startups, in solutions, in applications, in the way AI would be used.
The Qualcomm CEO, and they've just committed $150 million as part of a venture fund to invest in India-led AI startups. The question, though, is will India be one of the fastest growing AI nations from a consumer point of view, or is it also going to be a developer's nation from an AI standpoint?
I think India will be a developer's nation in the sense that we have today a very large IT industry which understands the enterprises very well. We have seen how our IT industry basically solved global problems in the Y2K situation. This one is a much bigger opportunity, in my opinion, where all the global enterprises would be looking up to industry partners who can come into the enterprise, understand the enterprise, look at the potential applications of AI-based solutions, and have that trust, which basically is needed for every enterprise, and create those solutions. And that's where our IT industry stands very strong.
Well, you believe the Indian IT industry stands very strongly. So let's get the picture from the Indian IT services sector itself. Your ambition quickly is of making TCS the largest AI tech services provider in the world. And in that context, I want to address the issue that was raised by the minister. Many believe that this is going to be a crisis for India's IT services sector, but the minister says it's going to be an opportunity. We've seen what has happened through the month of February. It's been a pretty brutal correction that we've seen from a market point of view. But do you believe that this is an opportunity for Indian IT to capitalize on and not so much of a risk as it is being made out?
Absolutely, Sharing. Like, I agree with the minister. We believe sometimes the bigger the disruption, the bigger the opportunity for us. And so there is some amount of fear mongering, some amount of lack of understanding. But if you unpeel what happens, there are three broad layers in which AI is impacting the IT industry. One is what we traditionally do. The second is what industries or enterprises have to do to enable themselves to leverage, adopt AI or accelerate their AI adoption. Third is what they can do more with AI. If you look at all these three, the first one, what we traditionally do, there is some productivity being brought in. Like it can vary from 20%, 30%. But even there, if you talk to the CIOs, they would tell you that this productivity, they're not going to reduce the headcount. Most of the CIOs would say there's so much of backlog they have not handled or catered so far. They would probably try to use the buffer available to cater to the backlog. So even in what we traditionally do, we don't expect a reduction in demand. Then for the enterprises to use AI, they have to get the data estate right. They have to reduce the tech modernization. They have to get the workflows right. There's so much of work to be done. And the third area is that they have to get the models right. Somebody has to build their models, train the models, orchestrate the model, build the agents. And the fourth is the most important. We call that what new they are going to do. For instance, some of our clients, we are doing a drug discovery using AI, or claims process automation using AI, or aggregators development. There's so much happening, and there's no need to panic. You have to think, sit back, relax, and think properly. There's so much of more work to be done. Every time there's a destruction, the work expands. And the good companies will participate, take a forward-leaning approach, invest in that, and they should be able to increase the pie.
Well, there is no need to panic. That's the word in Kumkekriti Basan of TCS. But I also want to talk about what we are seeing Indian IT services companies like yours do. Forge new partnerships. You just announced a partnership 24 hours ago with AMD to bring the Helios rack to India. And I want to understand from you the rationale for that. And is this going to now mean a pivot for TCS from software also to infrastructure? Or you've also got the TPG data set.
So it's again based on a larger scheme. We believe that you will be able to participate more in the AI ecosystem if you operate across multiple layers. Like Minister eloquently put together, you were there in Davos, the 4 layers, right? The more layers you participate, the more revenue, more value you can add to your customers. So we are looking at participating right from the infrastructure layer. There's the infrastructure layer, there's the model layer, there's the application layer, then there's the intelligence layer. We want to increase our participation in each one of those layers. That's why you see we participating with TPG, then signing up with KMD. We also signed up with some other design companies. So that's a overall plan.
And in this pivot to infrastructure, how do you see this changing the complexion of TCS going forward?
Definitely it's a pivotal moment for us also. We are investing in infrastructure. We are also getting more acquisitive because this is the area where we have to acquire capability and competency at speed and scale. So we are looking to be more acquisitive as well. So this is fundamentally going to change in a way how we approach infrastructure, how we are looking at capex and.
So more acquisitions likely. That is exactly the call. Mr. Bessam, I want to also address the issue of sovereignty. And I think that is being linked very closely to what many countries are doing, including India. We, of course, have a frontier model being launched with the support of the government. Sarvam is on course with that. But as you see more and more of this becoming critical to a country's security, to a country's economic security as well, what do you believe the way forward will be? What will our national priorities be?
Sovereignty has multiple dimensions. One of the dimensions is models. Another one is having the infra within the country. And third is having the legal framework. On the legal framework, we have a very balanced legal framework as a part of the Digital Personal Data Protection Act. And on the infra, which has to be in India so that we cannot be switched off. So that is right now building up very rapidly as part of our common compute, which is one of the major initiatives under the AI mission. We already have 38,000 GPUs. Another 20,000 GPUs is going to be added in the coming 6 months, and that will substantially increase over the coming months. So that's the...
Silica is a US-led initiative aimed at securing supply chains for AI and critical minerals. NVIDIA is close to finalizing a $30 billion investment in OpenAI, replacing a previously announced $100 billion multi-year partnership, according to the Financial Times. Sam Altman sidestepped a question on NVIDIA when asked by CNBC TV 18, but reiterated that the company needs more compute. I cannot guarantee AI will create more jobs than it destroys, says Anthropic CEO Dario Amodei. Adds the AI industry needs to be honest about the job challenge to address the same. That's an exclusive. Swiss pharma major Novartis to sell 70% stake in its India unit to Chris Capital for nearly 1,500 crore rupees. Chris Capital will also make an open offer for an additional 26% stake. Novartis India shares rally in trade. The board of Agri Major UPL approves a business restructuring plan. The company plans to create 2 listed companies, with one being a pure play crop protection unit. Move is aimed at unlocking value and simplifying the structure. UK police searched the royal mansion as investigation over Andrew Mountbatten-Windsor's dealings with convicted sex offender Jeffrey Epstein continues. The brother of King Charles was released 12 hours after his arrest yesterday. All right, let's start with the day's market action. A positive close to the week on Dalal Street. Sensex gained over 300 points and the Nifty gained over 100 points to reclaim the 25,500 mark. Mid-caps also rose in tandem with the blue chips, but IT stocks continue to remain under pressure. While the Sensex and Nifty managed to end the week in the green, the Nifty IT index lost over 2%. It has lost nearly 17% in just the last 3 weeks as fears of AI disruption hurt sentiment. Since the start of February, TCS is down 14%, Infosys is down 17%, HCLTech down 15%, Wipro down 20%, and Tech Mahindra down 15%. But the industry is not pressing the panic button just yet. From N. Chandra of Tata Sons to Nandan Nilekani of Infosys, the industry believes the AI disruption presents an opportunity for the IT industry. Anthropic CEO spoke exclusively to CNBC TV 18, saying that his company is not trying to replace industries and wants to work with all IT companies in India.
AI is a very, very important multi-decadal change. Every company has to figure out, has to ask fundamental questions. What is my moat? IT services companies, rather system integrators, will have a greater job, greater responsibility. One other point, but the companies have, IT companies have to do a lot of work.
Yeah,
like every other time, they've got to equip themselves with all the skills that are required. They've got to go through that.
You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk, it's an execution risk.
I think it's overdone. I mean, a lot of things that I've read in the social media and all of that feels overdone. But we do recognize that this is a big disruption. And if you really go after it, there are so many new opportunities. So I think as an industry, we will get through this very successfully, and that's what I believe. And we have responsibility as leaders to really make this transition happen.
We want to work with essentially, we want to work with essentially, all the companies in India. So, we're going to aim to get partnerships with, all the household names that you could think of. They're in different stages of discussion, and Infosys was the one that was announced just yesterday. We're very, very, very excited for the partnership. I visited Infosys the last time I came to India in October.
All right, let's talk about the money market. The rupee weakened by more than 30 paisa against the dollar. The Indian currency is now closer to the 91 mark against the greenback. 10-year bonds also tumbled in trade and the yields spiked by nearly 1%. The money market saw heightened trading activity today since it was closed yesterday. Now to the commodity market. Crude oil prices are on track to register their first weekly gain since January. This on the back of escalating tensions between the US and Iran. US has continued to amass military hardware near Iran, addressing the inaugural meet of the Board of Peace overnight. US President Donald Trump said that he will decide whether to launch military strikes against Iran in the next 10 to 15 days. US envoys held indirect talks with Iran on its nuclear program in Geneva this week. US Vice President J.D. Vance had also remarked that Iran did not address red lines set by President Trump during the talks.
Good talks are being had. It's proven to be, over the years, not easy to make a meaningful deal with Iran. We have to make a meaningful deal. Otherwise, bad things happen. They can't have a nuclear weapon. It's very simple. You can't have peace in the Middle East if they have a nuclear weapon. And they can't have a nuclear weapon. And they've been told that very strongly. They cannot continue to threaten the stability of the entire region. And they must make a deal. Or if that doesn't happen, I maybe can understand. If it doesn't happen, it doesn't happen. But